All right. So, residential status and scope of total income, first chapter. This, wherever you have seen resident, non-resident, etc., there have been some changes in the residential status over the years. So, we need to understand those provisions one by one. So, non-resident taxation, the total income portion is covered under 2 clause 45, that is income as defined in section 5 and computed in the manner laid down in this act. Generally, what do you mean by total income? As per 245, income as defined in section 5 and computed in the manner laid down in this act. So, section 5, the scope of total income is of three things here: resident, ordinary resident, resident, not ordinary resident, and then third one is non-resident. Three things: ROR, RNOR, NR. Now, residential status, if you think about it, you have individual and HF, and you have firm, AOP, local authority, company, all these people. For individual and HF, it is either resident or non-resident. And in resident, you have two things: ROR or NOR, resident but ordinary resident, resident but not ordinary resident. And for firm, AOP, local authority, company, you have two things: resident and non-resident. So, for resident, global income is taxed, and for non-resident, only Indian income is taxable. For resident, global income is taxed. For non-resident, only Indian income is taxable. Very simple. So, if you see the scope of total income, income received or deemed to be received in India. Second item, income accrued or arising in India or deemed to accrue or arise in India. Third, income accrued or arising or received outside India, but from a business controlled from India or from a profession set up in India. And fourth, income accrued or received outside India. So, received or deemed to be received or accrued or received in India is one part. For ROR, RNOR, NR, everything is taxable. For income accrued or arising in India or deemed to accrue or arise in India, again for everything is taxable for all. Income accrued or arising or received outside India, but from a business to be controlled from India. So, you are a resident, an ordinary resident, not ordinary resident. You are doing a business outside India though. You are selling, let's say, some products outside India, but the entire business you are controlling from India. Means what? You are into export business. From here you are exporting stuff. Everything is sold outside India, nothing is sold in India. So, will that also be taxable? For resident and resident, ordinary resident, resident, not ordinary resident, it is taxable. But what about for others? Non-residents. For non-resident, it is not taxed. For non-resident, it is not taxed. Means, if you are a non-resident, you have come to India and now you are controlling one business. The business is happening outside India, but everything is being controlled from India. You are a non-resident, taxable or not? No. People from Kerala have actually become experts in this last point. So, they go to Dubai and other places. For many years, they live there. They become non-residents, but they have close connection to their relatives here. So, whenever they come from abroad for a few days, they will set up a business in India and start exporting everything of those items outside India. And they will have all the businesses outside India, but the control is happening from in India. Right? I had a client who exported bananas, imagine, from Kerala and minted money. And one more client, he has become a multi-crorepati. And if you see, if I tell you what is sold, you will laugh. You've seen this coconut shell. That husk will be there, no? That husk with that coir, they'll do coir mattress and all those things. Kerala, he went to his farm, everyone was throwing it. It's of no use. It's a scrap. In India, it's like a scrap. So, he collected a few and went abroad, and somewhere else there was some coir industry for which their coconuts are not there in that country. He started selling them there to multiple countries from Dubai. And that coir guy, that quality of the coconuts are good and the coir strength also was good. Then now he placed an order for some 20,000 kgs. Then coolly he took a flight to India. He came to Kerala. There, all those for Onam he had come 2 years ago. Then he came. Then he went to all his friends who are farmers and he said, boss, you sell it all to me. What is the scrap value you are getting? 10 rupees. I'll pay you 40 rupees. Everybody sold to him. And then he exported, and each item he sold it for 500 rupees, 600 rupees. And just by selling the coconut shell for that coir, he has made crores. Is he paying any tax in India? No, because he is a person, actually is a non-resident. So those are some of the examples. So if you are a ROR or RNOR, you have to pay tax in India. But if you are a non-resident, then no need to pay tax. So what can be just thrown here in India, that becomes very famous outside India. So it's about ability. Then bananas abundantly available in India. Export to countries where bananas are at very, very high cost of import. So you charge very lesser amount because you have abundant supply. So all these are some of the mechanisms that Indians use. So you should learn business from Marwadis, Gujus, and down south from Mallus. They know the best. I'm not joking. True. If you be with them, you'll understand the art of doing business. Right. They have the brains. I mean, they have the acumen to do that. And I'm not generalizing, but generally that's how it is. If you see, right. So Gujaratis, again, Coldplay concert. 20 of my connects, they purchased. Each of them purchased 4 tickets. 20 people got. They knew exactly what to do. 100 tickets they bought and they sold it each one for 80,000-90,000. It's almost profit of so much. Think about it, guys. 12,000 ticket, they sold it for 90,000. 20 tickets into 80,000 per ticket profit. Just think about it. And they said they did not take in the bank account also. They direct, and this is not on via GoGo or any of those things. Direct. I bought the ticket. They said, I have ticket. Do you want or not? And these people who have FOMO, that I know I have to attend this concert. Everybody is attending. My friends are attending. So they bought 80,000. They bought tickets. Crazy. And there's everything cash deal. I bought 20 tickets. Everything cash deal. You come, meet me, and you pay cash. No, I'm in Bangalore. No problem. My Guju friend is there in Bangalore. He will collect it. They are there everywhere. No, so imagine, brilliant. So that's the reason, actual reason why genuine fans didn't get tickets. Because most of the people are these people who are actually selling. Here only in this room, 2-3 ideas were there, no? We are all like normal fellows. We had that idea. 2000 you went. See, you had that idea that, okay, maybe I can sell it. But the thing is, that's what it is. So they had the acumen. So this is pure business, guys. Now, they have done it just once. They have made 18 to 20 lakh profit in one day. Which stock market gives you this? Right? Yes. So, now is that also business as per PGBP? If it is in the bank account, should you pay tax? Yes. But they were smart there also. Everything full cash deal. And they know, if you say, no, I don't have cash, okay, no problem. Some other fellow will give. So, somebody had to dispose of his black money anyway. And his son and daughter was crying, I want Coldplay. Who's the main lead singer? Don't know, but I want to listen to Coldplay. Right? So, thing is, what happened? Yes, everyone is going, I also want to go. Fine. Father, mother, black money, pay. That's how the deal is. Crazy economy, right? Yes. So, resident. It's like when Linkin Park Chester died, everyone said rip, rip, rip. And who's the lead singer? Don't know. That fellow only died, no? Yes, that's what happens. Anyway, resident, basic conditions. One of the two basic conditions have to be followed, guys. Now, I have already told you are resident, not resident, non-resident. But who is this resident? That's what we are discussing now. Resident, two basic conditions, guys. Basic condition number 1. 1 out of 2 has to be followed. Condition number 1. Stays in India for minimum 182 days in the previous year. So, my previous year is 23-24. Right? Or stays in India for more than or equal to 60 days in the previous year, 23-24. And 365 days in the last 4 preceding financial years. Means, if my previous year is 23-24 year, if my previous year is 23-24, previous years, 1920, 20, 21, 21, 22, 22, 23. Those 4 previous years I should have stayed how long? 365 days, all 4 years put together, only then I am called as a resident. So, one, I should have stayed in India for in the last year for 182 days. Or second one, last year 60 days, but before that 365 days. So, as of now, we are CA students, we are all under the first category. But once you become a CA, you get a job abroad. When you go abroad, that year you are just in India for like 1 or 2 months, but now you shifted there. When you shifted there, so you are seeing it the next year. Previous year you stayed for how long? 60 days, more than 60 days. You stayed for like 3 months in India and then went abroad for 9 months. So you have stayed for more than 60 days, 90 days you have stayed. And before that 4 years, 10 years I am doing CA, we are only in India. So that remaining years you are anyway in India. So are you a resident? Yes. But 3 years you have already shifted there. Will you be called as a resident? No. Because none of these conditions would ever have been followed. Mind you, this is an and. Yeah, sorry. Yes, even the next year if it never comes to India at all. Did you stay in India for more than 60 days in the previous year? No. So the moment one basic condition also is not fulfilled, either of the two, one should be followed. If you don't follow one, automatically you are what? Non-resident. Right? Yes, basic condition is, but this is A1, this is A2. Just write this down, guys, because it's important. 3-4 charts I'll give you quickly. Just write it down because there are many small changes by Nirmala madam in the last 1.5 years. So I'll give those things now. That's why. Don't read the Where Act, very confusing. Don't read anything, may be confusing. Just stick to this chart. Everything is covered in a very easy way. And write those and. Just previous year, you please change it, okay? Previous year is not 24-25. For you, it will be 23-24. In the bracket previous year I have written, no, that is different. For you, it is how much? 23-24. Three, four important charts and then good to go. That is the thing here. So you just try to remember, revise and then write it off. The previous year will be 23-24. Stay in India more than equal to 60 days in previous 24-25, that is 23-24, and before that 4 years. Got it? Next, one interesting thing now, there are 3 exceptions. There are 3 exceptions where A2 should not be read as 60 days, this A2. There are 3 exceptions where this A2 should not be read as 60 days. What are they? I'll give you time to write down, but first one by one. There are 3 exceptions where this A2 point, the 60 days point should not be read as 60 days. Point number 1, you are an Indian citizen, you have gone for employment outside India, including for business or profession. And in A2, 60, it should be read as 182 days. So if you are an Indian citizen, you have gone for employment outside India, including business or profession. So in the point A2, that 60 to be read as 182 days, which means very simple, 1 and 2 becomes the same then. If you are a resident only if you have stayed in India for more than or equal to 182 days in the previous year. So that example that I told you, when you go abroad now, that's it. That year only it will be shifted to what? 182 days. So residential status doesn't depend on your citizenship in income tax. That is one thing we need to understand. Second one, different one. Indian citizen, you are part of the crew of an Indian ship. You are part of the crew of an Indian ship which keeps on going abroad. Very simple. A2, at 60 days to be read as 182 days. So you are a resident if the stay is more than or equal to 182 days. These two are simple. So if you are going abroad for employment is one, or if you are Indian citizen, part of an Indian ship only, which will travel across the world, it will be treated as 182 days. Third is the amendment actually. I'll give you time to write down. Third is the amendment, guys. You are an Indian citizen or a person of Indian origin. Who is this person of Indian origin? Grandparents are in India. Then you were actually a citizen of India, then you shifted abroad. Is Sundar Pichai person of Indian origin? Yes. Satya Nadella, person of Indian origin? Yes, because their grandparents or parents were part of undivided India. That's how it is. So generally persons of Indian origin, even in FEMA, they could not have held assets in India. But then they changed the definition of person of Indian origin to include all these people. And what about spouse of an Indian citizen? Foreign, like for example, Priyanka Chopra has married Nick Jonas. Is Nick Jonas person of Indian origin? Weird, right? Right? So, but unfortunately in FEMA, the definition says person of Indian origin will include what? Spouse of an Indian citizen. So let's for example take a lady called Sonia, just an example, right? Has gone to it, right? So she is in Italy and a person called Rajiv just goes there. While eating pasta, he will see this girl and then they get married, pizza and all. Then while coming, they get married and come back to India. The moment that lady comes to India, she becomes person of Indian origin. She's never set foot in India. That's the level where politicians, whether BJP, Congress, whoever it is, change the law. So they were made what? Persons of Indian origin. Deadly. So the thing is, and she was about to become Prime Minister. There was one guy, one mental guy is there, Subramaniam Swamy. He was the one, he went and he doesn't leave anybody. Even BJP, Congress, doesn't leave anybody. So he went and put a case in the Supreme Court saying that she is not at all an Indian. She has no roots of India there. Right? So yes, that's the reason. So unfortunately, person of Indian origin, yes. So like 1 year ago, what about Shoaib Malik? Now they are divorced, but Shoaib Malik is a person of Indian origin. Realizing their mistake, they changed the law, except Pakistan and Bangladesh. Right? So person of Indian origin means spouse of an Indian citizen, except that spouse should not be from Pakistan or Bangladesh. Nothing. They said, they very clearly mentioned, if you are a spouse of, you are undivided India, but I am not talking about your spouse. Your parents, grandparents, undivided India. But your spouse, like Shoaib Malik's grandparents were in India once upon a time. I don't care. If the spouse is from Pakistan or Bangladesh, gone. So you can never be called person of Indian origin. No, person of Indian origin, that's what. The thing is, you should be married. Right? Yes. Or husband should be dead, then no problem. Right? Then it's not an issue. Right? So if you see the spouse, if it dies, then I think you are still married. That's what, person of Indian origin. That's what I'm saying. That's why I gave an example. Husband, if he is knocked off, no problem. Then you can still be a person of Indian origin. except Pakistan, Bangladesh have added later. So poor Shoaib Malik, right? He cannot hold any, asset in India. Indian citizen, person of Indian origin, non-resident. So actually, Nick Jonas, surprising. I mean, when Priyanka Chopra just got married, is definitely a person of Indian origin. It's absurd and weird, but that's how it is. So Indian citizen or person of Indian origin. Second, non-resident. Third one, come to visit India on a comes to India on a visit. So either you are an Indian citizen or a person of Indian origin or non-resident. You come to India on a visit. Stay in India greater than or equal to 182 days in the previous year. That is normal. Fifth point, guys. In A2, 60 to be read as 182. This was always there. 60 to be read as 182. Now enters the people from the Gujjus, Mallus. What they did, I told you, no? They were staying only for 180 days. Came to India, 6 months nicely they stayed. They actually were planning it. I'm not even joking. 182 days if you are in India, you are a resident, more than 182. What did they stay? 180 days, exactly 6 months. 6 months in India, 6 months in Dubai. First, who are you? Indian citizen or person of Indian origin? Or you are a non-resident. You were already there. Now you wanted to set up this business in India. You can't just sit there and do it. No. So you came to India, work for 6 months. 6 months here, 6 months there. And then this money was called, this entire money here, this part, no, this dangerous, this part they were eating left, right, center. So Nirmala madam cannot take these things. For her also FOMO happens, right? So if any money goes, fear of missing out. So yes, so what did she do? This particular section was changed, guys. Only this, mind you. What was the amendment in 2020? 180 days to be read as 120 days. So you can't come here and stay for 6 months and all those things. You have to stay only, you up to 120, you do whatever you want. People were staying 150 days, 160 days. She analyzed that trend. That's why she brought about the change where she made it 120. Anywhere else, if you read this full confusing, it will be just stick to this chart. Okay. Copy this. Then I'll tell you more. More I'll tell. Don't worry. So this is regarding this. So you can just say 182. That 182 is now shifted to what? 120 days. The question was, by making it 120, what happened was, even that amount which was there, which was for non-residents, which is controlled from India, you are only a non-resident if it is 182. That became 120. So most of the cases, people who were staying for, more than 120 but less than 182 days. That's what people were doing to set up business in India. That amount came under the ambit of taxation. That was the change actually. But did they really get so much money was another question. So Narayan Murthy was the first guy to speak up. He said, there is no point making it 120. Please make it 182 only, or make it more also, I don't care. Make it 200. Let the people from outside come to India. They would definitely like it. That 180 days, 120 days is absurd, is what he told. Because, he said, let them come to India. Indians, we should welcome them with open arms, because ultimately they are Indians and a lot of money will be pumped in from NRIs. So that's the reason if you see Modi, every time he goes and meets the Indian diaspora everywhere, as we speak is in USA, right? And to a bunch of oldies, Hanuman kind was singing. That was more ironical, right? He's singing his song with full josh, but these oldies are seeing somewhere else. They didn't understand only, right? Yes. It's all funny. If you become famous, you have to do all these things. Yeah. Yes. Initially, 60 was read as 182 only. In all three cases, that removed the 60 point to 182. Only in the third point, now 182 is shifted back to 120. So in simple words, 60 to be read as 120. Right. Yeah, depends on what they, how many days they are in India, for sure. Is Matthew Hayden and all is dying in India only, right? So that fellow will definitely be a resident. One thing or the other he'll be doing. John T. Rhodes has shifted to India. John T. Rhodes, South African amazing player. He is now shifted to Goa. He's in Goa. So he's actually a resident in India. See, citizenship does not matter. It is a residential status. Adnan Sami is a Pakistani citizen. He got Indian citizenship. So, is he a resident? Yes. Even if he becomes an Indian citizen, but if he stays somewhere else, he doesn't make him a resident under income tax law. Citizenship is immaterial. John T. Rhodes is a foreign citizen. He shifted to India. After a few years, I am sure he'll apply for Indian citizenship. I don't know if he already applied. Yes, so that is what it is. Huh. Who example? Which one? Huh? IPL, IPL, okay, tell me, huh? Correct. Yeah, you're right. Yeah, you see here, if that fellow, no, that will be a resident, not ordinary resident. We should discuss that logic. For them, if he is earning anything outside India, that will not be taxed. We will come to that step by step. But take Virat Kohli. Virat Kohli may be a citizen, but he may not be a resident in India. For the last few months, he is living in London. So, he may not be actually called as resident. But he is a, what do you say? He may not be. But if he is a resident, an ordinary resident at it, he should stay for, I mean, his entire income, global income will be taxed. So, anything that he earns outside also will be taxed in India. But how does that work? That will be your double tax avoidance agreement, DTAA. So, you have to see the DTAA rules and all those things. So, basically, first and second one, 60 shifted to 180, no change, 182, sorry, no change there. Only the third one, because of our Mallu brothers, Gujjus, actually, she actually did the analysis. She also told that people from these areas, they are doing this very, very rigorously. So, I need to change the law. In the budget speech, it's given there. Not in the budget speech as such, but in the memorandum. Have we done? So, this is the simple thing, guys. 60 days is shifted to 182, but the 182 was changed to 120. As simple as that. Now, amendment, yeah, this one. 182 is read as 120. 182 is read as 120. Now, there will be, for these people who are in and out of India, there will be three things. One is what? Up to 120 is one, then 120 to 182, one is more than 182. More than 182 is Indian only, I mean citizen, resident. Up to 120 what to do, then 120, 182 what to do, we will see that. But for that I need to understand whether you are what? It is whether you are resident and ordinary resident or RNOR is what I need to see. So, let us discuss that now. If you are an individual, you are either resident or non-resident. For non-resident, both the basic conditions are not followed. For resident, at least one basic condition is followed. That is either A1 or A2. And if you follow one basic condition, if you want to be called as a ROR, both additional conditions have to be followed. And if you are RNOR, you need to follow at least one additional condition. To be called as a resident, at least one. But to be called as a ROR, you should first be a resident plus both the additional conditions to be followed. But if you are RNOR, then only one additional condition to be followed or no additional condition satisfied. What are the additional conditions? You are resident in India for 2 previous years or more in the last 10 previous years. You are a resident in India for 2 previous years or more than 2 previous years or more in the last 10 previous years. And you are staying in India for 730 days or more in the last 7 previous years, deadly. You should be resident in India for 2 out of 2 or more in the last 10, which means every year I have to choose this. That they'll give in the exam only, that he was a resident in all these years, that's no problem. And he should stay in India for 730 days or more in the last 7 previous years. So then you will either be this or you will be that. You'll have to see that. So basically guys, again I repeat, individual, resident or non-resident. For non-resident, both the conditions should not be followed. And resident, at least one basic condition should be followed. Basic condition is this, already discussed. And once you follow at least one basic condition, then you will be moved to additional conditions. For ROR, both the additional conditions should be followed. Or RNOR, only one additional condition to be followed. And if you are ROR, additional conditions, resident in India for 2 out of the last 10 previous years and stay in India should be 730 days or more in the last 7 previous years. Now the question to you is, these 120 days fellows, will they be called as ROR or RNOR? I am staying for, it is shifted to 120 down. No? So if I am in India for 125 days, 140 days and all, I am setting up business here now. Will I be ROR or RNOR? Kerala guy who is now who's a non-resident actually, but suddenly comes to India in the last couple of years, is staying for 130 days, doing business and going back. So that is again the thing now guys. Now, this is the structure. I'll explain and then give time to write this down. So the thing is, Nirmala madam said, this part is what I need to tax. But for that, I need to see the income, these two income also. That is income received in India or arising in India. That should be some value. If you are earning some 1 or 2 lakhs, you do whatever you want. If these two money that you are earning from India is more, then only this will be taxed. So what is that deal? What is the amendment? Now we'll come to that. Indian citizen of a person of Indian origin who comes on a visit to India, that last part, 120 days part. If his net total income or net taxable income is less than 15 lakh rupees, that is other than income from foreign source. Means what guys? All these three put together. So for a Dubai guy, this and this may not be there, but he's selling the husk and is making 10 lakhs, ignore. If he's making 1 crore and all that, like my client, then only Nirmala aunty will get FOMO. So if you see, check this, if NTI is less than 15 lakhs, that is other than income from foreign source. Other than income from foreign source is the last row. Anything that you earn abroad, I don't care about it. But the first 3 rows, if you are earning less than 15 lakh rupees, then 182 days, that 60 days will be read as 182 only. There is no change. 60 days will be read as 182 days. There is absolutely no change. But if your NTI is more than 15 lakhs, what is the net NTI? Net taxable income, which is other than the foreign income. Basically, Indian income plus that income where you export and make money, business is controlled in India, that all put together, if it is more than 15 lakhs. What is the modification? 60 days is now 120 days. Correct? 60 days is now becoming 120. What happened? 60 days became 182. 182 was modified to 120. So that's what I am trying to tell. This, whatever you wrote down here, in point number 5, 182 days to be read as 120 days. In which case? Only when your NTI is more than 15 lakhs. Only when your NTI is more than 15 lakhs. Otherwise, this will remain. 60 to be read as 182 if your NTI is less than 15 lakhs. That's why I didn't delete it. That's why here, this is the final chart for you to understand. Very simple guys. If NTI is less than 15 lakhs, other than income from foreign source, then A2 to be read as 182 days instead of 60 days. No change there. On the other hand, if NTI is more than 15 lakhs, NTI is more than 50 lakhs, then A2 is modified. Instead of 60 days, how many days should I take? 120 days. Plus 365 days will continue. Now, are you ROR or RNOR is the question. Nirmala madam says you are deemed RNOR. I don't have to check the additional conditions. Deemed RNOR. Did you understand the amendment? Not many questions have come. Copy. important amendment, guys. So ultimately, guys, if a person of Indian origin comes to India and his net taxable income is more than 15 lakhs, if your stay is less than 120 days in the previous year, non-resident. If your stay is more than 120 days but less than 180 days in the previous year, then stay is more than 180 days. If the stay is more than 182 days, then you are resident and you have to check the two additional conditions to see whether you are ROR or NOR. But if your stay is anyway between 120 days to 182 days in the previous year, then I'll have to see whether the stay in India in the last 4 years is 365 days. So the stay in India in the last 365 days, 4 years in the last 365 days in the last 4 years, I have to add everything, and automatically you will become a resident, not ordinary resident, only if answer to the question 1 is yes. This is predominantly for those businessmen who are staying 5-6 months in India, rest abroad, setting up business in India, exporting goods there, only for them. Right? So we should, 120 to 182 days. Less than 120 days in previous year, more than 182 days, and 120 to 182 days is the next part. Right? So this is for that. Now they are automatically deemed what? Resident and not ordinary resident. Simple. So this is the deal, guys. This, if you understand, other things are very, very simple. Now this these guys who are in the ship that I told you, part of the crew of an Indian ship. Sometimes they'll be in Chennai, then they'll go to Kochi, and from there they'll go to Sri Lanka. Then again one day they'll come to Chennai. They'll be, obviously in the sea. So what should I take? When I come to India, I should exclude, because Chennai to Kochi is 1 day sailing time. There are pleasure cruises and all. So then, then again from Kochi we'll go to Sri Lanka. And 1 day will come to Chennai, then go somewhere else. So in this case, what should I do? So that's why there is something called as a continuous discharge certificate. So let's say you may alight from Chennai, then go to Kochi, Sri Lanka, Lakshadweep, Singapore, Indonesia, Malaysia, and then again come back, whatever it is. There will be a continuous discharge certificate where they will count everything. The day you reported, 24th August, and the day you disembarked from that ship, that entire period will be deemed to be not in India. Not in India. If you left India on 24th August, generally I am saying, guys, if you are going by flight, 24th August morning you left, you will count 24th August or not? And you came back on India on 14th October, you will count that or not? So you see, if I am flying out on 24th August is counted as residence, definitely. Similarly, if you come back on 14th October, that is counted in the residential. Exception is ship. In ship, 14th October morning 10 a.m. you reported into the ship. Sorry, 24th August. 14th October at morning like 1 a.m. you disembarked. But the beauty in that ship is hidden point again. 24th August to 14th October. Even if you alighted or you disembarked early or late, doesn't matter. It is deemed to be you are outside India. In any other rule, whatever you said was correct. And I am flying. The day I am flying, that is deemed to be in India. The day I come back, even if it's 11:45 p.m. I landed, it is you are in India for the full day. Only in the ship, the day you get onto the ship and disembark, that also will be counted as outside India. Right? That is what. People like Vijay Mallya, he will stay in a place called Bermuda for 40 days, Switzerland 30 days, Seychelles 20 days, Cayman Islands 50 days, British Virgin Islands 40 days, various places. Now these people, they are staying in various tax havens. So for these people, is there any special case? And because of which they were being called as what? Non-residents. So what do you do? Check this. Page 1.3. Another section was added in Finance Act 2020. Person, citizen in India, citizen of India, his total income other than income from foreign sources exceeds 15 lakhs, means that NTI. He is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. Not liable to tax in any other country. Why? People were playing around like this. I was staying I'm a citizen of India, but I am going to various places and staying like this throughout the year. And these earning money, I have multiple businesses, all these places. All these places are called what? They are tax havens. Tax havens. In those countries, you are not liable to pay tax at all. So by earning that money, you are not paying tax there also, you are not paying in India also. So Nirmala madam caught hold of these people also, and new concept was added called deemed resident. Many of us do not know this section actually. Deemed resident. Did you know this? 6.1, yes. And if you knew, good. Otherwise, many people have no idea about this new section. Deemed resident 6.1a. So an individual shall be deemed to be resident in India if in any previous year the following conditions are satisfied. Deemed to be resident in India. Person is citizen of India, total income other than income from foreign source exceeds 15 lakhs and not liable to tax in any other country by reason of his domicile or residence. Tax haven. Such individual shall be deemed to be resident but not ordinary residents, and his income will be chargeable to tax in India. So when 2020 this thing came, no, all the people living in Dubai got wild, because that time there was no taxation in Dubai. Now it is there. So they said, boss, our country also is not liable to pay tax. So what do you think? This is for those countries or only tax havens? So what do you think, guys? See, liable to tax means that there is an income tax liability on such person under the law of the country for the time being in force, and who has subsequently been exempted from such liability under the law of that country. So now they are trying to tell, no, what I actually meant was, if you are paying tax at zero rate, if you are exempt from tax, no problem. You are liable to pay tax. Not liable to pay tax means what? And shall include a person. So even if you are paying tax at zero rate, it is deemed that you are liable to pay tax. Don't worry. Right? This is only for, she made a very clear cut thing that this is not for those countries where you have to pay tax but you are exempt from paying tax. In Dubai, tax was exempt. The Dubai law says you can impose tax on anything, but as of now, tax on income tax is exempt. There is no income tax that time. So she very clarified saying that the reason why I inserted this section was purely for what? Tax havens. It was written in the memorandum and given a clarificatory, clarification released also. It's only for tax havens, those countries where there is no concept of income tax only. So that's the deemed resident. So people living in Dubai at that point of time didn't have to worry about this section. It's only for the people. So this doesn't require any days to stay here, 80 days, 60 days, 20 days, nothing. You should be an Indian citizen, mind you. This is the section which talks about citizenship, not about residential status. If you are a citizen of India but living in tax havens and making money there, and your income from India is more than 15 lakhs, and you are escaping that third point again because you are setting up business in other places and making money there, all that income you come and pay tax here, because there you are not paying tax anyway, and you are actually controlling a business from India and you are a non-resident, come and pay tax here. Correct. But ideally, that was the idea. Idea was, first is Dubai people, anyway, that Dubai example that I gave you, you stay in India for more than 100 days, for that I will tax anyway. Other than that, if you are not in Dubai, you are in tax havens, you are running multiple businesses in tax havens, either controlling from India or otherwise. Or you never visited India, but you are still, I know that you are controlling businesses. Now you are deemed to be resident in India, deadly. But you should be a citizen of India. Not person of Indian origin, citizen of India. No, person of Indian. Akai Kohli is also not citizen of India. He can be. There's dual citizenship concept and all those things, yes. And this generally in the FEMA, it talks more about the citizenship, etc. And of course, the whatever you are doing also, that also matters. But in income tax, more than citizenship, it purely talks about what? Residential status. Akshay Kumar, for the longest time, was never a citizen of India. He was a citizen of Canada. So there were obviously people were telling that how can you call yourself Indian when you are actually not Indian? But yeah. Done, guys. Now HUF, residential status. We also discussed that in the little bit in the HUF and also LLP and all that partnership form. HUF, guys. HUF, this HUF part we didn't discuss because we discussed the firm. Firm, remember, if control is wholly outside India, non-resident. Little bit control in India, resident. What about HUF? HUF unfortunately depends on the Karta. If the control and management is wholly outside India, then non-resident. The control and management is wholly or partly in India, resident. But is HUF ROR or NOR? That depends on where the Karta is. If the Karta satisfies both additional conditions, ROR. Karta satisfies one or none of the additional conditions, or NOR. AOP BOI firm purely based on control. Now guys, residential status of companies. Residential status of companies. If an Indian company incorporated in India, which has a certificate of incorporation in India, they are always resident. If a company is there other than an Indian company, will you be called as a resident? Yes. If control and management is wholly in India. Indian company incorporated in India, certificate of incorporation, if it has, always resident. Infosys, resident. Reliance, resident. Company cannot be a citizen, resident only. Other than Indian company is a resident if control and management is wholly in India. But there were a lot of doubts with respect to what do you mean by this wholly in India? What if the main MD is outside, others are here, or MD is in India, others are outside. The main decision makers are outside. The board of directors are all outside, but MD is here. A lot of confusion. So Finance Act 2016 came out with some guiding principles called the POEM rules, place of effective management. So these were the guiding principles for companies with turnover of more than 50 crore. Big companies. I need to see where the effective management exists. So there were some POEM guidelines which spoke about if the POEM is in India, then you are a resident. What do you mean by place of effective management? We will see. The POEM is in India, you are a resident. If, and they created one more scenario called ABOI, that is active business outside India. POEM will be in India if the active business is in India. POEM will be outside India if the active business is outside India. Then you are called as a non-resident. So if the POEM is in India, see again, if your Indian company incorporated in India, no POEM, no active business, nothing you should see. That's it, you are resident because your incorporation came here. ROC gave you the certificate, chapter close. Only for other than Indian companies is the question. Whether you are resident or not depends on this. You are incorporated in Russia, but your place of effective management is in India. Everybody stays here only. Only the incorporation is outside India. So that will be a resident. Many people incorporate their companies in Singapore because there it's easier. But the entire operations, management, everybody sits in Chennai. What is it? Resident. On the other hand, where your incorporated also outside India, active business is also outside India, then the poem is outside India. So how do I figure out this poem and active business outside India? There are 5 conditions. 4 conditions talk about active business outside India, and 1 condition purely talks about the board meetings. This is what we need to understand. So if these 5 conditions, 4 conditions with respect to active business outside India and 1 condition with respect to the board meeting, all these conditions are, fulfilled, then you are a non-resident. Otherwise, you will be a resident. It is deemed that poem will be in India. Again, I repeat, guys, Indian companies don't even see this. Indian companies directly what? Resident. This is for foreign companies which have a main business in India. For them, I need to see whether the active business is in India or outside India. If I come to know that the active business is in India, then resident. How do I figure out that active business is outside India? 5 conditions have to be followed. Condition number 1, your passive income should be less than or equal to 50% of the total income. So, we will see that here. The residential status basically is for companies with more than 50 crore or more turnover. Guiding principles of determination of poem, circular number 6. The residential status of a company other than an Indian company has to be determined on a year-on-year basis as follows. So, same thing, it's given here, no need to draw anything, already given. So, one is the board meeting route, other one is other routes. Passive income is not more than 50% of its total income. Whether companies engaged in active business in India or outside India, all the conditions must be satisfied. First one, passive income should be less than or equal to 50% of total income. Only then you are called as, first of all, you are having an active business outside India. So, passive income should be less than or equal to 50% of total income. Passive income is what? Royalty, capital gain, dividend, interest, rental income, all these things must be less than or equal to 50% of total income. Which means your income that you are generating should be something more. Passive income is nothing. If the passive income is happening in India, this is less than 50% of total income, then it is still deemed to be outside India. Condition number 1. Condition number 2, less, and mind you, all conditions should be satisfied. Less than 50% of the total assets must be, are in India, which means of all your total assets, less than 50% should be in India. The moment more than 50% is in India, poem is in India, that's all. Poem is not in India, first of all, passive income that you are getting in the company should be less than or equal to 50% of the total income. What is the direct income of PVR? PVR movies, what is the direct income? Ticket sales. Passive income, popcorn. But shockingly, in 1 year, popcorn expense income was 52%. One balance sheet I was seeing. That is your food and beverage, F&B was 52% of PVR's income, guys. Crazy. Right? Actually, popcorn 30 rupees you can make. They charge it 300, 400, and we pay also, because movies when you are watching, yes, Here, at least in Chennai, you won't feel the pinch because 60 rupees seats are available. You get 100 rupees and all, there are seats, which is very, very nice. In Bangalore, one movie means minimum 1000 rupees, minimum 1000 gone. Seats itself are 400, 500, plus popcorn is 500, 600 gone. So, so that is a very good example of PVR, is an example where passive income only is more. Indirect income, other income which you had not even considered, passive. But active income is ticket sales, distribution income, that is only less. For 1 or 2 years it was like that. Now it has reduced. Right. Because it's in India, we will also know elite income, correct? We will not have there, right? Yes. So, royalty, capital gain, dividend, interest, all these things. Second one is what? Less than 50% of the total assets must be in India. Or if they are in India, what do you say? That one. So, fixed assets, I should take last 2 years average, right? 1st April to 31st March of the last 2 years and average it to understand the fixed assets component, not just the last year. Other assets, take it at book value. Add everything. Total assets also same calculation. Indian assets also same calculation. If the Indian assets, whatever is in India, is less than 50% of the total assets, then the active business is outside India. Third condition, of all your employees in the world put together, the employees who are employed in India must be less than 50% of your workforce. If you have 1000 employees overall, if people working in India is less than 500, then active business is outside India. But out of 1000 people, 900 are working in India only. Then poem is in India. That's all. That's why for you to be called as non-resident, all the 5 conditions should be followed. First condition, passive income. Second condition, assets. Third condition, employees. Employees also, I will take what? Average. 1st April to 31st March by 2. Should I take contract employees also? Yes. Link to the employees. This was very smart. 1000 employees are there. 100 are in India. 900 outside India. In India or outside India then? Outside India. But those 100 people are getting 90% of the salary. All brains in India, other fellows outside India, brawn outside India. 900 people are getting 10% of the salary, 100 people are getting 90% of the salary. That's why they added that point. Payroll expense also pertaining to this point. Payroll expenditure also should be less than 50% of the total payroll expenditure of that particular company. So guys, first case, passive income. Second case, total assets in India. Third, less than 50% of total employees are situated in India or resident in India. Lastly, payroll expenditure less than 50%. Plus, lastly, majority of the board should be in India or meetings etc. should be held outside India. The board should sit outside India, board of directors, or the main decision maker should be sitting outside India, and all the board meetings are also held outside India. Vijay Mallya's board meetings always used to be abroad. Bangkok, then Vietnam, everywhere. He used to have these board meetings everywhere. So then does it mean you are active business outside India? No, because that's an Indian company. So you should see only for these things. Where is the decision happening? Outside India. All these things will be then you can say that you have an active business outside India. Otherwise, in India only. That's what. Location where I am reading page 1.7. Location where the board meeting is held. I should see. Just holding the board meetings does not matter. Where is the actual decision making taking place? Who has the de facto control? By reason of fact, who has the control? Not by reason of law. All that I need to check. And you can do all meetings via technology now. That's not the problem. Where is the ultimate decision happening? That I need to check. Then resolutions can happen via board meeting resolution. It can happen also via circular resolution, where the resolutions are given to everybody and you will just pass the final resolution and close it without discussion. Where is that final resolution happening? India, outside India? Who's the decision making authority? Everything I need to check. Now this is where OM is outside India. So that is about it. So we'll take a quick just 5-minute break and we'll do the other area. Now we'll get into the foreign taxation part. Residential status done. Everything I've covered, which is enough for you. Then we'll do the taxation part a bit, last leg and close. Right. 5 minutes. Cool. Let's try, guys, till it goes. So next part of the story is section 9 onwards, which is there in the material. That is what is deemed to occur or arise in India. 911, 912, 913, all these things. Yeah. UPS sound is also like our heartbeat in the exam. Yeah. Yes. Interest, royalty, FTS income accrued in India. Then FTS is what? Fee for technical services. Tax rates and TDS sections, deduction under PGBP. I think now it came. Yeah, deduction under PGBP. Then chapter 6A, whether loss is carried forward. What about return on income? What about MAT? Everything we'll discuss one by one. So first of all, whatever is accrued in India, 915A. So for example, USA is the lender. USA is the lender. It is lending to whom? Government of India. Government of India. Government of India is paying interest, the interest to USA lender. Will TDS be deducted? Is the question we need to understand. But is it accrued in India for USA lender? Yes. So that is all this 915. Interest payable by government, resident or non-resident is accrued or deemed to accrue or arise in India. So definitely for a US lender, if government of India is giving interest, that is definitely what? Accrued in India. 915A. So we are understanding in this interest, royalty and FTS, what is accrued in India, what are the tax rates, what is the deduction, all these things, one by one. The USA lender, government of India is the borrower, they are paying interest. Will the section apply? Yes. Next you see, 915B. Lender is in USA, is giving a loan to Infosys. Infosys is the resident. Resident is paying interest to lender. For the lender, is it accrued in India or what? I am not talking about the rates now, that is next part. I am just talking about only if it's accrued in India only it is taxable, no? Otherwise not taxable. For non-resident, when we saw the chart, if you remember when we saw the chart of non-resident, here this one, accrued, received outside India, that's fine, but here for the non-resident part, these two, income received or deemed to be received in India, income accrued or arising in India or deemed to accrue or arise in India. So if I have a property in India and getting money, that's a different story. But what about this rent, etc.? Sorry, the interest. When I am giving a loan, I never have come to India, I am giving a loan to India and you are giving me interest. Is it accrued in India? Yes. That is why it is deemed to accrue or arise in India, because you are investing in India. So I need to see now, guys, whether it is accrued in India or not. If the loan was used in UK for business or profession or for other purpose, that is investment. So what did I do? USA lender gave a loan to Infosys. I need to see what use Infosys did with that loan. If they used it in India, that's a different issue. What if they used it in UK? They took a loan from USA, used the money for a project in UK. Is it taxable for USA, the interest that they receive? These are the questions they can ask in, deemed to occur or arise in India. Basically, if the loan was used for business or profession or for other purposes, that is investment, then it is not accrued in India, it is not taxable. It is not accrued in India, not taxable. If the loan was used in India, then it is accrued in India and taxable. Right? So 915B overall, lender is USA. He is giving a loan to Infosys. Infosys is paying interest. Is it accrued in India? It all depends on where the loan was used. This is 915B. If the loan was used in India, it's accrued in India. If the loan was used in UK, either for business profession or for investment, it is not accrued in India, not taxable. Just because an Indian company received the loan but used it somewhere else, the interest portion is not accrued to USA, guys. Have we done this? Simple. So, before that we discussed 91A, 915A. 915A, government directly paying to US lender. Where they use, I don't care. Government paying, definitely accrued, deemed to occur as in India. But this not deemed to occur as in India if it is used outside India. What is the final thing I should see? Use. If it is used in India, different. Used outside India, different. Yes. 915C. UK lender has given a loan to USA borrower. USA borrower is paying interest to UK lender. Between USA and UK, is there anything taxed in India? No. So, interest portion number 1, I don't care, 50 crore. But now, the USA borrower gives the money to, that's the question, guys. What have I used that money for? If the borrower has used in India, it's the deadly part. See, if UK lender gives loan to USA, USA pays interest and that money is not ever pumped in India, I don't care. Why will I tax at 50 crore? But when will it be deemed to accrue or arise in India for the UK lender? Is what did the USA borrower do with it? If he invested in India for either business or profession, then that is deemed to accrue or arise in India. And who has to pay tax? The interest, that money for the UK lender is deemed to accrue or arise in India. Because the final use of the asset, it's called the final rule. The final usage came where? In India. So, business or profession deemed to accrue or arise in India. Other purpose, it is not business or profession, hence it is not deemed to accrue or arise in India. So, this example is different from this example. This example, Indian company is borrowing. If Indian company is borrowing, it should be used in India. If Indian company is borrowing, if it is used outside India, not accrued. Indian company is borrowing from foreigner, and Indian company is using in India, accrued in India for the foreigner. Indian company is not using it in India, using it abroad, not deemed or accrued in India. Foreign company is lending to one more foreign company, but the borrower is using it in India. The borrower is using it in India for business or profession. Borrower is using it in India for business or profession. So, what's the answer? It is deemed to accrue or arise in India. Other purpose, not deemed to accrue or arise in India. Government is borrowing, paying interest. Answer, deemed to accrue or arise in India directly, no problem. Next. The A and B portion. This A and this B. A was what? government. B, Infosys borrowing. It's the same for software or know-how. 916 P for here, 916 and 7. Royalty and FTS. Royalty and FTS. It's the same, no change. But see this point, one extra point, guys. One extra point. What's the extra point? Non-resident, let's say in Portugal. Portugal guy is buying software from Apple Incorporated USA and paying royalty. Now, whether this royalty is deemed to accrue or arise in India for Apple is what we need to see. If they use it in Portugal, then India is nowhere concerned, nowhere bothered. But if that royalty, if that software is being used in India, that Portugal guys have one more branch in India and they're using that software in India for the business or profession. For the business or profession. Or even for other purpose, then it is deemed to accrue or arise in India. What is the other purpose here? If you see other purpose for not, is not for business, then it is not deemed to accrue or arise in India when it came to interest. I told you, UK lender lending money to USA borrower using it in India for business deemed to accrue or arise in India. Other purpose, not business. But here there is a slight change for royalty FTS point. Even if I am using it for other purposes, it is what? Deemed to accrue or arise in India. So, royalty FTS, government is paying royalty to foreigner, deemed to accrue or arise in India. Infosys is paying royalty or FTS, but Infosys is using that in India, deemed to accrue or arise in India. I told you that A and B, same point, no change, same as interest. Only C slightly different. Here C was a borrower outside India, lender outside India, used in India. Here also borrower outside India, lender outside India, but used in India. Use the software in India. Business or profession, other purpose. Business or profession, other purpose. Other purpose is different than the interest point. It is deemed to accrue or arise in India. This is how the rule is framed, guys. We need to remember this and go, no choice. That's why I'm trying to make it little easy. First one, again I repeat, Government of India, interest, royalty, FTS, same. Infosys taking a loan from outside India or paying royalty FTS outside India, but using everything in India is accrued in India. Using everything outside India is not accrued in India. Third one, borrower outside India, lender outside India. But for the lender, is the income deemed to accrue or arise in India depends on where the money is used or where the software is used. If the money is used in India for business, deemed to accrue or arise in India. Other than business, not deemed to accrue or arise in India. But for royalty FTS, different point. If it is used, I'm using the software in India for business or profession or even for other purpose, it is deemed to accrue or arise in India. On these minute points only, they play around a lot. This is regarding royalty, FTS and interest. General rule, universal rule in taxing PGBP. Non-resident, if I want to tax a non-resident, first of all, he should either have a business connection in India or he should have a permanent establishment in India. Either business connection or permanent establishment. But the beauty is, exception to that rule is interest, royalty, FTS. That's why I did that first. If loan is coming from outside India, I have not even entered India, still it is taxable if it's used in India. Think about it. Why? Because permanent establishment rule is not there. So you are asking me P should be there, P should be not there. P need not be there for interest, royalty, FTS. So anybody who has never visited India also, income will be chargeable under 915 and all those things. If P need not be there, it should be either interest, royalty, FTS. So general rule of taxation, non-resident giving to India depends on the permanent establishment or business connection 911. Exception, interest, royalty, FTS 91567. For 91567, no PE needed, no business connection needed. This was inserted in Finance Act 2010 with retrospective effect from 1976. An explanation in section 9. Interest, royalty, FTS, fee for technical services. So royalty also, software, fee for technical, everything. No PE is needed, no business connection needed at all. Directly you can enter into any deal. So no need to have a PE or business connection for what? Interest, royalty, FTS. No need to render any service in India also. Only that the money should be utilized in India, software should be utilized in India, technical service to be utilized in India. That's the deadliest point. So should not get ever confused. Interest, royalty, FTS, I don't care about PE concept. But if it's goods, selling goods, then PE will come. So we were talking only about the taxability. Now I need to talk about the tax rates. For interest, there are 4 types of interests are there. Tax rate is given under 115A. For interest, tax rates are given in 115A. It is from 110 to 115 BBJ, chapter 12, other tax rates. We'll have to see different types of interests. Interest number 1, guys. Check it out. Borrower. First of all, what? Non-resident or foreign company is the lender. Non-resident or foreign company is a lender. So when I give you those videos, first 2-3 classes will be little tricky. In the sense, you'll be wondering what is this fellow telling. I'm telling you now only. That's what you're going to think. But afterwards, you'll understand everything. So just hang in there for a couple of classes, because this is a different concept altogether, non-resident taxation. So you need to understand. After that, when I discuss the Vodafone case in depth, you will understand where I am getting at. Then it will become smooth. So first, anyway, I am giving you the basics here. So you will be able to manage, honestly speaking. But going forward, 1 or 2 classes you get difficulty, just stick it out, then it will become easy. Non-resident or foreign company is giving loan to an Indian company in foreign currency. Is it deemed to occur as in India? We already discussed, yes. 915A says yes. Government taking the loan, yes. Infosys taking the loan, yes. But Infosys should use where? In India. So all that, I am not even talking about the taxability. I am assuming in all these cases tax is applicable. So when I say borrower is government or Indian concern, it means what? 915A, government is taking. Then Indian concern, Infosys is taking. And using it where? In India. I am already assuming they are using in India. That's why I am talking about the tax rate. If Infosys is using outside India, not taxable. So here, In interest number 1, I'm assuming that Infosys is using it where? In India. So non-resident or foreign company, I'm borrowing money, loan and foreign currency. In foreign currency, mind you. Borrower is in India, or it can be an Indian concern. Borrower is the government or Indian concern. Now the government or Indian concern is giving interest to the non-resident or the foreign company lender. TDS rate, guys, is 20% as per 115A. Tax rate. TDS also will be the same. I'm going to match the rate. TDS also will be 20%. So TDS under section 195, 20%. Tax rate, 20%. This is section 115A. Got it, guys? Very simple. Here I am assuming that taxability is already occurring. When will taxability occur? Government anyway in all cases occurs. Indian concern, money is used in India. Interest number 2. Lender is a non-resident or a foreign company. Borrower is in India. Loan here, mind you, can be any currency. Loan can be any currency. But the borrower is running an infrastructure debt fund, which is exempt under 1047. That's why it's a special case. That income the borrower is exempt under 1047 because running an infrastructure debt fund. But still the borrower is in India, now is paying interest to whom? Non-resident or foreign company. Tax at a reduced rate of 5%. TDS also same rate under 194 LB 5%. Some TDS sections I didn't do because it's covered here. 194 LB. I want more and more companies from outside India to invest in my country because I can invest it in infrastructure. I can invest in infrastructure. Right? Lender, non-resident or foreign company. Loan in any currency. Borrower, India. Right? Do the Indian way. Bang it 2 times. Yeah. Yes, that will work. Still not working. Still old. Yes. Borrower, India. Infrastructure debt fund. Yes, it works. Infrastructure debt fund exempt under section 1047. Interest paid. Now, foreigners and all, when they come, they can't even believe that we do all these things. Right? So the TV remote or any remote will have layers of plastic cover first, correct? Which were used in the prehistoric era, that plastic cover which our mom would have put. Yeah, but inside when you see brand new. But when relatives come, we'll only show the plastic cover, will throw it off. And important relatives come just to show that we have new stuff. Right? That is a classic middle class mindset. And when we eat food and all, when we are eating normally, it's that Sona Masuri rice, small rice. When relatives come, basmati rice, right? If you remember. On our birthday also, basmati rice is not cooked. It's a little slightly better version of Sona Masuri rice it will be, but never basmati. So imagine how you will feel when we are seeing a relative belting curd rice, basmati rice that too, right? So it's painful. But that's our conditioning, middle class mindset. So loan, any currency. Borrower, India. Infrastructure debt fund. So if I pay the interest, then what is it? 115A, 5%. Because as I told you, logic here is I want more and more companies to invest where I'll put it in the infrastructure debt fund, and that money anyway will be used in infrastructure companies. So it's indirectly outsiders are funding me. So for which the tax that I'm going to deduct from them for them is less, 5%. Here I'm using it for any purpose and I'm taking it in foreign currency, hence 20%. And I have to repay also in foreign currency, which means my pure forex reserves are going out. So I don't want to give them the benefit, hence 20%. There's a logic for everything. Here it's any currency, but it ultimately used for what? Infrastructure, hence 5%. There's a logic for why less rate, but why 5%? That depends on what they decide. Why not 7%? Nirmala madam likes 5, the number 5 maybe, yes. So whatever. Third one. So there are different types of interest. First is normal borrowing, foreign currency. So repayment also, pure forex reserves are going out, hence higher tax rate. Second case, any currency, I don't care, but what is the ultimate use? Infrastructure, hence 5%. You can remember like that. Third one, interesting guys, lender is not a company. Lender is a simple non-resident. In this case, lender can be company. In this case, lender can be company. In interest number 3, lender is not a company. He is investing in an Indian company or is lending the money to an Indian company and is either giving loans or investing in long-term bonds, guys. Long-term bonds. Loans or long-term bonds. In what currency? Foreign currency. Loans and long-term bonds in foreign currency. Now this is important because there is a time limit for the borrowing. Borrowing should be only between 1/7/2012 to 36/23, which is well within your financial year that they ask. And it should be approved by the central government. Tax at a concessional rate of 5% and TDS also 5%. This you can copy down. This can come in our exam. Because the borrowing time is 1/7/2012 to 36/23. After that, borrowing and all will not be covered under this section. This will go for the normal section then, 20%. So done. Tax will be 115A 5%. TDS 5% under 194 LC. One more. Non-resident, not a company, is investing in rupee denominated bond in any currency of an Indian company. Time limit for borrowing investing till 30th June 2023. Tax is 5%, TDS is 5%, but if rupee denominated bond was issued between 17 September 2018 to 31st March 2019, so 6 months, then interest income is fully exempt under 10(4)(c). It was launched on Prime Minister's birthday, actually, 17 September 2018 to 31st March 2019. So this is also one more part you can write down. This also they can ask in our attempt, because The time limit for borrowing investment is only till 36/2023. Then, are we done? So, if the RDB is issued between 17 September 2018 to 31/3/2019, then interest income is exempt under 10(4)(c). Next, guys, non-resident or foreign company is buying long-term bonds or rupee-denominated bonds in a IFSC, recognized stock exchange. Again, these dates you have to remember, which is important for our exam. 1/4/2020 to 36/2023. If you are bought, then it is 4%. On or after 1/7/2023, as per Finance Act 23, tax is 9%. And in any of these part 1, part 2, part 3 that you have written down, interest rate should not exceed rate approved by central government. So these 3 questions they can ask, because it's all in the November 24 will probably be the end of it. Non-resident or foreign company investing long-term bonds or rupee-denominated bonds, the IFSC, 1/4/2020 to 36/2023, tax 4%. Fourth part. Again, guys, it is important. I'll explain, then you can copy. Lender is a foreign institutional investor or a qualified foreign investor approved by SEBI. They are investing in government securities of the government or rupee denominated bonds of an Indian company. This is interesting. The time limit of interest, see, in all the other cases, guys, what did I say? Borrowing should be within 36/23. Borrowing should be between 1/7/2012 and 36/23. Here it's not the borrowing, mind you. Interest is payable during 1/6/2013 to 36/2023, not the borrowing. Borrowing need not be during this period. Tax 5%, TDS 5%, 194 LD. All these can come in the exam. Again, for this, it is what I repeat, it is not the borrowing, it is the interest. Time limit is at 1/6/2013 to 36/2023. Interest payable during the period, borrowing need not be during the period. Tax rate 5%, TDS 194 LD. So they may confuse you by telling borrowing was not during this period. I don't care. It's the interest paid. For all the interest paid during this period, 5%. Next, again, foreign institutional investor or qualified foreign investor is investing in municipal debt securities. Interest payable 1/4/2020 to 36/2023. Here slightly different in the time limit. Only municipal debt securities. Tax is again 5%. Rate of interest should not exceed government approved rate. So for municipal debt securities, date is slightly different. Everything ends on 30th June 23 only, but here it is 1/4/2020 because the concept of municipal debt securities was released only in 2020. Unfortunately, these dates you have to remember only for these 4-5 cases. First June 2013. 23, yes. Interest payable, not borrowing. Then there's a general exemption, guys, which is a deadly exemption. Any non-resident or a foreign company giving loan to a unit situated in IFSC, right? Non-resident or foreign company giving loan to a unit situated in IFSC that where interest is fully exempt under 1015. So absolutely no problem. That's why they want more and more people to pump in money into IFSC because for them interest is completely exempt under 1015. That's why more and more people are actually investing in International Financial Services Center. What are the deductions in PGBP? Interest or dividend income. PGBP or IFOS deductions. So will I get any deductions in the interest or dividend income? No. And section 57 deduction will I get? No. Unabsorbed depreciation, will I get any deduction? No, because it comes under 32. So will I get any deduction while I am calculating my income? No. Chapter 6A deduction also I will not get for non-resident. Why? Only 80 LA will come. Brought forward losses, set off, yeah. Section 70 to 80, it is possible. So I am getting interest or dividend income under these sections. I will not be able to give any expenses under 28 to 44 as such. And even in IFOS 67 also 57 also says that interest you cannot take anything, right? You cannot take any deduction as such. Now, all these lenders, all non-resident lenders, should they file return of income in India? Because I told you interest for interest, PE is not needed only. If PE is needed, that fellow will file anyway. But if PE is not needed, should you file return of income? No return of income if only interest and dividend income you have. And most importantly, TDS is already deducted at the rate mentioned in 115A, deadly. So if the TDS has, that is why TDS rate is equal to tax rate. TDS rate is equal to tax rate. I have already deducted TDS. Should I get extra dividend interest income? Should I file the return of income? No. I need not file any return of income because I have already taken all this into account. Only interest and dividend income if I am earning, and TDS is already deducted at the rate mentioned in 115A, then nothing will come here. One example, non-resident or foreign company in USA providing services to India. India is paying royalty, any company in India is paying royalty or fee for technical services along with an agreement, everything is approved. Tax rate is 115A is 10%. DTAA rates is there. What should I follow? Always DTA will override the tax rates or tax rates will override DTA? DTA will override the tax rates. So it is tax rates or DTA rates, whichever is less. Now, if DTA rate is 20%, then I will pay 10% and should I deduct tax? File return of income? No. What if the DTA rate is 5%? Tell me, DTA rate is 5%, 115A rate is 10%. I will pay what percentage? I will obviously pay 5%. Should I file return of income? Should I file return of income? What do you think, guys? Should I file return of income? Yes. Why? Because I have not adopted rate as per 115A. What is the exemption here? It should be only interest or dividend income and TDS is deducted at the rate mentioned in 115A. What is 115A rate? 10%. Have I paid as per 115A? No. So, should I deduct TDS? Should I file the return of income? Yes. TDS deducted at DTA rate, return of income to be filed. TDS deducted at income tax rates, no return of income to be filed. And one point is there, this they may ask in the current context. There is a company called National Technical Research Organization, NTRO, which is part of your RAW, Research and Analysis Wing of India. So if they utilize any services from non-resident, then whatever money they pay, no TDS. You would have seen the bromance between Modi and Benjamin Netanyahu, who is what? Israel Prime Minister. So it is actually bromance only. Because when that guy was about to stand for the election, all these big high-rise buildings, full entire thing, he got Modi and Netanyahu's, banner done. So they respect India a lot, and Indians are taking a lot of, with respect to their military and tactical warfare, strategic warfare, lot of help from Israel. That's why if you see in the Palestine war issue, India is either silent or tilting towards one party. That's because there is a lot of things, even during the Pulwama attack and all those things, a lot of surveillance, a lot of drone technology was all flown in from Israel. Israel has better strategic warfare than India, think about it. So we import. There is mutual, sharing of information. So when the NTRO, National Technical Research Organization, is paying money to Israel for this, which is actually happening, there is no tax. There is no tax, no TDS. That's a special provision, because you cannot think, okay, it's a royalty, technical service, yeah, tax will come, right? It will not come. Now, non-resident transfers certain rights. So we talked about till now interest. We spoke about tax rates of those interest. Now a little bit we'll talk about the royalty and fee for technical services. Royalty also, where will it come, guys? If I transfer the rights to use certain things, whether it's a lump sum or for a limited period. If it's a outright sale, it's different. So if J.K. Rowling allows you to use the Harry Potter brand in India, there's a Harry Potter experience store, whatever it is. So then in that case, what? Obviously, is she giving it for like permanently or only for a limited period allowed to use? Limited period, 2 years, 3 years, based on the agreement. So everywhere, that's how it is. If it's an outright sale, then the non-resident would pay capital gain since it's a capital asset, and it will not come and it will never be called as royalty. So J.K. Rowling sold the rights of the book to Penguin and only to right to print the book, and rights of making the movie to whatever, Warner Brothers or whatever, that's it. And wherever you go, if there's any Harry Potter studio, whatever, she has the rights. She'll get every rupee that you spend on the ticket, she'll get a small percentage of it. So for a limited period, it's called royalty. 2 years, 3 years, it can be renewed. But if it's outright sale, then it will not come in. So you should see whether it's outright sale, everything cannot be royalty. Right to use outright sale, different from limited period. And that royalty now will be part of that royalty which we were discussing. Now this we already discussed, if you remember. I am buying units of a real estate investment trust, for which you are getting money. Interest I am giving you. What all income, guys? If you remember in REIT, interest income, rental income, dividend income, repayment of loan. In that repayment of loan you leave, rental income you leave. Other two, interest income, dividend income. So it will come under 194 LC, 194 LBA, 5%. If I am giving it to foreigner. So if you see, interest income was 12 crore, other income was 24 crore. So if you see, 1/3 is interest income, 2/3 is other income. So for both other income and interest income, for especially 677 is your interest income, for which 194 LC and LBA will come at 5% for non-residents. What is the rate for residents? You can check the notes. REIT, rates for residents. Check your business trust. How much? Here. LBA, 10%. For non-resident here, 10%. And here 5%. Interest income, see, 5%. That time we had seen, no, 5%. That 5% only is this. 194 LC / LBA, 5%. Other residents, 10%. Little bit of royalty FTS still. This I have already discussed in PGVP. Microsoft USA sells the right of a computer software in India. Let's say to Dell. And Dell is transferring royalty. Is that asset or is it royalty? Is it asset on which depreciation is claimed, or is it royalty expense? Is it asset or expense? Expense. We had seen it as an expense. So in rule number 5 of these international taxation rules, block of asset, computer includes computer software, that point was removed. Computer includes computer software. Act overrides because see, rule number 5 says computer includes computer software. The act only they changed it. They removed royalty from computer software in the section 9. Section 9 was amended where they removed it. So what will you use? Act will override the rule, or rule will override the act? Act will override the rule. Guys, if I buy the software, I am the end user. Like I am a normal individual, I am buying in this thing, what do you say, Windows software. Should I pay royalty, or that is my asset? Asset. So end user and all, it's not royalty. And if I buy the software for reselling or distribution, then that is also not royalty. It's just that Dell uses it in their system and then takes out other things, only that will be called as software. Come again, sorry, Microsoft? Yes, that's royalty. Because I'll sell it to the end user. For him, it is not royalty. I have to pay to this thing, no, Microsoft. But if I purchase the entire software as a subscription, then that is I am only the end user. I want to install in my systems. Dell comes with the system, right, with the software. So if I install a proper license in each computer and then give, I am also the end user, you are also the end user. So that it's not royalty. It comes where I'll use it for 5 years, 6 years, etc. That's what. So if there is a Harry Potter theme park somewhere in India, if they release, if they open, then they'll have to take the rights from J.K. Rowling for 5 years, 10 years, whatever. That would be royalty. So that company which is running the show cannot pay that money, whichever they are paying to J.K. Rowling, and they cannot show it as an asset and cannot show it as depreciation. That should be expensed off. Right? That's what I'm trying to tell. End user concept is what we need to see. Next. Now ICICI Bank, for credit card and other services, OTP services, etc., they were using a foreign server. Foreign server. Services are what, guys? Foreign server. OTP is being launched, and my server is only outside India. Jeff Bezos is Jeff Bezos not because he delivers items to your house in one day. He doesn't even care about the delivery system. Jeff Bezos is the richest man in the world because of AWS. That is their server. Top companies in the world use that server. So now when I am using that server, I'm using a foreign company server and I'm paying you every month some amount as royalty. Will TDS come or not? Supreme Court judgment said OTP or any service is not deemed to accrue or arise in India. To nullify that, explanation 5 was added. So now definitely any usage of foreign servers, very much tax will come. It is deemed to accrue or arise in India. So we saw the interest portion and the royalty portion now is what we need to see. Royalty or FTS. Paid to non-resident is deemed to accrue or arise in India. Royalty or FTS is paid to non-resident is deemed to accrue or arise in India. By government, then it is taxable for sure. By a resident for business or profession in India, taxable. For earning income in India, taxable. And basically everything is paid to non-resident. Paid to non-resident by a non-resident for business or profession in India, taxable. Earning income in India, taxable. Ultimately for royalty or FTS, something should be there in India. For personal use, not deemed to accrue or arise in India. Royalty or FTS, PGBP and IFOS, again this 28 to 44 DA will not come, unabsorbed depreciation will not come. Chapter 6A deduction is available. Guys, if you see, this is the difference compared to interest or dividend. In interest or dividend, chapter 6A deduction was not available. Here it is available. But actually guys, if you see ATC to ATG, everything is for resident anyway. Simply they have given this. Correct? But three things are allowed. What? ATG, GGB, BJP, GGC, Congress. Foreign company, kindly donate, take deduction. No problem. But, yeah, old regime again. But GGB, GGC, old regime, new regime. New regime you will not get. GGB, GGC. Yeah. Brought forward loss set off allowed. No return of income. No return of income. Only income is royalty or FTS. And TDS is deducted at a rate not less than the rate mentioned in 115A. So special rate of tax, guys. Chapter 6A deductions are not allowed in two cases. One, royalty or FTS, but you can only claim ATGGB, GGC and Finance Act 2019. In all these things, there is one ATLA that you find, leave it. Whereas Finance Act 23, one important change in Finance Act 23. Tax rate of royalty was 10%, no tax rate. Now it has become 20%. No, well, TDS normal, but when you are ultimately doing it for non-residents, yes, you should deduct along with everything. So if you see, that's what I'm telling. If I include surcharge and cess, DTAA says 20.2%, 115A says 20%. So what should I choose of the lot? DTA is always all inclusive, but 115 I have to add and deduct, no? So 20.8%. So 20.8% or 20.2%, whichever is less is 20.2 only. I think that's about it, guys. Other things still I cannot start because it will take time. Cool. So other points we will discuss. I mean, I'll send you the. Hi, my dear buddies. How are you doing? So, guys, let's begin. So, in the previous session, session number 74, I guess. Now it's 75 session, 75th session. 74th session, we're talking about GDR. So, as discussed, guys, GDR from one country to another country, or rather, one non-resident to another non-resident. If he sells the GDR, even though the underlying share is in India, capital gain is exempt as per section 47. We had seen that in capital gains that it's exempt. So predominantly when it will come, if what do you say? GDRs in India cannot be sold if it because it's not listed. So unlisted will be sold. So if anything it is sold in India to a resident basically, then of course the provisions of yesterday we were doing 115, right? AC will come into the picture. This one, tax on income on bonds or GDRs, 115 AC. So LTCG generally it will come into the picture. And GDR long term means it's not 12 months because since STT is not paid here, since it is not traded in the stock market, 36 months. 36 months is the criteria. So that is what we were seeing. We saw all these things, capital gains on bonds and GDRs. GDRs are represented by equity shares of a company listed in India transferred by non-resident to another non-resident. Then it is exempt under 47(7)(a). Now, what if these GDRs are converted into shares? What will happen? So GDR is not traded on a stock exchange. If a non-resident wants to sell GDR on an Indian stock exchange, he shall first convert this GDR into shares. So guys, and then later he will sell that. When the GDR is getting converted to shares, obviously that will amount to a capital gain, because what is not capital gain? GDR sold by a non-resident to a non-resident abroad, that is not capital gain. But if I am converting GDR into shares, that will obviously be capital gain. So by making a request to the central government for redemption and then conversion into equity shares. On conversion, capital gain shall be applicable in the hands of the non-resident. Full value of consideration minus FMV on the date on which request for redemption was made is what you should take. And eventually when that shares are sold also, same thing will happen. So cost of acquisition, where the shares of the company are acquired by the non-resident on redemption of GDR, cost of acquisition shall be the price of such shares prevailing in any recognized stock exchange in India on the date on which the request for redemption is sent. Period of holding is from the date of request for redemption. So for example, non-resident Mr. Harry acquired GDR of Indian company A Limited listed on a stock exchange, 3000 GDRs at 1400 on 12/1/2023. Request to the CG for conversion of GDR into shares on 15/7/2023. Shares of A Limited as on 15/7/2023 is 1600 per share. This is the date of the request. So what is the capital gain on conversion here? Full value of consideration. 3000 shares is converting into what rate? This rate, guys. 1600, 48 lakhs. Minus cost of acquisition. What is the cost of acquisition? 3000 into 1400. He acquired it on 12/1/2023. So yes, it will be what? STCG 6 lakh. So it is taxed at the normal rate. GDR is not listed, so taxed at the normal rate. Moreover, when the shares received by Mr. Harry on 25/8/2023, so shares of A Limited on 28/2003 is 1800. So in this 1 month, it has increased by 200 rupees. Tomorrow, when I am selling these shares at 2000 rupees, assume, so 3000 into 2000 with the full value of consideration, cost of acquisition. Cost of acquisition will be what? 3000 into 1600. So it is 48 lakh rupees. 2 lakh rupees will be taxed at 111A, short-term capital gain, at 15%. This is what we need to look at 15%. So if you see, cost of acquisition also will be what, guys? Price of such shares prevailing on any recognized stock exchange on the date in which the request for redemption has been made. Obviously, this date, this amount only I should take, 1600. Very, very simple. Next, where an income by way of dividends on GDR or LTCG on transfer of such GDRs is received by resident employees of an Indian company or its subsidiary engaged in a specified knowledge-based industry or service. So, if it is related to any knowledge-based industry, technical knowledge or legal knowledge, if it is in that particular industry or service, and if I receive GDR by resident employees of which company? Indian company. So, if Infosys KPO is there, knowledge process outsourcing, and their employees receive the GDRs, or the subsidiary also engaged in a specified knowledge. So either Infosys receives or Infosys subsidiary employees receives the GDR. In that case, same again 10%. What is that specified industry? IT software, entertainment service, pharmaceuticals, biotechnology, or any other industry which may be notified. So if Biocon India receives GDR and Indian employees of that company receive, or Biocon subsidiary employees receive that under 115 ACA, it will be charged at 10%. So basically it's the same as AC only, but just one small addition, that is specified knowledge based industry, it will be the same. Anyway, this we will deal it slightly later also, but anyway, this is how it is, 15115 ACA. Next, in tax on income of specified fund or FIIs, here it's there, or correctly here, or FIIs, foreign institutional investors. Income of specified fund or foreign institutional investor. So we'll just talk about FII. I'll come to specified fund in a while. Okay, let me just talk about FII for now. So guys, normally for FII, if there is income on royalty, normally I'm saying, what will come? 115A will come. Then if FII, similar to FII, I told you, overseas foreign organization, OFO, if they buy units, then 115AB. In the previous session we have seen, tax will be on that rate. If it is GDR, then what? 115AC. For all the other things, 115AD. What will be the other things? Dividend income in respect of other securities. That, for example, if they want to buy shares in Reliance, then where will they come? 115AD. Because if you see, royalty is 115A. This OFO is regarding units, mutual fund units and UTI, etc. Then GDR is 115AC. Nobody talks about actual shares. Shares, dividend income from shares, and LTCG from shares, etc., STCG from shares, etc., all that will come under which section? This section. So ideally it was like 10% and all those things. 30% also was there for normal short-term capital gain. So they went and requested the government saying that we will not invest in India because if you are giving short-term as 30%. I'm just telling. Actually in this section 30% is there short-term. See here, 30% on short term. So initially this was how it was framed. You are giving me 30% on short term, but if those shares are listed on the stock exchange and STT etc. is paid, there it is 15%. This benefit also please give me. Normal benefit of 111A also please give me, they told. I said okay, fine, take it. Second part. What about LTCG. LTCG under 112A, what is the rate guys? 10% after 1 lakh exemption. In excess of 1 lakh, right? These fellows who are earning in crores, they wanted that benefit also. I'm not joking. Earlier this benefit was not there for them. Earlier it just said you have to pay 10% on LTCG. Without, obviously whenever I go for 115AD, the normal provisions will not apply. What are the normal provisions for LTCG? 1 lakh rupees. In excess of 1 lakh only you should do. These fellows said, I want that also. Imagine. So guys, for 115AD cases, 2 additional benefits were given. One was, they also brought into the section itself, 111A. Second thing what they did, whatever was allowed for 112A, the benefit of 1 lakh, Same benefit was brought here also. In the previous session, when I was speaking about GDR, I told for GDR that benefit of 1 lakh is not given, but institute gives that benefit, which is wrong. I told you we have to wait for the RTP. That is not there in the Bear Act only. That's why I am telling it is wrong what ICI is doing. But this one, FIIs went and demanded, saying that I want that 1 lakh rupees benefit. So they gave. So under 115 AD, that benefit is there, not 115 AC. For GDR, there is no benefit as such. Or for other sections, there is no benefit as such. Only for 115 AD, same benefit of 112A also is given. Rest is the same. Interest on dividend income or securities, etc. In the other sections, we saw in 115A normally how much it was, guys. 20%, here also 20%, no change. So this section will be the specific section for FIIs or specified fund. What is specified fund? We'll see later. What is specified fund? We'll see later. So check it out. Interest or dividend income in respect of securities other than units of 115AB or 115AC. I already told you 115AB, 115AC, it's taxed there. Rest of the things is taxed here, 115AD. 20% of interest or dividend income in case of FII. I'm not coming to specified fund, I'm only talking about FII. Fair enough. Come here. Income by way of STCG or LTCG arising from transfer of securities covered under this section. These securities are not covered in OFO or GDR. These are actual securities. So shares, if you sell, it will come under 115 AD. Shares sold by non-resident who is a FII, 115 AD. Other than a non-resident, other sections. Other section. That is the normal section is 115 anyway. Yes. So here same guys, 10% on LTCG normally, any other long-term capital gain, 30% on short-term capital gain. But if it is going through the stock market STT, these two provisions were inserted later. Benefit was given later. That is 15% on STCG under 111A, then 10% in excess of 1 lakh LTCG under 112A. 111A and 112A later these were inserted. Very, very simple. Are you getting it, my dear friends? Later it was inserted. Yeah, so 10% LTCG, 30% are already there. Two other things they got it added because they wanted it similar to the what do you say 112A and 111A also. So they got that also. They said nothing doing. You have to give this benefit to us, right? One by one. That is one part of the story, guys. That is what it is called FII. Now, what is specified fund? Let me see if it's there here. So here it's given 1040. Yeah, 6.2. Come to 6.2. I'll also open here in my book 6.2. 6.222. Okay. So if you see section 47, I'll give you the logic of the specified fund. Here. Any transfer of a capital asset being bond or GDR 115 AC, rupee denominated bond of Indian company, derivative, such other securities as notified by the central government is behalf made by one non-resident on a recognized stock exchange in IFSC. And where consideration is paid in foreign currency, we had seen this. This will not be regarded as a transfer, 7AB. But what if I want to deal in shares? If you see here, guys, shares are not there. Such other securities I am notified, shares are not given. So, in order to invest in IFSC also, what will happen is, many non-residents will come together, non-resident gang will come together and will create a fund. Non-resident will come together and they'll create a fund. And they will have a Indian manager, fund manager, and this entire fund will be incorporated in a International Financial Services Center. So this fund will issue what? Units to whom? To the non-residents. And then the fund will invest. The fund will invest in various other things, whatever it is. Because if you see, generally in IFSC, individuals cannot invest. So individuals, what they'll do, they'll come through a fund and they start investing. And what it's basically similar to a mutual fund. Whatever they invest, income that they derive, this fund is called as a what? Specified fund. This fund, the income that the fund gets, is exempt under 10(4)(d). And then the fund will then give return to the NRs. This also, my dear friends, is exempt under 1023 FBC. 1023 FBC. Did you understand the logic? Whatever income the fund is earning, that is also exempt under 1040. Then whatever income the fund gives to the non-resident, whatever income the non-resident is earning, that is also exempt under 1023 FBC. These are all the various new amendments that have come to ensure that more and more foreigners will come and invest in our country. So if you see this 6.1 here, you check this. 1040, what are the schemes, what are the things that are exempt here? Check it out. The following incomes of specified fund are exempt. Capital gains on transfer of capital assets referred to in 47(7)(ab). That only I told you now. On a recognized stock exchange located in AFSC and consideration payable in foreign currency. Capital gains on transfer of securities of foreign company other than shares of company resident in India. Dividend and interest of securities of foreign company. Dividend and interest on securities of foreign company. Investment in foreign companies if you do. Debt instrument should not be issued by a PE of foreign company in India. Income from securitization trust chargeable under PGBP. Securitization trust also we had done in direct taxes classes. Yes, that income also here. So if you see, if 95% units are held by non-residents and 5% units are held by sponsors who are residents, I told you this is that manager, then 95% of the income shall be exempt under 10(4)(d). 10(4)(d). 10(23) FBC, you see, the income arising to a shareholder from a specified fund in the form of dividend or interest or by way of short-term capital gain or long-term capital gain from the transfer of units is exempt in the hands of the unit holder. Exempt in the hands of unit holder. You see, specified fund means a fund established or incorporated in India in the form of a trust or a company or a LLP or a body corporate, which has been granted certificate of registration as category 3 AIF. Remember guys, category 1 and 2 I told in DT, and I told you in category 3 when it comes, they also invest in some risky things like money market. It is highly risky but great returns. I told you we will discuss in non-resident taxation. Here we are. Category 3 alternate investment fund and regulated by SEBI, then which is located in any IFSC, of which all the units other than the units held by sponsor or manager are held by non-residents, or investment division of a overseas banking unit, that also offshore banking unit, investment division of a banking unit of a non-resident located in an IFSC. Now even the investment division of a banking unit also can come in the, what do you say, IFSC and start investing. That is also covered here, which is registered as category 1 foreign portfolio investor under SEBI portfolio regulations. It has commenced operations and fulfills all other conditions. This offshore banking unit was inserted in Finance Act 21. So the gist of the story, my dear friends, you see, only capital gains is exempt, and dividend and interest on securities of foreign companies exempt. What about dividend and interest on securities of Indian company? Now those things are the ones which are taxed in 115 AD. 115 AD. So, and if you see, for income arising from specified fund or dividend or way of short-term capital gain as transfer of fund is exempt in the hands of the unit holder. Unit holder, which unit holder? That is the foreign unit holder. Income. What is the exempt income here? Specified fund can only do three things: capital gains, dividend and interest on securities of foreign company, not Indian company. So, as far as specified fund is concerned, for those covered in 10(4)(d), what are these? Capital gains on capital assets, transfer of securities of foreign company, capital assets of recognized stock exchange in IFSC, because shares of company in India is not there, and dividend and interest of securities of foreign company. For these things, if it is held by non-residents exempt under 10(4)(d) for the fund. For the fund, it is exempt under 10(4)(d) and under 10(23)(f)(b)(c), exempt for unit holders. If it is held by residents, if at all it is held by resident, if you see here, of which all the units other than the ones held by sponsor or manager are held by non-residents, very clearly given. So it is held by a resident who is not a sponsor. This will be taxed at normal rates. Now, the specified fund which is not covered in 10(4)(d), this is interesting. Those which are held by non-residents means what? Example, guys, shares in Indian company. Example, investment in securities of Indian company, which is not covered in 10(4)(d). For them, then only what will come? That is the connection 115 AD. And if it is held by residents, then normal rates. Normal rates. Got it? So what is the connection of 115 AD? There are two things now. One is FII, one is specified fund. Specified fund means this one. Specified fund which invests in those items which are not covered in 10(4)(d). Example, securities of Indian company. Held by NR, 115 AD will come. Next, for specified fund, dividend income 115 AD, how much will it be? 10%. General rule, guys, if you remember, it is 20%. But for them, it is 10%. Where is it? See there now. Go back. Here. Page 3.4. There you go. Normally it is 20, but for these fellows, what is it, guys? 10%. So here it makes sense. Check it out now. 10%. Under 115 AD. Interest income. Same. 115 AD. 10%. Both this came in Finance Act 2020. Third one, Transfer of securities in the IFSC, which is governed by 47 7AB. Exempt under 1040. Transfer of shares. (115 AD). Long-term capital gain. Shares. Indian company in stock exchange. LTCG 10%. STCG 111A 15%. In excess of 1 lakh. This benefit is also given. This is for specified fund. Did you get it, guys? For specified fund. Apart from all these income, other things are normal only. These are the things. So coolly I am connecting everything and doing it. So very slowly we are doing. Please concentrate. First we figured out what do you mean by specified fund. I explained. Then in specified fund, there can be two types of exemptions. One is 1040. The other one is not covered in 1040. So if it is not covered in 1040, then if it is held by NR, then 115 AD. The same connection we have given here, 115 AD, these three. Because it's not exempt. The only exempt one is this. The same chart in another perspective is this. Very simple. Lastly, for non-resident unit holders, dividend, then interest income, dividend income, interest income, then what else? Transfer of units of that fund. Whatever you do, exempt under section 1023 FBC. 1023 FBC. Very simple. Got it, guys? Yes or no? Hope you understood. Let me also come back to whatever page we were in. I make notes in my own notes, so that will be easier for me to explain also. So I'll be reading up stuff and then adding, keep on adding. So it will be very easy for me also to understand. So here, come back. Same thing I had written. Done. Now you see, coolly you see again, income of specified fund. Now you know what is specified fund. Or foreign institutional investor. Guys, if I had to just do it like this chart, I could have finished in 5 minutes. This is not a fast track batch at all. You also know that. I think by now you would have understood. There is no thing called fast track, nothing called regular. Everything is the same. It's simply one marketing gimmick in the market that people do, including me. But others, the problem is, they will actually go ahead and do fast track only. But for me, I don't know the difference only. I'm always a regular guy. I will, Okay, little extra sums in regular, all that is there, but the content will remain, the conceptual clarity will remain the same. But of course, in regular, we'll understand more of the Bare Act, we'll try to go more in depth, that is all extra. But for your examination, whether you buy fast track premium, regular, depending on the time, depending on the level of knowledge you need, you can go ahead. But whatever you buy, you will never feel the, difference in anything. Though there is a difference, you'll never feel the difference. You'll always feel, yes, I've covered everything. And whatever course you take, I can assure you that you will do well in the exam because I am not leaving anything. You are also seeing everything we are covering in depth. Ultimately, taxation is very easy. Just that it's too much to remember and hodgepodge everywhere. I'm trying to bring everything through charts. The reason why I do not want to give these charts, people are asking me, sir, give those charts also. No, you need to put pen on paper. I'm also writing. No, I'm not showing some already written charts. When you put pen on paper and when you write it, actually, it will be in your brain. And once it's in your brain, sorted. Got it? Cool. So now you see all the easy part you will understand. No deduction under chapter 6A, obviously. No deduction under which one? 28 to 44C in computing income in respect of units. First proviso and second proviso to 48 shall not apply while calculating LTCG, STCG. Set off and carry forward all losses shall be applicable. Same. Unabsorbed depreciation as well as brought forward cannot be set off against income. We know that. Foreign institutional investor means investor as CG may notify. Specified fund means same as 1040, which I have already seen in 6.1, 6.2 paper in the question. In case of specified fund, the provisions of this section shall only apply to the extent of income attributable to units held by non-resident. I told you. For Indian fellows, normal tax rates will apply. Ninth point. Nirmala auntie, no? Nirmala auntie did something in 2019. What she did? In 2019, Nirmala auntie for individuals hiked up the surcharge. In 2023, Nirmala auntie again reduced the highest surcharge of 37, made it 25%. It's a different story. But there was no scene of surcharge and all before so much. They made 10%, 15%, 25%, 37% and all she made. After she did that, market collapsed in 2019. If you observe 2 days after, 1 day after the, budget, the entire market collapsed. Why? Why did the market collapse? Because guys, these foreign investors, as an institutional investor, it will be a company. But other foreign investors, what are these foreign investors ultimately? These almost 90 to 95% of these foreign investors are through funds. I told you, specified funds, through that only. They are generally in the form of AOP or BOI. I told you some 100 people come together and they'll create a fund, they'll be in AOP, BOI. If you remember AOP, BOI taxation, they are taxed at MMR, maximum marginal rate. And because Nirmala auntie increased the surcharge, MMR also increased to one of the highest. That's why in 2023 budget also they reduced it. I'm just saying, you should have an overall picture, right? For our examination, it is all same only, 25%, 37%, all that is there. I'm just giving you an overall picture. I want more and more people to invest. That's why I'm reducing the rates. Anyway, in 2019, when she inserted the surcharge, 90% of the FII, 10% of the FIIs were companies, but 90% of the FIIs were AOP, BOI, their tax rate increased. Here, I'm only talking about the tax rate. I'm not talking about the surcharge. Surcharge increasing will obviously increase the tax rate. Hence, I already told you in day 1, if there is any dividend income or if there is capital gain, what will be the surcharge maximum? 15%. Do you remember? First class. Sir, what you told God only knows. When you told mother promise, I don't remember. Nonsense fellows. First class, da, first class. When we are doing the tax rate, etc., in the first class only, we had discussed that if there is dividend income or capital gain income, surcharge will be maximum how much? 15%. You have only written in your own handwriting. See, everyone was coming under this. If you are going through, I mean, if you are not a non-resident, but either ways also you have to do it, no? So, yes. This one, see, dividend income, dividend and income under 112, 11A, 112A, maximum surcharge was made 15%. Since it was amended there also, second amendment Nirmala aunty brought was under this section 115 AD. That is point number 9. Nirmala auntie's amendment. Point number 9. Where FII is not a foreign company. For foreign company, no tension. I am telling you this for other than foreign company, which is chargeable as AOP BOI. But it is a foreign fund. I told you FII generally is based on foreign funds only. It's not a specified fund, but it's a foreign fund. Then on such fund, tax rates applicable to individual will be applicable. Surcharge shall not exceed 15%. Then they cool down. Oh, okay, no problem. So what is the relevant TDS section for this, guys? Relevant TDS section. Here 196D. TDS on interest or dividend under 115 AD shall be deducted 20% or 10%. 20% if it is FII, 10% if it is specified fund. No deduction shall be made in respect of income which is exempt under 104D. MCQ question they had asked once. ICI MCQ, I'm not joking. TDS on LTCG in which section it is not applicable? For FII, first one, 115 AB. The section is 196B. Second one, 115 AC. Section is 196C. Third one, 115 AD. This is 196D. Fourth one, none of these. Long-term capital gain. So if you see, my dear friends, you see, (196B) you see, 196C you see, 196D also you see. Long-term capital gains, yes, taxability is there. 196C you see. Long-term capital gains, yes, taxability is there. But my dear friends, in 196D, any income by way of interest, payable to specified fund, that's it. Interest or dividend income is there. long-term capital gain is not there. So no TDS on long-term capital gain. Important MCQ. See how they are asking. No TDS. No TDS for FII. What is the reason? It is FII. No stockbroker is involved. So broker generally will deduct TDS. Here no broker is involved and shares are sold on a regular basis. So no TDS. Second, will TDS on LTCG apply to specified fund also? Because if you see, it's missing here in 196D. So even for them, it is no. Not for FII also, not for specified fund also. It's not rectified only. So you see, no deduction shall be made on capital gains arising on transfer of securities under section 115 AD. Payable to whom? FIIs or even other people. Done. So this is what it is, guys. If you see the previous year's papers and all that, you see the FII investment details in our country, how many people invest and in crores. See in 22-23, they pulled out little because of COVID, etc. They initially gave 2,67,099 crores, but there was a lot of pulling out in 21-22. Anyway, overall, from the inception, from 98-99, before that, till that time only less only. After FEMA came, 99, after that you see. Overall, till now, they have invested 13,48,512 crores in our country. That is the sector, investment sector. You see this question, I think November 18 or something, and downloaded online. 10 marks. SOL Incorporated notified foreign institutional investor derived following incomes from various sources for the financial year 17-18. Income in respect of securities 28,50,000. Expenses incurred in respect thereof 50,000. The above income includes an interest of 16 lakh received from an Indian company on the investment of rupee denomination bonds and dividend income of 3,50,000 from a domestic company referred to in 1150. So if you see this 16 lakhs Indian company rupee denominated bonds, it will be 194 LB. So it will directly come under 5% taxation if you remember. 3,50,000 dividend income separate, it will be investment income 115. Capital gain sale proceeds on sale of securities on 52 lakh 15/1 2018 and purchase cost. So it's long term 4 years. So 52 minus 28 is what, 24 lakhs. This will go at what, 10%. 10%. Short term sale proceeds of equity shares 13,50,000. Cost of acquisition. So this, since it's short term and it is equity shares, assuming it is sold in the stock market, 111A, 15%. Then you see sale proceeds of equity shares of company B, cost of acquisition. STT is not paid. Since STT is not paid, my dear friends, under this section here, it will come under 30%. 30%. 30%. Right? So that's how it is. So dividend income is 3,50,000. So first of all, on that 16 lakh, what percentage? 5%. 5%. And no other deductions will be allowed. Very simple. This is RDB. But if it was during that period from Modi's birthday, then it is exempt. That is not given. That's fine. Then the balance investment, 28 lakh minus 16 lakh. 20 lakh 50 minus 16 lakh. Balance investment on that 20%. This one, 20%. This will come 20%. Then long-term capital gains. How much? 25 lakh was there, no? 52 minus 28 is 24 lakh. 24 lakh into 10%. But if you take it as LTCG, which has gone through STT split, it's not going to. If you assume that, then in excess of 1 lakh rupees. So 23 lakh may you have to write the assumption there. Then this remaining amount 8 lakh. 13 lakh 50 minus 5 lakh 50 is 8 lakh. So for that, how much? 15%. Then 9 lakh 25 minus 4 lakh 85. For that 4 lakh 40,000 again, short term at 30%. See, 10 marks in your pocket. Like that, they are asking questions. So guys, come to 3.1. 3.1. So section 115C. Before we go here, let us just kind of, write down the general law we have for these sections. The general law applicable to non-residents under 115A, 112, 112A, whatever it is. If a non-resident purchases the following in foreign currency, and sells them after they become long term. First one, equity shares of Indian company. Second, debentures of public Indian company. Third, deposits of public Indian company. Fourth one, securities of central government. Now tell me, the first proviso to section 48, which talks about the TTBR and all those things, TTSR, TTBR, average, your foreign exchange benefit, fluctuation benefit, will you get? No. If you sell debentures of public Indian company, will you get? No. We had seen it will not be, will, sorry, my bad. Generally it is not there, but here, if you are just selling, a non-resident is selling, without going into those special cases, generally will you get first proviso? I am talking about normal cases. See, I wrote no because you will not get in those special cases. Your 115, all these ACA, AC and all that. That I am not talking. I am talking about these things. Will you get first proviso benefit? Yes. Here will you get first proviso benefit? Yes. Deposits of public Indian company. Deposits of public Indian company. It has got nothing to do with, it's not, you'll just deposit it and you'll get the money back along with the interest. Is it a capital gain as such? No, there is no capital gain. There is no capital gain. What about securities of a central government company? Securities of central government company? No, no. Securities of central government company? No, no. Obviously, second proviso also will not get. Coming to this, second proviso and first proviso both, if I have a long-term capital gain, this I will name it as 1. General law, guys, general law. This I will name it as 2. If I have a long-term capital gain, listed and sold on stock exchange. Second, listed and sold off market. Third, unlisted shares. If it is listed and sold on the stock exchange, first proviso not applicable. Why? Because it's long-term capital gain. Second proviso not applicable. Right? And what is the tax rate? 10% in excess of 1 lakh rupees. Long-term capital. It is listed and sold off market. First proviso will apply. Second proviso. What is second proviso? Indexation. Not apply. %. Same. I'm just revising. Unlisted shares. First proviso will not apply. Second proviso will not apply. Is also 10%. This is what we have been seeing now. Listed company and sold on stock exchange, off market also 10%, unlisted shares 10%. We've been seeing all this. And obviously 2.5 lakh basic exemption limit will not be there. Chapter 6A deductions will not be there. All that we've been seeing. We just saw it. Third point. If it is interest and dividend, then 115A will come. Tax rate will be 20%. Expenses at any cost not allowed. Chapter 6A deductions not allowed. These are the normal provisions. Now for NRIs, non-resident Indian, under Chapter 12A, special provisions were granted. This is section 115C to 115I, special provisions. NRI taxation. For them, 2 extra things were there. Two extra things.
This is the normal provisions. Normal provisions. For NRIs, I'll write here. For NRI, first proviso benefit will be given. Second proviso anyway not given. And 1 lakh benefit not given for NRI. These are the special provisions we are going to discuss now. Everything is same to same. 1 plus 2 plus 3. The general law will equate to NRI also with 3 changes. Change number 1, only for this, listed and sold on stock exchanges. For NRI, first proviso benefit will be given. Second proviso anyway not given. 1 lakh benefit not given. So, one is addition, one is subtraction. Fair enough. Plus one deadly thing. Second huge benefit is 115F. If you sell shares and make LTCG, and if you invest within 6 months, the sale proceeds, then the capital gain will be exempt. You remember similar thing we saw in 54 EC, rural electrification bonds and all that. Similar way, only for NRIs, if there is a long-term capital gain, and if you invest it in within 6 months in the similar securities, what will happen? Capital gain will be exempt for you. Capital gain will be exempt. So this is the additional masala for whom? Only NRIs, not non-resident, Indian. For non-resident, again I repeat, what is the general law, my dear friends? Equity shares of Indian company, definitely will get first proviso. Debentures of Indian public company, definitely will get first proviso. Deposit of public Indian company, no capital gains. Securities of central government, there is no first and second proviso also, because for bonds and debentures, there is no indexation. We had seen the third proviso, if you remember. For bonds, there is no indexation benefit. And there is no first proviso also. Very clearly, we had seen that time. LTCG, listed and sold on stock exchange. We just saw all the rates now. 10%, off market 10%, unlisted 10%. Third, interest and dividend tax 20%, expenses not allowed, chapter 6 deductions not allowed. With the same structure, 3 changes. Change number 1 for NRI. First proviso will be applicable, second proviso will not apply. 1 lakh benefit will not be there for NRI. And 115F, long-term capital gain, invest it within 6 months somewhere else, the capital gain will be exempt. These provisions are this one, chapter number 3, non-resident Indian. With this logic and with this background, now if you read, becomes very, very simple. It becomes very, very simple to understand these provisions. Let's read. Non-resident Indian NRI means an individual being a citizen of India or a person of Indian origin. Person of Indian origin if is he or either of his parents or grandparents were born in undivided India, which means Bangladesh, Pakistan also. If your parents or grandparents are born in undivided India, then this also will come into the picture. Person is deemed to be of Indian origin if he or either of his parents or grandparents were born in undivided India. Otherwise, you should be a citizen of India who is not a resident. Citizen of India but who is not a resident. In FEMA, definition of person of Indian origin is different. Even spouse of an Indian citizen will be a person of Indian origin. Here it is very clear. It says if his parents or grandparents were born in undivided India. And mind you, 115C is optional. He may choose to do it. What is a specified asset? Already discussed. Shares in an Indian company, debentures issued by public limited Indian company, deposits in public limited Indian company, security of the central government. Those 4 items already discussed. This can be public or private. This is public, security of the central government. Same, no change. Convertible foreign exchange means as convertible by RBI. Foreign exchange asset, this is specified asset. The same specified asset, if you buy it in foreign currency, then it is called as foreign exchange asset. So NRI taxation special features 115C, that is if he may choose to do it. He may choose to do it. Investor income means income that you get from this asset. Interest income under 194 LB, LC, LD shall not be covered here and shall be taxable as per 115A. This is only these items. Only these items, nothing else. So, if you see method of computation, investment income, no deduction in respect of any expenditure will be given. Where gross total income includes investment income and LTCG also. As I told you, second proviso will not apply, and I told you what is the extra benefit here. First proviso shall apply. Extra. Compare it with the usual stuff, is extra. No deduction shall be allowed in chapter 60, same. Where GTI includes investment income, LTCG and other incomes. Second proviso shall not apply. First proviso shall apply normal. Chapter 6A shall be applicable to those other incomes. That also we have seen. Very, very simple. Interest received by NRI on rupee denominated bonds, I told you, from these state to these states are exempted under 10(4)(c). Interest received by NRI on debentures in a unit located in IFSC also after 1919 is exempted under 10(15). Income tax computation, same guys, investment income 20%, LTCG 10%, other income normal slab rate, same thing, no change. This is the extra masala. Where NRI has transferred a long-term foreign exchange asset within a period of 6 months after the date of transfer and invested the net consideration in any specified asset. Then LTCG, if you invest, full LTCG exempt. Otherwise, LTCG into cost of new asset by net consideration. That pro rata basis, you will get the exemption. And there is a 3-year lock-in. Where the new asset is transferred or converted into money within 3 years from the date on acquisition, the LTCG exempted earlier shall be deemed to be the income. Simple. A non-resident acquired shares on 1/1/2009 for 1 lakh in foreign currency. These shares are sold by him on 1/1/23 long term for 3 lakh. He invests 3 lakh in specified assets on 31/3/23 and sells them on 36/23 for 3,50,000. In this case, LTCG of how much? 3 lakh minus 1 lakh. Purchase for 1 lakh. Shall be exempt as the entire net consideration of 3 lakh is invested in buying new shares. However, since the shares are sold within 3 years, he purchased it on 31/3 and sells them on 36/2023. From the date of acquisition, entire LTC were exempted earlier shall be taxable. So whatever was exempted earlier will be taxable, plus additional you will get short-term capital gain 3,50,000 minus 3 lakh. Same. Return of income. NRI is not required to file ROI if total income consists only of investment income or LTCG. And TDS has already been deducted. We have seen that. So TDS rates are normal general NRI taxation TDS rates are 195. Let me just restart and once again. There is some network problem, guys. I tried, leave it. So anyway, I'll show it to you here only. Rates are under 5.2. I've given it here anyway, 5.2. And let's see here. See, I was doing that only, no? Any long-term capital gains referred to in 115E or long-term capital gains on listed securities, 10%. And here on investment income in 115E, 20%. So TDS will be under which section? 195. TDS will be under 195. So come back. To chapter 3. .2. So NRI is not required to file ROI if the total income consists only of investment income and or LTCG and TDS has been deducted from such income. Yes. How TDS is deducted? Section 195. (115) AB and all we have done already. AC all this done. And this is a choice. You may choose to opt or you may not choose to opt. Where the NRI in the previous year, this is a special case, benefit to NRI when he becomes a resident. Special case. So let's say you are a non-resident in 2021 because of COVID, you did not get any job, you were thrown out from the job, many people it happened, you came to India and you became a resident because you stayed in India full year and 21 also full year, this year also full year you are staying, next year also full year. What I am saying is basically you are staying here. So the moment he becomes a resident, can he still choose to continue under the old 115C? So there is a choice. If you file a declaration saying that I want to be bound under the section 115C, the entire special provisions basically, then he can continue to do so. So if you see, where the NRI in previous year becomes resident in any subsequent year, he may furnish a declaration in writing along with return of income under section 139(1). The declaration shall allow him to be governed under the provisions of this chapter in respect of interest derived from foreign assets. Only for interest income, guys. Only for interest income. Provisions will not apply to dividend and income. Dividend income and LTCG. This will be normal provisions. Provisions shall apply to investment income and for that assessment year and subsequent assessment year until the transfer and conversion of such asset. Until that asset is still there or an asset, he will continue to be under the old provisions. An NRI may choose not to be governed also and he may go through the normal chapter. Benefit under this chapter shall not be available if he opts for 115 BAC. Correct? If he opts for the new regime 115 BAC, then this particular section will not be there. It's just for you to go through. So if you are a non-resident is becoming a resident, you can opt to do so. You have to file a declaration. Interest income is not covered here. I mean, interest income only is exempt here. or interest income itself is governed by the old provisions of 115C. But other two incomes, that is dividend income and LTCG, will be continue to be taxed at the general provisions. There is no change there. And yes, it will apply for that assessment year and the subsequent assessment year until the transfer or conversion of such asset happens. An NRI may choose also not to be governed by the provisions of this chapter by furnishing return of income and declaring therein that the provisions of the chapter shall not apply to him. Benefit will not apply if he opts for 115 BAC. Then other things we have seen already. So that these are the special features, guys, nothing else. These are only the special features. Right. So one exam question, I've just slightly modified it, guys. Also taken it from a couple of books because they had modified the same. So let me just write it down. NRI derives following foreign exchange assets as on 31/3/21. Shares. Purchase date 1/1/2015. 2 lakh. Shares sold 31/3/21. Obviously long term, right? Immediately you can see 4,50,000. Dividend 40,000. Collection charges. What do you think? Well, collection charges will you get anywhere? No, even in 57 you will not get. If you remember, what you will get only 20% of the loan taken to buy the shares, interest portion, to the extent of 20% of dividend. Business income 2,80,000. Since you're an NRI, you will get the benefit of first provis also, if you remember. So on 1/1/15 and 31/3/21, TTBR, TTSR, 24/26, 29/31. So what will happen if he opts for? If he opts for the special one, chapter 12A. If he opts for chapter 12A, what will happen? Capital gains. So since it's long term, period of holding is from 15 to 21, sale price. Sale price is what? 4,50,000. At what rate? Average rate I should take. So 30. 29 plus 31 by 2, 30. So it comes up to $15,000. Cost of acquisition 2 lakh. At what? Again average. 24 plus 26 by 2. 25. Dollars 8,000. So what is the gain? 7,000. This $7,000 I should do it at what rate? That we've seen only at the TTBR rate. TTBR rate. So it is long term capital gain is $7,000 into 29. 2,03,000 rupees. Then what would be income from other sources? IFOS. That will be dividend. Dividend is directly 40K. You will not get any other collection charges, etc. will not be allowed. Then PGBP. How much have they given? Business income 2,80,000. It is 2,80,000. Now tell me, guys. On this 40,000, what is the rate of tax? 20%. On this 2,03,000, what is the rate of tax? Is under 115E. This also 115E. What is the rate of tax? For this 10%. 10%. This one will be normal rates. Normal rates. So this will be the same thing, guys. If it is other cases, no, then of course, yeah, other things will remain the same. So this same thing will happen even if the shares are unlisted. Shares are listed and STT is not paid. Shares are listed but STT is paid. Same thing. If it does not opt, then you have to do three different things. If shares are unlisted, then first and second proviso will not be applicable. Next is if shares are listed and STT is not paid, then it will be computed by applying the first proviso. Then if STT is paid, in that case obviously first and second proviso not applicable. Like that we need to discuss and do it, guys. Simple. But this is what I wanted to show you. This is how you need to show, and this is what will be the tax rates etc. of this particular thing. Done. So I think we have covered many important things. Good enough. Illustration 89. Check my book also. Done. Let's see this in DT. Let's come back to DT, guys. Page number D18, module 1. Module 1. IFOS. TDS on winnings from lottery, crossword, puzzle, etc. This is applicable to both resident as well as non-resident. Now we'll do some chilled out things, becomes easy. Where the total income on SC includes any income by way of winnings from lottery, crossword puzzle, racehorse, all these things, card game, any other game of any other sort, gambling and betting. What is the rate? Flat rate of 30%. Flat rate of 30%. Taxability of income. In the nature of winnings from any lotteries, crossword puzzle, etc., are subject to the following: no expenditure allowed, no deduction allowed, no benefit of carry forward, not even the benefit of basic exemption is denied for these certain cases. Income is paid after deducting, grossing up principle has to be applied. So if you see these things, I had done this, I am just revising. Lottery includes winning from prize award to any person by draw of lots by chance. Card game. Horse race means a horse race upon which wagering or betting may be lawfully made. 115BB does not apply to income derived from owning and maintaining race horses. That is a different activity altogether. So this second and this one, this case is important. Also, if the terms of the lottery was such that 30% had to go to the government and you will only get 70%, You will pay 30% on the full 100% or 70%. Obviously only on the 70% because this will be overriding title. This will be diversion of income based on overriding title. So in the lottery, I need to see what terms and conditions they have given. The only important thing here is this case, guys. Kerala High Court versus CIT. CIT versus Manju Singh, Manju and Company. So once he sold off all the lottery tickets, whatever little lot, or some 10-15 leaves he had, in that only after the lottery was announced, he figured out he was the winner. He said business income. The business income and his claimed expenses, etc. Assessing officer said, no bro, this is not business income, IFOS. Goes to court. Court says, boss, when the lottery has been announced and you have already sold and the lottery is announced towards the end, once the lottery closing date is over, then the whatever paper you have becomes not stock in trade. They are waste paper. From that waste paper, you struck gold. So it will be income from other sources. Read. Any winnings from unclaimed or unsold lottery tickets held in the possession of an agent or trader shall be in the nature of business and does not constitute lottery winnings, is what the director of state lotteries had told. But you see, contrary view, this is what we need to remember. That winning from any unsold lottery tickets held by distributor as stock in trade shall be considered as winnings from lottery, as winnings by the distributor were not in his capacity as lottery distributor, but as a holder of lottery tickets. So this is one thing that we need to see. Very, very simple. This is the normal, what do you say, 115 BB. 115 BB. But for non-residents now, I just revise this because now I need to go to non-residents. Here. Just write down here only. Section 194B. It says, winnings from lottery, if amount exceeds 10K, then it is 30%. Rate is given here. This is the taxability, this is the rate. Now this was for resident and non-resident. But one interesting thing, a MCQ they had asked, a non-resident wins lottery of 8,000. Should they deduct TDS? Question had come. 194B is the taxation of lottery, 30% if the amount is more than 10K. If a non-resident earns 8,000 rupees, will you have to pay 30%? Guys, this is the general rule. Specific rule for non-residents is 195. So if you see 195, page number 5.2, specifically point number 8, income by way of winnings from lottery, crossword puzzle, card game, etc. They have given a rate as 30% in 195. Clearly given 30%. Here there is no 10K benefit. no 10K benefit. So my question here is, will 194B apply or will 195 apply for non-resident? MCQ question. 195 will apply. Specific rule for non-resident will override the general rule. Important. Like this 2 marks they'll ask in the exam. This was the only important thing here I wanted to discuss. Got it? That 10K is only for 194B generic rule, but for 195 specific rule is already there for non-resident. So for them nothing will be covered. So if a non-resident won lottery 75K, other income 1 lakh, on this 75K 30%, on this 1 lakh normal rates. Interesting to know, no 87A will apply. Surcharge, higher education cess will apply for sure. TDS of 30% will be deducted on the amount which includes the cess. This is also important. Normal cases will not include, no, TDS will be deducted just like that. Here you have to include surcharge also, higher education cess also, on that we have to compute. And no 87A rebate also will be allowed. Under any circumstances, no rebate. When we were discussing 194J, if you remember, we are discussing as per the CBDT circular, even umpires are called professionals. And I told you, what about foreign umpires? What about foreign umpires? Will they come under this or no? Interesting. We had understood, tried to understand. Let us now come to that. 115 BBA. Tax on non-resident sportsmen or sports associations. Total income of an SSE being a sportsman. So many examples I can give you. If you are a foreigner who comes to India, let's say the Sri Lankan cricket team, or let's say the English cricket team comes to India, under the international rules, BCCI, Board of Control for Cricket in India, has to pay some amount to the English cricket board also and the English cricket players also. Similarly, if our fellows go there, the English cricket board will pay money to Indian cricket board BCCI, and they will also pay money to the players. Are players getting money from everywhere? Is it chargeable in India? 100% yes, because they are residents. What about outsiders coming to India. Will it be deemed to accrue or arise in India? 100% yes. Because obviously it is received in India and the services here, whatever it is, also is rendered in India. So this particular section talks about that. What about cheerleaders? What about cheerleaders in IPL? Cheerleaders, money that they get, will it be taxable under this section? We need to see. I recently, not recently, I had gone to this concert in India. This guy, Alan Walker, is a EDM artist. It was in Chennai. In fact, very nice it was. And then again I went to Pratik Kuhad. Pratik Kuhad is a citizen in the United Kingdom. He's an Indian, but settled in UK. He's not an NRI. He is a citizen of the UK. He was just born here. He studied here little. Then he went and shifted out there. He's a actual citizen of the United Kingdom. Now, if he comes to India, which he came, I attended his concert also, the money that I gave him means obviously the concert I'm saying, will it be taxed? Yes, but will it be under 115 BPA? Second, Alan Walker, EDM concert, will it be taxed under 115 BPA? Check it out. Total income of an SSE, being a sportsman, English cricket player, Australian cricket player, who's not a citizen of India and who's a non-resident. Yes. Being a non-resident sports association, English Cricket Board. Both the cases. Any income received, income will be what? Man of the match, man of the series, best bowler, yes bank, maximum, whatever you can take, everything. Income received by way of participation of any game in India. You can get any sport, guys. Cricket, football, hockey, kabaddi. Then they'll come and do advertisement also, no? Coke, Pepsi, income received by advertisement also. Then these foreign commentators will come and do commentary. Income received by any contribution of articles relating to any game, sport, newspaper, magazine, journals. Sportsman or an athlete is what they say. Commentator is, of course, you are always a sportsman and you're giving your other services here. Contribution to articles of the game of sport you are giving. Many people on CricBus, etc., they will give articles. Everybody will be taxed under 115 BPA if you are a foreigner. And to the English Cricket Board also I should pay. Cheerleaders, my dear friends, will come under this, being an entertainer who is not a citizen of India and a non-resident. Cheerleaders will come. Alan Walker will come. Pratik Kuhad, if he is a citizen of India, assume. In my opinion, he is not. He's shifted there, he's got citizenship. Or let's say he has dual citizenship. What do you think? Entertainer is not a citizen of India and non-resident, income received from his performance in India. Akshay Kumar is a Canadian citizen, FYI, for this reason only. What is the tax rate? Is an entertainer who is not a citizen of India, but actually is a resident. If assuming if he is a non-resident, then what? 20%. Priyanka Chopra, now she got US citizenship. Priyanka Chopra, is she a citizen of India? No. Is she a non-resident? Yes. She came and did one movie here in India now. Fully in India. What is the rate of tax? 20%. Pratik Kuhad, citizen of India but a non-resident. Will he come under this? No. He'll come under normal provisions. Now what about foreign umpires? Simon Toffel, Asad Rauf, all these people. Aleem Dar. What about them? When I was a kid, there was Steve Buckner. Always he hated India. Always he used to give out for all these our fellows. Then David Shepard, one guy was there. When India were 1-1-1, any team 1-1-1 used to, opt. Nelson, that score was called Nelson. Very interesting. Umpires, though they are professionals under 194J, 194J is for Indians, residents. They are not professionals. They are neither sportsmen nor athletes. They are neither entertainers. So you see, important. Umpires and match referees in games played in India can be described as professionals or technical persons who render professional, but they cannot be said to be non-resident sportsmen or association. Though for the purpose of 194J, match referees are professionals, TDS is attracted only when the deduct is a resident. There is not a resident. So 115 BBA will not apply to them. What will apply? Normal 195. 30% rate. How sir 30%? 195 rate only is like that. Residual rate is 30%. Here. This rate. 12. Number 12. 30%. Got it? So payer, any person, payee, non-resident sportsman, non-resident entertainer, including theatre artist who is not a citizen of India. Anybody who comes to India, any non-resident sports association, rate 20.8%. Surcharge will be applicable based on the limits. Nature of payment, income of in participation in any game or sport in India other than referred to in 115 BB, that is horse race, winnings, lottery and all that. Income by way of advertisement, income by way of remuneration, for articles, sports, etc. News agency, Mr. Stephen Smith, Australian cricketer, contribution he will give, 25,000 he earns, 5,200 tax he has to pay. Right? That's what it is. So 194, 115 BBA is the taxation, TDS is 194E. For umpire, 194E will not come, 195 will come. In the year 2011, crude oil crash happened. This was on the lines of the subprime mortgage crisis in the year 2008, after which crude oil also fell miserably. Once the crude oil fell, all these countries were scrambling for, countries who are ready to buy. India has always been a huge consumer of crude oil. Pranab Mukherjee was the finance minister. Pranab Mukherjee went to all these, oil producing countries and he told, let us fix the rate. One barrel, let us say $35, fixed for 8 years. I will 100% agree to buy so many barrels per annum for next 8 years. Enter into the deal. But there was a catch. If they came to India, since the money is being paid in India, and since they have a business connection in India, if you see section number 9, one sec. You see section number 9. In the case of a business other than the business having business connection in India on account of significant economic presence that you leave, but in case of a business having business connection in India. So don't you think so it is business connection? So don't you think so if I have a business connection in India, I need to pay tax? Yes. So those companies started telling, boss, we will give you for 8 years. You are a very good client, but then we will not pay tax. That's why, my dear friends, in the year 2012 Finance Act, Pranab Mukherjee inserted 10 clause 48. Income received in Indian currency by foreign company, because that was paid in India. Why Indian currency it did was to prevent foreign exchange fluctuation. Very smart. He said, if you agree for Indian currency, we'll give you exemption. Brilliant, Pranab Mukherjee. Because foreign currency, if you give tomorrow, what do you say, $1 will become 80 rupees. Then if I have to pay $35, I have to pay 80 rupees. So what he did was 35 into today's rate, 70. That's it. Fix that rate for next 8 years with some minor increase in Indian currency. If you say so, then you will get exemption. Otherwise, buy. On account of sale of crude oil, other goods, services notified to any person in India shall be exempt from tax. Conditions: receipt of income should be pursuant to an agreement. Having regard to national interest, foreign company and agreement is notified. Foreign company is not engaged in any other activity in India, obviously. Then again in the year 2016, Arun Jaitley, along with Modi, went to all countries, especially Narendra Modi used to travel a lot, if you remember. He went to all the countries in UAE and he said, crude oil you have, you give me that crude oil for so many years. In return, everywhere you have desert everywhere. There is no land to store your crude oil. In India, we have so much land available, no problem. In some remote place, I will give you the land. Underground, you please invest properly. You build all your containers. You bring all those crude oil containers to India. From here, you do business. I will give you exemption. What exemption? 1048A. Finance Act 2016 by Arun Jaitley. I want to show you the Finance Bill 2016, Arun Jaitley speech, or rather the explanation to Finance Bill. The existing provisions, Section 5 talks about total income. In case of a non-resident, the taxation of income takes place only if the income accrues or arises in India or is deemed to occur in India. Section 9 provides for circumstances in which income is deemed to occur in India. One of the circumstances provided for income is that the income is directly or indirectly derived through or from a business connection. UAE business connection is there. The Indian Strategic Petroleum Reserves Limited is in the process of setting up underground storage facility for storage of crude oil as part of strategic reserves. Maintenance of strategic reserves is India's national interest and ensures price stability for Indian oil companies. The filling cost of such facility entails huge financial burden. You should have proper facility for emergencies, against fire, against all destruction, etc. The government has explored the possibility of meeting a substantial part of the financial burden through participation of private players, including foreign national oil companies, UAE, and multinational companies storing and selling crude oil. However, storage of crude oil by and sale in India would create taxability. Hence, in order to achieve neutrality in terms of taxation, to encourage those people to come to India and do so, there is a amendment, which one? 1048A. Income accruing or arising to foreign company on account of storage of crude oil in a facility in India and sale of crude oil. It should be pursuant to an agreement, national interest, it should be notified. Let's say the agreement gets expired, everything is done, some little bit oil is left. Do you think they will take it back? No, they will sell it here only. That also the foreign companies asked, bro, later you will sell that in India only. Then you will say deemed to accrue or rise in India. For that also you give me. So 48B. Income accruing or arising to a foreign company on account of sale of leftover stock of crude oil from the facility in India after expiry of agreement. That also exemption. So three exemptions were granted by Arun Jaitley and Pranab Mukherjee combination. Congress BJP. It has got nothing to do with the party. It's about the good stuff that people did. On that note, we shall stop. 48B. 48C also was there. Let's just finish it off and then we'll close it. Income accruing from what? Arising to whom? I told you, no, Indian Strategic Petroleum Reserves Limited, wholly owned subsidiary of the Oil Development Board, as a result of arrangement for replenishment of crude oil. Replenishment. New stock coming in for that also. The crude oil is not replenished in the storage facility within 3 years from the end of the financial year in which crude oil was removed from storage for the first time, exemption shall not apply. So, this is also putting force on Indian Strategic Petroleum Reserves Limited, saying that the moment the oil is over, it is your responsibility to get it here quickly within 3 years. Otherwise, exemption will not be there. So, all these wonderful exemptions were granted. Head office expenditure we had seen quickly in direct taxes itself. Done, guys. This chapter also done. Right? We've been doing international taxation almost 3 chapters over. See? I mean, first one is still not over. Many things to do in that. But see, this is done. This is done. All this, remember? Many things are there still. Many things. Transfer pricing is also there, deadly. And DTAA is there. It's not over. But I hope you are now understanding how easy it is. Right? Don't worry, guys. It's easy. Just keep on revising. 30 marks should be in your pocket. If you study the way we are doing now, 30 out of 30 guaranteed. Come on. Up top. So, I've been sick since the past few classes. That's why, running nose, voice also is gone. But the classes, I'll ensure the quality will never deteriorate. Okay, guys? Love you all. Take care. Bye. Hi, buddies. How are you doing? So, yes, in the previous class, we were discussing. What were we discussing? Tell me. We were discussing, if I'm not wrong, 1048A, 1048B and all those things. Sale of crude oil. These 3 things we discussed, right? Remember? 1048, 1048A, 1048B. So 1048 was what? Income received in Indian currency on account of sale of crude oil. Pranab Mukherjee had inserted that. Is exempt from tax. And then slowly in other countries. Correct? So we saw these areas also. Sports association, etc. we saw. Storage. So this was inserted by Modi. Storage of crude oil facility. That is one part of the story. 1 second. Yeah. And later 48B told that on the leftover stock, it could be expiry also or it could be termination also. Expiry, the agreement expires in the normal course, that's okay. But also they're talking about termination. What if the, contract is terminated between the two? So if it is terminated between the two also, then you will have to sell it. Leftover stock has to be sold. That is 48B. Similarly, replenishment under 48C. Because guys, if you see, anybody who has a business connection, so if you see, if I read it with 1048A, if one non-resident sells it to one more non-resident, anyway it is exempt. Because if you see, hold on, I'll show you. Section 9, if we see, 911 only speaks about business connection. Let it open. Swami Nityananda Swaha. That fellow is also not working today. Maybe woke up late. Oh, finally it came. Business connection. And you see the explanation. Business connection shall include any business activity carried out through a person who was acting behalf of a non-resident. Obviously. Only through a non-resident. All these things are there. You see here. In the case of a non-resident, no income shall be deemed to accrue or arise in India to him through or from operations which are confined to the purchase of goods in India for the purpose of export. So if I am storing crude oil in India and Dubai fellow is I am importing from Dubai and then I am selling it to exporting it to a foreigner, anyway it is exempt under 91B. Correct? 91B, anyway it is exempt, right? So here you see this also. If I store crude oil in India and export to UAE or export to any other country, anyway under 91B it is not deemed to occur as in India. But if I sell it to any person resident in India, then it shall be exempt from tax. Right? That's what I'm trying to tell. So then only it will be exempt from tax. So under 91B, guys, what is not deemed to occur as arise in India? Anything that I import for the purpose of export. Anything that I import for the purpose of export is not deemed to accrue or arise in India. But if I import something, store it in India, sell it in India itself, see here to a person resident, that also they have exempted under 1048A. First is storing. Second, if you are selling outside, anyway exempt under 91B. But if it is selling it to India, let's say I am importing crude oil and selling it to Adani, selling it to Ambani, still it is exempt for the foreign company. Right? So many things have come, they are changing. Narayan Murthy also you would have read somewhere he had told that why 182 days you are making, why 120 days you are making for non-resident, make it 265 days also. Don't put pressure on them saying that you have to stay in India for so many days only. It's okay, even if they stay 300 days, 350 days also, make them non-resident. So basically, ultimately we have all understood that if outsiders invest only, our country will grow. Outside funds should come and you should make non-residents comfortable. Not too comfortable that they'll take away everything, but not too averse also where they will not come and do business. In fact, Elon Musk was supposed to come and introduce his Hyperloop in India. Under Hyperloop, it's a underground magnetic system whereby Bangalore to Chennai, though it is like 5-6 hours by car and 6 hours by train and like 1.5 hours, 1 hour by flight, you can actually travel in 20 minutes. Imagine. So you can go from Bangalore to Chennai in 20 minutes and come back. Crazy. So things are changing, guys. Things are definitely changing. So it will take time, of course. So what they are trying to tell is this one. So if I'm importing and then selling to a non-resident, anyway not covered under 91B. If I'm importing and selling to India, then it is this. And then it's, especially we saw 1048B also. That is done. That is done. So we have been seeing all these, right? Right. So I'll just read one question. You let me know whether, if they've asked 2-3 times, May 16, May 17, May 15, slightly older question, but for the concept only I'm reading. Read it. It's not that you have to note down everything, just read it. This is May 16, May 17, May 14 also asked in the exam. Just hear me out. Omega Limited, an event management company, organized a concert of international artists in India. Okay. In this connection, it engaged the services of an overseas agent, Mr. John, from the UK, to bring artists to India. He contacted the artists and negotiated with them for performance in India, terms of the authority given by the company. He did not take part in any event organized in India. Company made the payment of commission of 1 lakh to the overseas agent. Tell me, guys, will it be taxed in India? I told you in TDS part also, when I was explaining 40A1, 40A1A and all that. If I make payment to an overseas agent who has never provided any services in India, never come to India also, he has contacted them there and he has taken money, and those people have come here. He was paid money only to get the connect. He got the connect, got them into the country. That's it. Chapter close. So an overseas agent of Indian company, he operates in his own country and no part of his income can be taxed in India. So that is just a common point, because it is services rendered outside India. What will be taxable if the services is rendered in India? His only job was to get the foreign artist to agree, for which he was paid money. Using his business connection, he just had to get the people to India. So where did he use his business connection? Outside India. Where did he actually give his services? Outside India. What was the service? Getting, the artists on board. So will it be taxed in India? No. So that was a common point that we need to see. Those are the two questions. So we will finish off a very quick theory chapter called advanced ruling very quickly. Let's not waste time. Advanced ruling. So if you see here, we had finished 2, 3, all that done. Yeah, 13.1. Very quickly, we'll finish it off, guys. Very easy chapter it is. They may ask here and there, generally, like for MCQ 2 marks like that, or they may ask for, 4 marks. That's it. Quickly, we'll finish. Very easy chapter. There you go. Page number 13.1. Advanced ruling. So earlier, guys, advanced ruling means what? So basically, non-resident who had entered into a transaction or who was about to enter into a transaction could have approached there was an authority earlier called authority for advanced ruling. It could be a question of fact or a question of law. He could go to them and say, sir, this is the problem that I have. Tell me whether the tax will apply or not apply. Please tell me whether it will apply or not apply. So earlier for non-resident, it was there. Now the thing is, and earlier, no, anything that the advanced ruling authority had told would have been binding on the SSC and binding on the department also earlier. Now there's a huge change. Why I told you that it may not come as often as it would have come before is because Finance Act 2021 has clipped its powers. What did I tell you earlier? Authority for advanced ruling, whatever he decided was the correct thing. In the sense, if he says that, yeah, this is a question of fact, tax has to be paid. Question of law, tax has to be paid, then tax has to be paid. No, tax need not be paid, then tax need not be paid. This was prior to 2021. Finance Act 2021 removed this authority for advanced ruling, removed this concept, and it started something called BOR, B-O-A-R, not B-O-R-E, B-O-A-R, Board for Advanced Rulings. In this Board for Advanced Rulings, earlier there used to be like a CBDT representative, there used to be a High Court judge, retired, there used to be a Law Ministry official earlier. Now everything removed. Now it is a Board for Advanced Ruling. whatever they decide, it is not binding on SSE and department, not at all binding. So as of today, whatever you do, it is not binding on what? Not binding on both SSE and department. Not binding on SSE and department. This is the advanced ruling. So the superpower which was given before has been removed under Finance Act 2021. That's why the importance has reduced. But that doesn't mean they may not give in the exam. 2 to 4 marks if they ask. Otherwise, no also. But we should not ignore anything. We'll quickly finish it off. Okay. Advanced ruling. So what is advanced ruling, my dear friends? Determination by the bar, BOAR or bar, board for advanced ruling. You can write it BOAR, bar also is fine. Application to bar, not that bar. Okay, that is board for advanced ruling. In relation to a transaction which has been undertaken or proposed to be undertaken, I just told you, determine any question of law or fact by a non-resident. So that is the first part. Here, no case should be pending. There should be no case pending before any of the authorities. Determination by the bar in relation to tax liability of a non-resident arising out of a transaction undertaken or proposed to be undertaken with such non-resident. So this is what? This is checking by a resident. Resident to check non-residents' tax liability. I am entering into a transaction with a non-resident, so I need to know whether the tax will apply or not. So I will go. Here also no case should be pending in any of the courts or ITAT or any of those things. 2A. Determination by a bar in relation to tax liability of a resident applicant using out of transaction which has to be undertaken or proposed to be undertaken, question of law. But here guys, these are all notified individuals. It is similar to 2 only, but this is notified. What is notified? Transaction value should be 100 crore or more. Under 2A, it should be 100 crore or more. And even in this case, there should be no case pending. Should not be any case pending. So under 1, 2, 3, these 3, there should be no case pending anywhere. Yeah, so transactions valuing 100 crore or more in total, which would have been undertaken or proposed to be undertaken, here no case should be pending. Determination by the bar in relation to an issue relating to computation of total income which is pending before any IT authority. So guys, here you see this is only application can be made only by a government company, that is PSU. And in this particular case has to be pending where? IT authority or ITAT. But case should not be pending in High Court, Supreme Court. In these 3 cases, no case should be pending anywhere. Not in IT authority, not in Commission of Income Tax Appeals, not in ITAT, nothing. But here, no case should be pending in High Court and Supreme Court, but case should be pending before any income tax authority. Only for what? PSU. These are small points. That is why my value addition comes. Otherwise, it's very easy. You can only read this. So you should keep in mind. In point number 1, 2, 3, case should not be pending anywhere. In point number 3, case should be pending where? Case should be pending where? IT authority. Only then I can apply. Rather than going to the court and wasting time, the PSU can apply and determine a question of law, question of fact. Everywhere question of law, question of fact is there. Please note. Question of law, question of fact, question of law, question of fact. Here also. Last part, determination by the bar whether an arrangement proposed to be undertaken is an impermissible avoidance agreement. This we will discuss when we study GAR. General anti-avoidance regulations. Later we'll see. When we do GAR chapter, you'll understand this. Because you need to understand the concept of impermissible avoidance agreement. So whether a particular arrangement is an impermissible avoidance agreement has to be found out either by a resident or non-resident only then. Very, very simple. Now, two questions, guys. It's also an exam question. So for assessment year 2020-21, assessment year 21-22, 22-23 assessment years. One company, Eco and Company, filed an application for with the bar, board for advance rulings, BOR or bar. So now, why am I telling this is, what do you mean by cases pending? In advance ruling, if a resident, non-resident, whatever they are doing, what do you mean by case should not be pending? What is the meaning of case should not be pending? Okay, normal case not be pending means it should be not there with the Commissioner of Income Tax Appeals, should be not there with ITAT, should be not there with any other appellate authority. But what about if a 143(2) notice is sent? Will that mean that case is pending? You have not even replied. Will it mean case is pending? That's the problem. So what do you mean by case should not be pending? This question they had asked in the exam. 2-3 times it has come. Important. Right? Assessment year 2021 and 21-22. Notices were issued under 143(2) by the department, and subsequently 142(1) enquiry along with questionnaire also came. All this was there before application to bar. Before application to bar, all these things came. For the assessment year 22-23, notice under 143(2) was issued before date of bar application, but 142(1) plus questionnaire was issued after date of bar application. So the bar will reject which document is the question. If any case is pending, they will reject. What do you mean by case pending? What do you mean by case pending? What do you mean by proceedings pending? So the issue is similar to the case law 2016, Hugh-Sung Corporation versus Authority for Advanced Ruling 2016. They said mere issue of notice will not equal to proceedings pending. But issue of notice plus questionnaire before bar application. Issue of notice plus questionnaire before the bar application will be what? Will be deemed to be proceedings pending. Will be deemed to be proceedings pending. Notice plus questionnaire before bar application will be deemed to be proceedings pending. Which means what? in this case. Here, 2020 and 21. 22, 23 cannot be rejected. That application cannot be rejected because this questionnaire came after the bar application. These two, rejection is correct. Rejection is possible. Rejection is possible. See, like this, they can ask tricky questions. So I have removed all the theory questions out of the, I'm not solving them, it's easy. These practical questions, when they have asked, I have solved that. Then one more question, practical. 4 times they have asked in the exam. May 2006, 2013, May 2016, May 2019. I've been analyzing all these papers. So whatever examples I do in class are all previous year's questions. So please do not feel that questions are not solved. Do not even have that idea. I am solving questions only. And for all other questions, you have the compiler. Please go through my Q&A vault. So many questions I have given. That is more than sufficient. More than sufficient, because all the types are covered. Rather than solving the same questions multiple times or say with changed figures, etc., try to solve different questions. That is the idea. Obviously, only then it will be fine. So here, foreign company entered into various contracts with various Indian companies. Right? Now, they approach the bar asking for whether TDS is applicable. TDS is also called as withholding tax. Because these Indian companies had to pay money, right? So they were deducting TDS. Before they could even do it, these people asked them, sir, what is the rate of withholding tax? Please tell. What is the rate that we should follow? One of the Indian companies also made an application to bar asking the same question. Sir, what rate we should deduct? Please tell. And this had this before going to the bar, no, let me change this example a little. What did they do? They went to an assessing officer to inquire about the rate. Basically an income tax authority. The issue was, this was done first, this was done second. This application was rejected, stating that the same issue about the rate is already pending before an income tax authority. It will amount to a proceeding pending. It will amount to proceeding pending. So, went to the court. This was in the case of Ericsson Telephone. You know Sony Ericsson? Yes. Ericsson Telephone Corporation. 1997 case law. Many of you were never even born. And Ericsson Telephone Corporation. So what was held in this Ericsson Telephone Corporation? They said, is there any proceedings pending against the foreign company, was the question. The answer is no. The question, similar question in the similar case was raised by an Indian company, but not a foreign company. Although the question which was raised pertained to one of the payments made to the applicant only, no doubt, it was not one pending determination before any authority in the applicant's case. Had the applicant, that is the foreign company, made an application before? No. If he had not made an application before, how can you say it is proceedings pending? Correct? So this particular rejection by the Board of Advanced Rulings is 100% wrong. Rejection is not tenable. Rejection is not tenable. So see, these are the questions. Apart from that, other things are mere theory. You can finish it off. Hence, advance ruling makes a decision taken in advance by the bar after application made to it in relation to a transaction which has already been undertaken or proposed to be undertaken. Either question of law or question of fact. Again, I repeat, question number 1 is by a non-resident. Question number 2 is resident asking about the non-resident. Third one is notified resident. Notified resident is all transaction value more than 100 crore. In all the three cases, no proceedings must be pending. Fourth case, PSU, proceedings must be pending. Only then this will get attracted before any IT authority or ITAT, but it should not go to the High Court. If any case is pending in the High Court, then it will not apply because High Court will override AAR anyway. So rather than going to the High Court, it's a via media mechanism where immediately I can check, okay, whether to go or not to go. It's like that. Last is about your GAR, which we will see later. 245 RR provides that where resident applicant has made an application to bar, IT or ITAT cannot take any decision in respect of such issues. In other words, resident cannot pursue both the remedies. Yes. The fact that in the first three cases you are telling that no case should be pending only shows that until AAR has finished its work, you cannot go to any other authority, ITAT and all those things. Steps for obtaining advance ruling under Income Tax Act. First one, make an application in the prescribed form and manner. Application can be withdrawn within 30 days from the date of application. However, this does not preclude. So basically you can withdraw the application within 30 days. 40 days later you will come and give valid reason and you want to withdraw. Can you withdraw? Answer is yes. That also you can withdraw, guys, no problem. It was held in a case law, MK Jain. Does not preclude the bar from permitting withdrawal of the application after the set period with the permission of the bar if the circumstances so justify. See, when you are withdrawing, it means that you already have got your answer. So in that case, you have to allow them to withdraw even before 30, even after 30 days. So 30 days is just an overall view that try to finish within 30 days. It's not like the 100% you have to finish within 30 days. It's not like that. You have to withdraw within 30 days. Application shall be filed in quadruplicate. Application will be digitally signed if the SC is required to furnish return of income. Otherwise, can be communicated to registered address. Now everything is digital signature. Now category. Applicant referred to in 1, 2 and 2A, like the first three items. Amount, what is the fee? The amount does not exceed 100 crore, 2 lakhs. The amount is 100 crore, does not exceed 300 crore, 5 lakhs. So it should be in crores, guys. 1 lakh, 2 lakh cases and all, you will not even go because the fee only is 2 lakhs. Amount of transaction exceeding 300 crore, 10 lakhs. For 4 and 5, that is for your GAR and your PSU, that is how much? 10,000, that's all. Government, why will it pay itself 2 lakhs and all that? Then what should you do? Bar shall forward a copy of the application to PCIT or CIT to ascertain whether the case is pending or not. So you should tell, sir, case is pending or not, please let me know. Bar may allow or reject the application. However, in the following three cases, application shall be rejected. What? For a non-resident applicant except PSU and the question is raised is pending before any authority, obviously it will be rejected. For PSUs, you see, when the question is pending before High Court or Supreme Court, I already told you. Which means for PSUs, question should be pending before IT authority, but it should not be pending before High Court. Question raised in the application involves determination of FMV of any property. If that be the case, AR cannot do, it will be forwarded to a valuation authority. Question in relation to a transaction is prima facie avoidance of tax. It will not be applicable for PSUs. Basically, if you have given a question of fact and the face of it, it appears that it is tax evasion. Why will AAR say, yeah, this is right, go ahead? No. Do you think AAR will support tax evasion? No. Tax avoidance? No. Is it there to as a plan mode of planning for evasion of tax or avoidance of tax? No. So it will not be allowed. These are the, if application is rejected, of course I can appeal. Opportunity of being heard is given, and the copy will be given to the PCIT or CIT. Earlier, you could have applied against the rejection. Earlier, that power also removed now. No appeal is possible against the order of rejection. That's why I've given in bold, important. Earlier it was possible. If application is accepted, then the bar shall pronounce its advance ruling on the question specified in the application after examining the information. On request of the applicant, bar shall provide an opportunity of being heard, obviously. Bar shall pronounce within how many months? 6 months from the date of receipt of the application. Copy of the advance ruling pronounced by bar shall be sent to the applicant and the PCIT or CIT. Step 6. The CG may make a scheme by notification for the purpose of giving advance ruling by the bar so as to impart greater efficiency, transparency. Basically, this entire thing is faceless. They said bar proceedings also now can go faceless. The order of the bar giving its opinion against the rejection, you cannot prefer an appeal. But against the final bar order, can you prefer an appeal? Yes. This is also a change, important. The order of the bar giving its opinion is an appealable order, as the same is not binding on the SSE or the IT authority. Hence, the SSE or the IT authority can file an appeal to the High Court against the order of the bar within 60 days from the date of communication of the order. The High Court may grant a further period of 30 days. So within 60 days, you can, go to the High Court and file. If circumstances are there such that 60 days is also very less, High Court can grant further 30 days. High Court can grant further 30 days. High Court may further grant a period of 30 days for filing such appeal. The central government may make a scheme by notification for the purpose of filing appeal to the High Court so as to impart greater efficiency. Same thing, guys. Even High Court proceedings of bar related hearings can be faceless. Faceless. And the central government can issue certain directions with respect to how the faceless etc. should happen. No such direction shall be issued after 31/3/2023. That's the last. Where the bar finds that the advance ruling sought by applicant is through fraudulent means or misrepresented facts. Whatever facts which are there are completely, clearly, manufactured by the applicant. That be the case, ruling will be void ab initio. Board for advance rulings. The central government shall constitute one or more board for advance ruling. Yes. 3 bars have been constituted. 2 at Delhi, 1 at Mumbai. The bar shall consist of 2 members, each being an officer not below the rank of the chief commissioner. Earlier there used to be one retired judge and all that, now everything removed. In that too, one person, let's say, resigns or dies. Does it mean the proceedings of the bar is invalid? No. That's why specific section they have inserted. Any vacancy caused by or defect in the constitution of the bar shall not question or invalidate any proceedings or pronouncement. Powers of the bar. Bar shall have all the powers of the civil code. So it has what? Quasi-judicial powers. In respect of discovery and inspection, enforcing attendance, examination on oath, issuing commissions, compelling production of documents and all those things. Every proceeding is a judicial proceeding under the Indian Penal Code. However, bar shall not be deemed to be a civil code for the purpose of criminal procedure. If any criminal thing is found there, fraud, etc., directly it will go to criminal legislation, PMLA, Prevention of Money Laundering Act, all those things it will come. Yeah. Bar shall not be deemed to be a civil court. So basically, guys, if anything happens criminally, if during the course they come to know that the money was laundered, etc., then PMLA proceedings will come. PMLA is a criminal law. So do you think this summoning on attendance, discovery and inspection, etc., will work there? No. Then of course, while computing, if you recall assessment procedure 153, computation of time limit. In computing the period of limitation for making assessment or reassessment, the period commencing from the date on which the application is made to bar and ending on the date on which application is rejected by bar or advance ruling is pronounced by bar shall be excluded. So for example, in assessment year 21-22, SSE made an application to bar on 1/12/21. The bar pronounces its ruling on 34/22. Received by CIT on 31/5/22. So what is excluded, guys? It can be done up to 31st December 22 plus 182 days. That is from 1/1/21 till the day you receive 31/5/22. Totally on 1st July 23, I have time. Till that I have time. That is about advance ruling. Next, that's all, guys. Chiller it is. What is the most important thing? That is the amendment where earlier power was there, it was binding power. Now no binding power. Very, very simple. So let me see in my book what else we can do next. Small points we'll cover and then we'll start off with DTAA today. Double tax avoidance agreements. Interesting area. This class and next class we'll have to do that. Okay, let's do one small concept. Come to very small, it is 6.3. 6.3. Relocation to IFSC. So what does it mean? So guys, there were a bunch of non-residents, okay? So point number one, they invested in a fund called Singapore Investment Fund. Singapore Investment Fund had shares of Indian company, shares of foreign company, all that they had. Now the entire thing was shifted, relocated to India Singapore Investors Fund. Now this is located in a International Financial Services Center, IFSC. So there is a transfer of shares from this SIF fund to this fund. Fair enough. Then India Singapore Investment Fund gives units. Units. To whom? To the non-residents. To SIF, SIF will eventually give it to the non-residents. It's part of the same link. Then all these shares are sold by the India Sing Investment Fund. Everything they sell off. When they sell, what happens to the capital gain that comes? Is the question. There are three capital gains here. One is sale of shares. Second is granting of the units here after selling. Then the shares when they are transferred to IFSC. Simply they will not transfer, they will transfer some amount, capital gain will come here. What happens to this capital gain? Is it exempt or not? In order to help more and more people to transfer their funds, non-resident funds in all other funds to IFSC, they have granted exemptions everywhere. This entire thing is not at all a transfer. Transfer is exempt under 47 7AC. This transfer is exempt under 47 7AD. This is also exempt. That is the gist of the story. This was introduced by Finance Act 2021. Finance Act 2021. And this capital gain income, the nature of capital gains, this is exempt under 1023 FF for the fund. Very simple. With this, overview, let us now dive into it, you will understand. Check it out. Provisions for tax neutrality have been introduced if a foreign investor fund relocates itself to IFSC in India. Any income by way of capital gains arising or received by a non-resident or a specified fund on transfer of a share of a company resident in India by the resultant fund. This is the resultant fund. This is the transfer of shares. This is the capital gain arising. Or a specified fund to the extent attributable to units held by non-resident. Obviously, I am only talking about non-resident here. Resident, everything is taxable. Calculated in such manner as may be prescribed, and such shares were transferred from original fund or from its wholly owned SPV. Original fund, SIF, or any other SPV also, to the resultant fund in relocation, and where the capital gains on such shares were not chargeable to tax if that relocation had not taken place, shall be exempt from tax. Now the question here is, it's not yet complete. Shares of Indian company will be exempt or foreign company? Tell me. Shares of Indian company will be exempt or foreign company? What will be exempt? If this Singapore fund, which was not at all in India, these were Singaporeans, not at all in India. They have, instead of shares, I would say GDR. Shares they cannot buy, I told you GDR. If they had bought GDR of an Indian company and shares of a foreign company, tell me, if they sold GDR, I've already discussed, GDR sold abroad by a non-resident to another non-resident, capital gain will not come. We had seen in capital gains. Foreign shares, Singapore fund has invested in Tesla. How is it linked to India? Not taxable. If it were to be in a foreign country, would it have been taxable? No. Now, because it has come to India, source rule, source has come to India, will it be taxable? Yes, that's why exemption. This is not a transfer, amended. This is not a transfer, amended. And 1023 FF also has come into the picture. Any capital gains which has arisen now, which would not have arisen had the transfer not happened. See the wordings. Where capital gains on such shares were actually not chargeable to tax, means what? GDR selling in Singapore not chargeable. Foreign shares sold in Singapore not taxable. If that relocation has not taken place, if it had not taken place, not taxable. Now it has taken place, it has become taxable. But now I am making it exempt. 1023 FF. So no capital gain. See, 247, 7AC, 7AD. Transfer in a relocation of a capital asset by the original fund to the resultant fund. This one. 1047, 7AC. Any transfer by a shareholder or unit holder in interest in a relocation of a capital asset being a share or unit in the interest held by him in the original fund in consideration of resultant fund. Here I am issuing units. In consideration of this, I am issuing units. Exempt. This is not a transfer, not a transfer. This income is exempt. Are you understanding, guys? Pure conceptual clarity. No nonsense. All these things. Original fund is a category 3 alternative investment fund. Relocation has happened. All this you can leave it actually. Relocation should happen on or before 31/3/2023. That's why this concept is very important for your exam, because the last date is 31/3/23. Resultant fund, cost of acquisition. In the hands of resultant fund shall be the same as cost of acquisition in the hands of original fund, no change. Gift taxation Nifty 6 to 10 also will not apply. Otherwise, if you have sold for less, etc., gift taxation also will apply. That also will not apply. Important example. Same, whatever I told you, same is there here. Let's read. Hong Kong Investors Fund is a fund registered in Hong Kong. Wow, awesome. India has DTAA with Hong Kong. The fund is subject to Investors Protection Regulation of Hong Kong. The units of the fund are held by the following non-residents: 10%, 20%, 30%, 25%, 15%. The fund has invested in the following shares: PQR GDR, Indian company; Infosys GDR, Indian company; XYZ Indian company; USA company, USA company, UK company. These are foreign shares. India Hong Kong Investors is formed in India on 1921 and has been granted certificate of registry as category 1 alternate investment fund. Hong Kong Investors Fund transfers all the shares held by it to India Kong Investors. India Kong Investors, what do? Allot units to the following shareholders in this manner: 10, 20, 30, 25, 15. Same here, same, no change. India Kong Investors Fund sells the share of PQR, Infosys, XYZ, Global, everything for how much? 500 crore. 500 crore is emitted in the same cat here. If I had sold any of these things in Hong Kong, it would not have been taxable in India, but now it is taxable. That is a specific exemption. The amount of 500 crore received by a non-resident is now exempt under 1023F as per introduced. Conditions should be satisfied. Income in the nature of capital gains received by non-resident investors. Capital gains is on account of transfer of shares of a company resident in India. All these things. Capital gains on Global Inc., etc. are anyway not taxable since they are located outside India. This is what we know. Shares are sold by resultant fund. Such shares were transferred original fund to resultant fund in relocation. Capital gains were not taxable if the shares were sold in Hong Kong, as transfer of GDR outside India and transfer of foreign shares outside India is not taxable. There will be no capital gains also in the hands of Hong Kong Investors Fund when it transfers shares held by it to India Kong Investors and non-resident unit holders when they receive units of India Kong in lieu of units of Hong Kong in view of 47(7) AD. So 3 concepts we have covered. If you remember in capital gain, those points when it came, I told you we'll discuss in international taxation. Now the day has come. Very, very simple. Easy, guys. Come on. Come on. Awesome. Easy. Concept. All concept. Nothing else. Everything else is so easy. Concept, if it's clear, everything done. Let's come to double taxation relief, guys. 11.1 to 11.5, double taxation avoidance agreements. So if there is an Indian resident who's earning, let's say, 40 lakh, he's a surgeon, he goes to USA and let's say earns $4 million. That is 40 lakh. He's a resident. He goes to USA, special purpose, does some surgeries, and whatever money he earns there, obviously since he's a resident, global income is taxable in India. But USA also, from USA's point of view, since he's earning the money in USA, it is taxable there also. Taxable here also, taxable there also. Double tax. That is why there is a double tax avoidance agreement or avoidance of double tax. Agreements for double tax avoidance or avoidance of double tax agreements. It's called ADTA, DTAA, or simply called as tax treaties. Tax treaties. And each paragraph of those tax treaties is called article. In your elective paper, paper 6E, I think 6C, sorry, they will also ask you, what do you say? You should know how to read the DTA and all that in that. There you should know how to read the double tax avoidance, agreements. But for our case, that much depth is not needed. What can happen in those treaties are, for that particular item, India, USA. In India, it may be taxable, and in USA, they may give an exemption when you are filing the returns there. Or in India, they may give you an exemption, there you need to pay tax. In some cases, in both the places, you have to pay. But one country will give you tax credit. Tax credit in one country. If at all there is no DTA, then Government of India will give unilateral relief. This is covered under section 91, unilateral relief. This is called as bilateral relief. It's called as unilateral relief. Bilateral relief under DTAA, etc. This is covered under section 90 and 90A. Whereas unilateral relief is covered under 91. So you have given the chart. Easy. Let's see. So double taxation avoidance 11.1, guys. Come on, all of you. 11.1. A double taxation avoidance agreement is an agreement entered into between two countries in order to avoid taxing the same income twice. The two legal criteria for taxability under law are obviously residence and source. In India, that surgeon will be taxed because of residence. In USA, he will be taxed because of the source of income. When a resident of a country derives income from a source in another country, he is likely to get taxed in both the countries, source country and country of residence, obviously, as I told you. Country in which he resides, that is home state, exercise the right to tax on the income on the basis of residence rule. Country in which the situs of the transaction exists, situs means the source, wherever it happened, then they will charge there based on the source rule. This gives rise to a double taxation of the same income in the hands of the same person by two different countries. DTAA can be provided in two ways. One, unilateral relief, section 91. Second is bilateral relief, 90 and 90 capital A. Unilateral relief is when there is no agreement between two countries. The country of residence will provide the relief. India, If there is DTAA, double taxation can be avoided by providing bilateral relief by two methods. One is tax exemption method, tax credit method. Tax exemption method, wherein one will tax, one will not tax, or tax credit method. DTAA is very, very easy, very, very important. Generally, one question they'll ask in the exam, minimum 4 marks, 2 to 4 marks, minimum. If you open any paper, generally one question will be there. Very easy, chiller chapter it is, very easy, don't worry. Actually, in international taxation, the most tricky one is already done. At 115A, AEC, ACA, ABA, all that done, no, over. That only if you keep on revising, because you have done everything structurally, but if you keep on revising, it will be helpful for you. Barring that, chiller guys, all this 30 marks in your pocket you can make. That's why I stopped DT, almost over it was, started this. So 90, 95 marks, 90 marks if it's in your pocket, other things you can quickly go through. For me also, if I finish these parts, I can, I can give you some breathing space that, we have finished all these areas. Other things are very easy, don't worry. So a double taxation avoidance agreement is an agreement between two countries. We have seen all this now. Tax exemption method means what? A particular income is taxed in only one of the two countries. Tax credit method. Income is taxable in both the countries in accordance with their respective tax laws, read with DTA. However, country of residence of the taxpayer allows him credit for the tax charged in the country of source. Correct? Country of residence of the taxpayer allows him credit for the tax charged in the country of source. So, whatever you have paid there, to that extent I will give. This 9091 we'll see, 90 and all we'll see. Let's check 91. That's easy, that's why. Finish it off. Here, page 11.3. Section 91, unilateral relief, the following circumstances must exist. First circumstance, there should be no DTAA with the foreign country or specified country with which India SSE is resident in India. In respect of income arising outside India, SSE pays income tax in foreign country and also in India. There should not be any DTAA with a foreign country or specified territory within India, with which India has this. Then there is no DTA. SSE is resident in India. In respect of income arising outside India, SSE pays income tax in a foreign country and also in India. Both the things he should be paying. With which India you delete, guys? Which delete? Come on, guys. Come back, guys. Yeah. You see, calculation of relief. How will I calculate the relief? If the above conditions are satisfied, benefit shall be extended to the SSE entitled him to deduction from the Indian income tax payable by him, sum calculated on such doubly taxed income at the Indian rate of tax or at the rate of tax of the said country, whichever is lower. What is Indian rate of tax? Whatever tax he paid on total income in India versus total income in India into 100. Simple, normal maths. What is foreign rate of tax? Tax paid in foreign country divided by total income assessed in that country. Then these rates are then applied on the doubly taxed income. Very simple. Very simple. So doubly taxed income means the income computed after allowing all expenses and deductions under chapter 6A. Example. $31,321 royalty earned from USA, 10 lakhs. TDS in US, they deducted 50K. They remitted to India 9,50,000. Let me not take USA, let me take Somalia, because there is no DTA, assume, right? So there is no DTA. There were certain expenses to earn such royalty, which was 2,10,000 rupees I had spent. And I have other income from other sources, 1,50,000. So in India, I am computing this. There they just deducted and gave me this. That's all. Chapter close. Now what I should compute? Royalty income. How much, guys? 10 lakh minus, sorry, minus expenses. I have spent money now to earn that royalty, 2.1 lakh. So 7,90,000 I am computing in India. IFOS 1,50,000. Overall income 9,40,000. Since it's royalty, I can claim 3 lakh rupees under 80 QQB. 3 lakh. Overall, how much? 6,40,000. 6,40,000. Tax in India, 6,40,000 up to 5 lakh, 2 lakh to 5 lakh, 5 lakh to 1 lakh, 1,40,000 into 30% plus 12,500. So the tax will be, I think, 40,500 plus 1,620. I've already done this sum, so I'm copying. Tax will come the same, 42,120. Now calculate the rate of tax in India. Very simple. Tax is this much, income is this much. 42,120 divided by 6,40,000 is how much? 6.58%. What is the tax in, what is the tax abroad? 50K by 10 lakh. 5%. Whichever is lower, so 5% is the relief that I'm going to get. This 5% will be on the doubly taxed income. 99.99% of them, of us, will write doubly taxed income is 6,40,000. Answer is no. Please check here what is the tax, doubly taxed income. Only royalty, right? Royalty. 9,50,000 I earned here. Here how much I earned? Same royalty. What is it doubly taxed here? 7,90,000. 7,90,000 minus 3 lakh. Because I've already got the benefit. Though I got 9,50,000 from USA. What is the portion that is taxed? Obviously 7,90,000 minus 3 lakh. 4,90,000 only is doubly taxed. Because I've claimed this expense also. I have claimed this also. Correct? 5,10,000 rupees I have claimed separately. What is the amount? So I have already taken a deduction under income tax. That is not taxed, subtracted. What is actually doubly taxed? 4,90,000. So what should I take, my dear friends? IFOS is not doubly taxed. Why should I take IFOS? IFOS is taxed not. Why should I give benefit of IFOS also? Doubly taxed income is just 4,90,000. This is where we make a mistake. Other things are all fine. So my dear friends, you will get a relief of 5% on 4,90,000. 5% on 4 lakh 90. Got it? 24,500 rupees you'll get. That is the relief you are going to get. Hope you understood. Very, very simple. Becomes very easy. If you are getting from many countries, you will obviously get from what? Different country you need to choose and you need to figure out different countries. See your second one. On the amount of doubly taxed income, income is calculated at the Indian rate of tax, foreign country. Foreign tax will calculate separately for each country. If I am receiving from 5 different places you can compute. When deduction is claimed under Chapter 6A, 80QQB, no relief should be allowed on the same income to that extent. Yes, I just did now. To that extent, to the extent of 3 lakh, no relief was given. The taxpayer is entitled to take credit for the taxes paid in the foreign country, whether paid during the current year or in the period prior to subsequent to the current year also, no problem. I can take credit. Since a firm and its partners are two separate entities taxable under the Income Tax Act, relief to the partner in respect of share of profit paid by the firm in a foreign country outside India is not admissible because they are two separate entities in the eyes of Income Tax Act. Though they are not two separate entities in the eyes of law. In the eyes of company law, they may be same. But in the eyes of income tax, they are different because person includes firm and partner separately. So calculation of tax on total income including foreign income, we added cess, Indian rate of tax, foreign rate of tax, claim the relief. That is what we did. I just showed you a practical example. So come to compiler guys, page number 12.15. Check this question. So Nandita, an individual resident retired employee of the Prasar Bharati, age 60 years, is a well-known dramatist deriving income from 1,10,000. In May, 2-3 times they have asked this question. Tax 11 lakh was deducted in the country where the plays were performed. India does not have any double tax agreement under Section 90 of the Income Tax Act with that country. Our income in India amounted to 6,10,000 rupees. Her income in India amounted to 6,10,000 rupees. In view of the tax planning, she has deposited 1,50,000 in the public provident fund and paid contribution to approved pension fund. She also contributed to 28,000 to central government health scheme during previous year, and also gave payment to medical insurance 26,000 to ensure the health of her mother, a non-resident aged 84 years who is not dependent on her deadly. See how they are asking. In international taxation, they asked 80D question. I opened 80D. There also I had shown you. You remember. See here 80D, page number H6, module 1. In 80D, normally you can claim 25,000. You can claim additional deduction when the mediclaim is taken for a resident senior citizen. In this question, it is for non-resident. So that additional 25,000 you will not get. Either it is 25k, normally you will get, plus extra 25k. This extra 25k is only for additional benefit, is only if you have taken for resident senior citizen, not for non-resident senior citizen. So to what extent you will get? Only 25k. Can you take extra? No. See how they are asking. Deadly. Indian income 6,10,000, foreign income 1,10,000, overall 7,20,000. Deposit may be 1,20,000, contribution to pension fund 32,000. Here 32,000. Yes. Aggregate deduction under these two put together is 1,50,000. Contribution to central government health scheme 28,000 allowable reduction under section. Since he is a resident senior citizen, deduction is allowable to a maximum of 50,000. But medical insurance premium of 26,000 paid for aged mother, she is a non-resident, she will not be entitled for a higher deduction. Restricted to a maximum of 25,000. See guys how they are asking deadly. There if you miss out here, no, every full answer is gone. Why? Because my calculation will be based on this. So if this goes, this also goes, full answer goes. Hope you are understanding. So average rate of tax in India 13,796 by 936 by 5,17,000. See the entire rate only will change off. Foreign income 11,000 deducted, 1,10,000, 10%. Whichever is lesser, this one. 2.696 on the what? Doubly taxed income. What is the doubly taxed income? 1,10,000. It is taxed both the places. So 2,966. 10,970. ATD allows a higher reduction of 50,000 in respect of medical premium paid to ensure the health of a senior citizen. She is a senior citizen herself. So that you will get here. Overall reduction in respect of A and B 50,000. Higher reduction for senior citizen. That's okay. But resident, this you will not get. See, some small point in reductions they asked in the exam. 3-4 times I have asked that question. Important. Right? So some general rules in computing this these areas. For example, I am in Kenya. I am getting a rent of 10 lakh, and let's say Kenya taxation laws allows 40% ad hoc. Standard deduction as is 30%, that is 40% assume. So 4 lakh. So I will be earning from my house in Kenya 6 lakh. Let's say 10% tax I pay 60k. So what is the tax rate in Kenya? 10%. In India, income from house property, how much I will take? 10 lakh. 30% standard deduction I will take 3 lakh. Total it will come up to 7.5 lakh. Let's say other income is around 5 lakh. Total 4.5 lakh. Total 12 lakh. Total 12 lakh. Tax on that, let's say it's coming up to 1,79,400. To compute all that normal. Average 1,79,400 divided by 12 lakh. Rate. Which rate? What is this rate? 1,79,400 divided by 12 lakh. 14.95%, which is lesser 10%. Now, what is the doubly taxed income? Is the doubly taxed income 6 lakh or 7.5 lakh? What is the doubly taxed income? 6 lakh or 7.5 lakh? What do you think? So guys, doubly taxed income is 6 lakh. No, here you are getting less deduction, but the taxation double it's happening on 6 lakh. So 60,000 is the benefit you will get. Doubly taxed income is 6 lakh. Important to know. Second, rent in the USA is 10 lakh. Municipal tax I'll pay 1 lakh there. Overall 9 lakh. In India, same 10 lakh. I mean, I'm a resident who owns a house there. There I'll pay tax on 9 lakh. Here I'm paying minus 1 lakh municipal tax minus 30% under deduction 2.7. Overall it is 6.3 lakh. What is the doubly taxed income? 9 lakh is doubly taxed or 6.3? Guys, 6.3. You should always take whichever is lesser. Easier if you want to remember. Right? Also, in USA, source is 10 lakh. 40%, let's say, is the thing that you will pay tax, 4 lakhs tax. In India, the same 10 lakh, the tax rate is less, 30% plus cess, 31.2%. So here you will pay 3,12,000 for the same income. So here the tax credit, also called as tax sparing. Tax sparing or tax credit is to the extent of what? Is extent to the amount of tax that I pay in my country, assuming it is lesser than what I pay abroad. Just because you are paying more there, you cannot claim higher amount. So always it should be whichever is less. And if you are paying less here and paying more here, I don't care. This amount you are paying double. So you have to pay, when that I will charge on that, is what it is. Very, very simple. Okay, let's solve 1 or 2 more questions and then we'll stop for the day. Question number 3. So Kamesh, individual resident in India, furnishes you the following particulars of income earned in India, country X, country Y for previous year 22-23. This was November 16 or 15 question. 2 times asked again, 2 times. For the period so and so, India has not entered into double taxation avoidance agreement with these 2 countries, 2 different countries. Ignore the provisions of 115 BAC, that obviously. They have given income from profession, agricultural income in country X, gross, Dividend income from incorporated in country Y, gross. Royalty income, literary book from country X. Expenses incurred for earning royalty. Business loss, rent, and all these things. Business loss in country Y is not eligible for set off against other incomes as per the law of that country. So what? I don't care. Within bracket IDC, I don't care. Idli, dosa, coffee and all, don't tell. South Indian people. It's a very good restaurant in Bangalore called IDC. Love it. They have very good idlis, dosas, coffees. Now I'm salivating. Okay, let's come back. Here IDC means I don't care. Business loss in the country Y not eligible for set off against other income as per law of that country. That country will live in this country, it's allowed. No. I should see what is doubly tax. Doubly tax will be whichever is less. There, if it's not allowed, I'll pay higher tax. Here, I'll pay less tax. So, doubly tax will be smaller component. Rates of tax X and Y are 10% and 25% respectively. Compute. You see, income from house property, house situated in country Y, gross annual value 2,40,000. Assumed to be paid in that country. Assumption you have to write 2,30,000 net annual value. Reduction 30%, 69,000, 1,61,000 I'll get. Profit and gains of business or profession. Income from profession carried on India 7,50,000. Business loss, I'll set off here. Income from other sources 50,000, 1,50,000. Dividend. Royalty income from literary book after deducting expenses 5,50,000 overall. This is overall 80 QQB. This is the total income in India. Total tax on that amount is 2,09,352. Now what is the working note? Average rate of tax 2,09,352 divided by 12,96,000 into 100, 16.15%. Average rate of tax in country X 10% given in the problem. Doubly taxed income is what in country X? Agricultural income 50, royalty income. Royalty income minus expenses minus deduction. Why? Because you should do it after all the deductions. You should take whichever is less. In India only it will be less. There you would have paid tax on 60,000. I don't care about that. So 60,000 minus expenses allowed here minus 3 lakh. This is the doubly tax portion. 3 lakh. Rebate will be what? 3 lakh into 10%, 30,000 rebate. That is one part. Second part. Doubly tax income with respect to country Y. Income from house property 1,61,000. Full income. I mean this one. Whatever after all the deduction, this one. Then dividend 1,50,000. Total this. Business loss set off in India, it's allowed. No. If I pay higher tax, I cannot help it. Should always be whichever is lesser. 2,46,000. So again 16.15% or 25%, whichever is less. So it's 16.15%. This much total rebate 69,729. That rebate you put it here. Tax payable rounded off so and so. Very easy. Got it, guys? Let me see if there is anything, or you can only solve. You can solve all these, guys, no tension, right? So that concludes our lecture on DTAA, only that one part. We have only done the unilateral exemption part. In the next class, we'll do bilateral exemption. Okay? See you. Please solve all the questions. Whatever is important I solve, please solve other questions without fail, please. Okay? Hello, my dear buddies. How are you doing? So let's begin today's session, my dear friends. In the previous session, what were we doing? We were checking the tax sparing, tax credit, and we started off with DTAA. In DTAA, we understood the unilateral exemption method. So today we need to understand, anyway, the other things are very simple. So now we will see, and we understood 91.1, if you remember, where there is no agreement. Where there is no agreement, we understood 91.1. So we were checking, if you remember, here, 91. When there is no DTA, what to do? SSC is resident in India, pays income tax in a foreign country, then we have to see whichever is lesser on the doubly taxed income. We understood this very, very carefully. There is, one more subsection 2, which is simple. I'll just show you the Bare Act itself. So let us say this 91.2 was specifically made for only Pakistan. Do you think India has a DTA with Pakistan, guys? We don't want to do anything with them. So it has got nothing to do, nothing, no DTA, nothing will be there. Yeah. So if you see here, if any person who is resident in India, so that this predominantly refers to undivided India, where Pakistan in the Sindh territory, of course, during the partition, people came this side, from here people went that side, whatever the case may be. So now, if I had any agricultural land in Pakistan and I had paid tax not as per the Pakistani Income Tax Act, but as per the agricultural income taxation rules of Pakistan, basically. So in that case, 91.1 will not come, because 91.1 clearly speaks about tax paid in Pakistan. Here it's not tax paid as per Pakistan Income Tax Act. It is the agricultural income taxation rules at the time of division, at the time of independence. So in those cases, what to do? There are many people who still have their roots in Pakistan, and many Pakistanis who still have roots in Punjab, Sindh area. So for that particular thing, a specific section, that's all, just we can quickly go through. I have not given it in the notes as it's not very important, but since it's there, I'm just doing it. If any person who is resident in India in any previous year proves that in respect of his income, which accrued or arose to him during that previous year in Pakistan, he has paid in that country by deduction otherwise, tax payable to the government under any law for the time being in force in that country relating to taxation of agricultural income. So it's not Pakistani Income Tax Act, but Pakistan has some rules relating to taxation of agricultural income. So predominantly that he shall be entitled to deduction from the Indian income tax payable. So this is only for Pakistan, only restricted to that. How much amount of tax paid in Pakistan under any law aforesaid on such income which is liable to tax under this act also, and of a sum calculated on that of the Indian tax rate, whichever is less. So same thing, guys, no change. Whatever you paid, not Income Tax Act, it is as per the Agricultural Land Tax Act, correct? So I don't know the exact name of the law there, but there is a law for agricultural land taxation. There it is taxed, correct? Here it is not. So here on other income, etc., you will pay some tax. There you will pay tax there. But the thing is that particular land outside India will be taxed here, obviously, right? Only agricultural land in India is not taxable. So global income is taxable for a resident in India. So for that portion only, it will be done. That's the same concept only, but that's how it is, right? So that is regarding this one small thing. It is immaterial, but leave it. Now, right. Let us now understand section number 90, guys. Agreement with foreign countries where there is DTA. The CG may enter into an agreement with any foreign government or specified territory outside India. Now, hear me out for some time, for 5 minutes. So, yes, there are certain tax havens, my dear friends. Tax haven is a place where there is no taxation. Basically, there is no concept of taxation there. You have your Cyprus, you have your Cayman Islands, British Virgin Islands, like that many tax havens are there. So I told you before also, just before doing equalization levy in direct taxation, I gave you these basics. So what they did, all the countries, lot of golmaal was happening, lot of tax evasion was happening. So all the countries came together, the big 20 countries, G20 came together, and they started the OECD. They started the OECD, the Organization for Economic Cooperation and Development, OECD, is what they started. And now OECD has spread to across 120 odd countries with 400 employees, constantly seeing which country, which person is doing this, is sending money to tax havens, etc., and all those things. Because from the country where it is taxed, instead of that, it is being shifted to other countries. So what is happening to the base country's tax, the base of taxation money that I have to receive, it is getting eroded. Correct? So it's called base erosion. And of course, the entire profit or the money that the revenue has to get, it is being shifted. Profit shifting. So this is the concept of BEPS. What is happening is BEPS, base erosion, profit shifting. In your paper 6C, which speaks about international taxation, you have under BEPS in each country there is an action plan. So in that paper 6C you should study that action plan also. Thankfully for paper 7 you do not have. So under this action plan there is one plan which talks about double non-taxation. Bro, double taxation I've heard. What do you mean by double non-taxation? Basically, this double non-taxation happens at when there is no tax at both the places. No tax in both the places. For example, earlier dividend was not taxable in India. So let's say in Germany also dividend is not taxable. So basically, this is double non-taxation. Or in one country rate is more, one country rate is less. Then also they are doing. Like for example, I'll give you. Let's say a person in India earned some, what do you say, royalty from UK. You wrote a book and you are earning, you're selling across India, you're earning some royalty. Now royalty, let's say as per the UK DTAA, you have to pay 10%. So UK person has to pay you, and for you obviously 10% it is taxed. It is taxed at 10%. Instead what I will do, instead of money coming from the UK, I will figure out, let's say Germany. I'll open a shell corporation, or also called post box company, one scam company. I'll open a shell corporation, shell company, or a post box company in Germany. And from Germany, I will transfer the money to India. And this, my dear friends, is just 5% taxation. So what people started misusing the treaties like this. Misusing the treaties. They started left, right, center misusing the treaties, which was 100% wrong. So wherever it was 10%, here also the percentage was there, 10%. Rather than this equal, what to do? Let me do double non-taxation or double under taxation. How I'll do double under taxation, my dear friends? I will coolly go to one more country where royalty taxation is 5% and where I will open a sham company or a post box company and divert everything through that. So this was definitely golmaal being done. So what happened was, there were something called multilateral instruments. To curb this from happening, this is double non-taxation or double under taxation, multilateral instruments, MLI they are called, they were signed by almost 106 countries. And this is power to automatically change the DTAA. Because guys, if I want to change DTAA, it's a long drawn process. So people knew that and were doing this golmaal. Correct? So to even imagine DTA is for your benefit, then that also golmaal they were doing. First of all, DTA will provide less taxation for you. That also I don't want to pay. Golmaal fellows. So they started off with multilateral instruments. Multilateral instruments whereby 106 countries have signed. automatically you can change the DTA. This, whatever they were doing, no, from UK jumping to Germany, Germany to UK, maybe if some other countries 3% jump there also by opening sham companies. The technical term for it is called treaty shopping. Treaty shopping. So they signed this entire thing saying that no, treaty shopping has to be stopped. And they said, let us change the DTAA by entering into one more thing called CTA, covered tax agreements. These things are not there in paper 7, but you need to know. Okay, CTA, covered tax agreements they made. And they also made like an opt-out scheme. If you don't want to enter into this scheme, you can opt out anytime, no problem. Then one more, if you want to come inside later, ratification scheme. All these they brought in, my dear friends. All this they brought in. Hence, this double non-taxation, etc., was applicable from 1/4/2020, right? As per the multilateral instrument signed by 106 countries. One of the terms and conditions of that particular multilateral instrument was saying that tomorrow there will be a lot of litigation. Income Tax Act is silent about double under taxation, double non-taxation. But multilateral instrument is talking about double non-taxation should not happen. So these 106 countries agreed that 100% tomorrow people will start litigation in this area also, saying that multilateral instruments will not apply to Indian Income Tax Act and all those nonsense will come. So one of the terms and condition of that multilateral instrument was what? To amend the Income Tax Act of the respective country. Each country in this 106 countries had to do what? Amend their income tax law. And because of this, my dear friends, Nirmala Aunty amended in Finance Act 2020. Amended section 90 to also insert not just double taxation, to also insert provisions for double under taxation or double non-taxation through the technique of what? Treaty shopping. Come on. Superbly you have understood, I know. Fist bump. Awesome, guys. Awesome. So let's read Nirmala Auntie's memorandum. Why she inserted this particular clause. Yes, download it. Check it out. Aligning the purpose of entering into double taxation avoidance with multilateral instrument. I told you now, MLI. Section 90 of the Act empowers the central government to enter into agreement with foreign countries or specified territories. We'll come to that. All this granting relief, avoidance of double taxation, and all these things. So Section 90A also talks about central government, that is for foreign government companies. Now you see this, see this, understand this. India has signed multilateral convention to implement tax treaty related measures to prevent base erosion and profit shifting. BEPS, also called as MLI, along with representatives of many countries, has been since been ratified. India has deposited the instrument of ratification to OECD Paris along with its final position in terms of CTA. Reservation, option and notification under MLI, as a result of which MLI has entered into force on 1st October 19. The provisions will apply from 2021 onwards. The MLI is an outcome of G20 OECD project to tackle base erosion and profit shifting. Tax planning strategies that exploit gaps and mismatches in tax rules to artificially shift profits to low or no tax locations where there is little or no economic activity, resulting in little or no overall corporate tax being paid. The MLI will modify India's DTAAs to curb revenue loss through treaty abuse. Brilliant. Treaty abuse is nothing but treaty shopping. And base erosion and profit charges by ensuring that profits are taxed where substantive economic activities generating the profits are carried out. The MLI will be applied alongside existing DTAs, modifying their application in order to implement the BEPS. So if you see, intending to eliminate double taxation with respect to the taxes covered by this agreement without creating opportunities for non-taxation or reduce taxation through tax evasion or avoidance. including through treaty shopping arrangements aimed at obtaining reliefs provided in this agreement for the indirect benefit of residents of third jurisdictions. See, went to Germany and did 5%. That I will stop. In order to achieve this, 90 subsection 1 has to be amended to also include which one? The same text as provided in MLI. So that dialogue has been inserted in this particular section. Now you see, you will understand, guys. Important. Page 11.1. Page 11.1. Page 11.1, section number 90. Agreement with foreign countries or specified territory. Specified territory here are those special administrative regions which are governed by some other countries. For example, Bermuda. Not Bermuda Cheddi, guys. Bermuda. Bermuda is what? A British overseas territory. Then British Virgin Islands, British territory. Cayman Islands, British territory. The Gibraltar is a British territory. Guernsey is a British crown dependency. Isle of Man, Islay and all, don't tell, guys, please. Right? Islay of Man and all, don't tell. Correct? This is Gibraltar. You know, these UK fellows, if you go to them, it's Gibraltar. Gibraltar. We will tell Gibraltar. Gubal. In Kannada, Gubal means it's a bad word. Okay? Yes. Gibraltar and all, don't tell. Bermuda. Not other Bermuda. Okay? Then British Virgin Islands, Cayman Islands, Gibraltar. Okay? Then you have this Guernsey, Isle of Man, Jersey. Jersey is also British Crown dependency. Netherlands, Antilles is one more thing. Then Macau. Macau is by China. Hong Kong, China. Correct? And Saint Martin, not Saint Martin. Saint Martin, that is also, these are all some of the examples of what? Notified territories, specified territories. With these, DTA will not be there. Why? DTA is between two countries. This is not even a country, it's a special administrative region. So with them, no, we will have something called as tax information exchange agreements. Tax information exchange agreements will be there. Or assistance in collecting tax, ACT, not Act Broadband. Correct? It is assistance in collecting tax. And tax information exchange arrangements with these specified territories will be there. Giving credit relief and all this. Basically, asking them, please, explain what is the source, where it happened, etc. First, for granting relief in respect of income on which income has been paid, both under the Income Tax Act and income in a foreign country. This is what DTA will provide credit relief. Credit relief. Next, income tax in India under the corresponding law in force or specified territory to promote mutual economic relations, trade and investment. So here you will give, exemption. Either you will give credit or exemption, whatever. Then of course, this is that Finance Act 2020 which we discussed now. For avoidance of double taxation without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements aimed at obtaining in the said belief, etc., whatever, in any other territory. So very simple, guys. What is the scene here? How to do that? I mean, I just here, if you see UK and Germany, no, Germany 5% it's coming means India will ask, bro, according to me it should come from UK. You have opened a shell corporation in Germany. Please give me the residency certificate. You should have something You should have all the filings, all the details. You please give me that. Once you give me that, I will not ask any question. If you have opened a sham company, obviously you wouldn't have filed anything. So I will not allow. I have details with me that it is a UK company. You are telling it is Germany. Fair enough. Please give me the entire history, residency status, filings you give me. I will not ask one question also. I will pass at 5%. I'll allow. If you don't give, that was what was decided in the multilateral, instrument. You see, or what else? For exchange of information. This one, Chidambaram had once told when he was the finance minister, he had told all Swiss banks and all the thing in the Cayman Islands, you please disclose all the information. That is this one only. I told you, no. That is your assistance in collection of tax and also the tax information exchange agreement. He had invoked exchange of information for the prevention of evasion or avoidance or investigation of such cases, because I need to investigate the cases. Many such cases were opened up, and I remember even this fellow had gone in jail, gone to jail, Amit Shah, during that time. Amit Shah returned the favor once he became Home Minister, and he sent Chidambaram inside in the INX media trial. If you have observed politics slowly, all this you will understand. Politics is not just politics. It has much, much more. To understand and link, you will remember. For recovery of income tax and may by notification make such provisions as are necessary for implementing the agreement. Very simple. How to recover? This is, Vijay Mallya will be in UK. So can I take over his assets? Yes. All those things, provisions will come here. Same thing. Royalty, then it will be beneficial to, and ultimately what should I tax, guys? Whichever is more beneficial is what I should tax. Very, very simple. Subsection 2, I'll show the Bare Act. 90 subsection 2. 90 subsection 2 says, please tax whichever is beneficial. I've told you already. Only whichever is beneficial I should do. Whichever is more beneficial. So here 92, where the central government has entered into agreement with the government of any country outside India or specified territory outside India as the case may be, under subsection 1 for granting relief of tax as the case may be, avoidance of double tax, then in relation to assessee to whom such agreement applies, provisions of this act shall apply to the extent they are more beneficial to the assessee. Whichever is more beneficial we have to obviously follow. Generally both are same, then that's what, whichever is more beneficial is what we need to check. That we have already seen. That we have seen. If you see in module number 1, we had seen one thing. Page 19.4 in module 1, my dear friends. We still haven't done this, GAR. I told you that time when we were doing this tax planning, etc., I told you that it will be connected with international taxation. GAR 19.4. You see this. South Africa, India. Right? You see this condition. Under the provisions of DTAA between India and South Africa, any capital gains from sale of shares of Bokaro Plants Limited, an Indian company. Bokaro Plants Limited is an Indian company. Nani Incorporated is a company in South Africa, it has a wholly owned subsidiary 1, wholly owned subsidiary 2. And that wholly owned subsidiary 1 has 9.5% in Bokaro plants. This second company has, this is wholly owned subsidiary 1, wholly owned subsidiary 2, 9.5% it has. As per the DTAA, any capital gains arising from sale of shares of Bokaro Plants Limited, an Indian company, would be taxable only in South Africa if the transferor is a resident of South Africa and holds not more than 10% of equity capital of Indian company. If this transferor holds more than 10%, then it will be taxed in India. So the rule is, if Nani Incorporated has more than 10%, then taxed in India. Less than 10%, taxed in South Africa. South Africa is less rate. India, more tax rate. Now, in this DTA also, they did Golmaal. What Golmaal they did? Nani Incorporated opened 2 sham companies, wholly owned subsidiary. And through their wholly owned subsidiary, they held 9.5. No other business was done by wholly owned subsidiary. It was just an instrument to hold less than 10% so that taxation can be done in South Africa only. Ideally, 19% everyone ignored. 9.5 plus 9.5. Instead, what they are saying, they are doing it through 2 companies. Nani is telling, no, I am holding only 9.5 in one company. I am not holding anything. This company is holding. Even in DTAA, they started doing Golmaal. That's why government came out with GAR, General Anti-Avoidance Rules. And very simple, GAR provisions will override any DTAA, as simple as that. GAR will override DTAA. Sir, where is that, sir, in the Bear Act? Here, sir. Inserted from 2016. Finance Act 2013, sorry. But with effect from 2016. Notwithstanding anything contained in subsection 2, provisions of chapter 10A, GAR, shall apply to the SEC even if such provisions are not beneficial to him. GAR will not benefit him, no. GAR, what is it telling? It's tax in India. Is it beneficial to him? No. But it's overriding. That's why it's overriding subsection 2. Subsection 2 says beneficial. Notwithstanding anything contained means what? Subsection 2A overrides subsection 2. And what is chapter 10A? GAR. GAR overrides DTA. So come back to our notes. Your understanding, guys, very easy. Here you see. Very simple. Got it? Yes. So we had done all this here, guys. Moving on, I told you, know, if you are trying to play around with the rates, etc. If you do this treaty shopping, etc., there is, of course, one more section where I told you, no, you have to do the tax residency certificate you need to produce. Now that is again given under this subsection 4. Inserted in 2012 itself. An SSE not being a resident to whom an agreement referred to in subsection 1 applies shall not be entitled to claim any relief under the agreement unless a certificate of his being a resident in any country outside India is obtained by him from the government of that country or specified territory. So normal DTA also you should give the tax residency certificate, and more importantly, if you are doing through that Germany, etc., tax, under tax, double taxation where it is under tax paid or no tax paid. In those things, of course, you need to produce a tax residency certificate. Tax residency certificate, that's very, very clear. Next, if you see explanation 1. Explanation 1. Before that, general rule in DTA. In DTAA, here. This we have done now. Yeah, if you see, one clarification came, the TRC produced by a resident of a contracting state will be accepted as evidence that he is a resident of that contracting state, and the IT authorities in India will not question the TRC or the other residential status. You please produce the TRC, no questions asked. No questions asked. A non-resident SSE in form number 10F shall also provide the following particulars: name and status of the SSE, nationality in case of individual, country or specified territory for incorporation or registration in case of others, tax identification number or unique number in country or specified territory of which SSE claims to be a resident, period for which certificate is applicable, everything, address of the SSE in the territory. If such information is already collected in the TRC, information need not be furnished separately. Generally in the TRC, all this information will be given. It will be given, all these things will be given, no tension. Now, so general rule guys, general rule, non-discrimination clause. Rate of tax on foreign company shall not be less favorable than rate of tax on domestic company. This is what generally in all DTA it will be written, saying that if the rate of tax on foreign company, let's say for the same business in India, for domestic company it is 30%, and foreign company doing all those businesses, let's say it's coming up to, and as per DTA, you're earning income in both the places. So in foreign income here is 40%, and the same tax abroad for them will be 35%. So for the same income. Now the problem is under DTAA, how much will you pay? Ideally, whichever is beneficial, 35%. Is it less favorable or not less favorable? It is the same. No, either only I should have paid less only. So rate of tax on foreign company shall not be less favorable than rate of tax on domestic company. Generally, what they are trying to tell is you should always give the benefit of DTAA to companies, foreign companies. Now, what used to happen? What used to happen? In India, it is 40%. Let us say this is 42%. In India, it is 40%. But some courts, what did they do? Is it 42 or 40? Which is lesser? 40. I will charge 40. Some courts, what they did? They saw this line. Rate of tax. This is a non-discrimination clause written in DTA. So when they were reading the DTA, they saw rate of tax on foreign company shall not be less favorable than rate of tax on domestic company. What they charged? Rate of tax on foreign company is 40. Rate of tax on domestic company is 30. Those they started charging 30%, guys. Government said, bro, if that be the case, most countries I have DTA. Okay, if you come and earn in India specifically, I'll charge that 40%. Okay. But if there's double taxation, I'm giving you 40% benefit. No, why are you comparing domestic company rates and this 40%? Because of the wordings of DTA. If you feel that whatever we are doing is crap here, think again. Let's see, question. Exam question, guys. I just opened it online, some study cafe, it seems. Ignore that, but one second, let me also check if it's there. Yeah. Page 12.11, important. Q&A vault. Cosmos Limited. Cosmos Limited, company incorporated in Mauritius, has a branch office in Hyderabad, opened in 2018. Indian branch has filed return of income for assessment year 23-24, disclosing income of 50 lakhs. If paid tax at the rate applicable to domestic company, 30% plus education cess, etc., as per paragraph 2 of Article 24, non-discrimination clause, reads as below. Taxation on a permanent establishment, which an enterprise of a contracting state has in other contracting state. Taxation on a permanent establishment, which an enterprise of a contracting state. Mauritius only, no? As in other contracting state, India, shall not be less favorable levied in that other state, India, and the taxation levied of enterprise of that other state, India, carrying on the same activities. However, assessing officer computed tax on Indian branch at the rate of 40%. Foreign companies 40% only. Domestic taxation is 30%. Let's say in Mauritius it's 42%. What should I use? 40%. Correct? No. But because of this clause, they were claiming 30%. AO charged at 40%. Under section 90 subsection 2, what does it say? Where the CG has entered in an agreement for avoidance of double taxation with a country outside India, then whatever is more beneficial to the SSE. Out of 42 and 40, what is beneficial? 40. Over and top, above that, I should read the DTAA. In the DTAA, it is trying to tell 30. In view of paragraph 2 of the Article 24 of non-discrimination clause, it should be 30%. Government couldn't take this. Same question is also there in November 18. Copy paste, 4 marks. It's T incorporated case. Copy paste, name change. Show you. See, 3 marks. Same, no change. T incorporated non-resident employment has permanent established in India. Same 30%, 40%, same. No change. They couldn't take it, my dear friends. Explanation 1 was added. Brilliant explanation. For the removal of doubts, they are telling, bro, cheating. It is hereby declared that the charge of tax in respect of a foreign company, 40%, at a rate higher than that at an Indian company. It is hereby declared that 40% which you charge for a foreign company at a rate higher than the rate at which domestic company is chargeable, 30%, shall not be regarded as less favorable in respect of such foreign company. They said, bro, Don't compare 40 and 30. Compare 42 and 40. And even if I am as a domestic company paying 30, that is for my Indian company benefit I will give, no. For you I am giving benefit between the two. Why are you comparing between us now? Then what is the point? Foreign companies will come to India and pay 30%. Brilliant explanation. Shall not be regarded as less favorable charge or levy of tax on foreign income, which means what now? Because of this explanation, how much will you charge? 40%. You see here? Explanation 1 to section 90 clarifies that the charge of tax in respect of a foreign company at a rate higher than the rate at which domestic company is chargeable shall not be regarded as less favorable charge of levy of tax in respect of such foreign company. Therefore, in view of this explanation, action of the AO is levying tax at 40 is in accordance with the law deadly. Got it, guys? Similar example also is given there. You read. That is what it is. Deadly. Then you read 90 subsection 3. Any term used but not defined in this act or in the agreement referred to in 91, that is DTAA, shall, unless the context otherwise requires and is not inconsistent with the provisions of the agreement, have the same meaning assigned in the notification. They are saying if some terms and conditions etc. are not defined in the act also, not in the DTAA also, they said notification will release. Based on that notification, you should go ahead. DTAA is entered into by two countries in 2005, assume. Notification came in 2020. Will it be used retrospectively or prospectively was one more question after this section came. Does it mean only from whenever from 2020 only the notification will come, or previously also I should take? What is the question? What is the answer? So here you see. For the removal of doubts, it is hereby declared, explanation 3 and 4. This was all came when? 2012. See the retrospective effect they made. The removal of doubts is hereby declared that where any term is used in any agreement entered in the subsequent is not defined under the agreement but assigned the meaning in the notification. Meaning assigned to such term shall be deemed to have effect from the date on which the agreement came into force. So even though the notification, if it comes in 2020, it is deemed to come to effect from which date? 2005, the day when the DTAA came into force. Again they are telling, if it is hereby declared that where any term used in the agreement is defined under the said agreement, the said term shall have the same meaning assigned to it in the agreement. And if it is not defined in the agreement but defined in the act, it will have the same meaning as defined in the act, plus the explanation whatever is given. So to summarize, come to this. Full summary is there. Term is defined, page number 11.2, point number 4. If the term is defined in the agreement, meaning as assigned in the agreement should be taken. The term is not defined in the agreement but defined in the Income Tax Act, meaning as assigned in the Income Tax Act plus any explanation given. Term is neither defined in the agreement nor in the act, it will be in the notification. And the notification will be coming into force from the date the agreement came into force. Very, very simple. Very, very simple. This 6 also done. Specified territory association, all you can go through. Specified association means notified institution, etc. Of a specified territory outside India. The CG has notified India Taipei Association in Taipei, the Taipei Economic and Cultural Center in New Delhi as a specified association. Guys, section 90 capital A is copy paste section 90 only, no change. Section 90 capital A is the same. No change. Copy paste. United States banned Indian ghee, cow ghee. United States also banned import of basmati rice. Because when they were selling their pulses to India, we were charging 200% import duty. Because we have our own spice, our own produce anyway, pulses, etc., in abundance. Rice, anyway, we are exporting, but other pulses are in abundance. You would have seen no tomato and all vegetables they throw poor farmers because they don't have a market sometimes. So what I'm saying is, when the US banned, basmati rice, and even now US has banned cow ghee. In Canada, normal milk is not allowed, exported, because they produce their own stuff. So they issued sanctions, etc. Then diplomatic relations went haywire. They are telling, boss, we are not charging any tax, you are charging tax there, nonsense. Why the hell should we pay? If you remember when this stupid fellow came, what's his name? That joker. What's the name of that guy, guys? It was tip of my tongue. Come on. Donald Trump. Donald Trump. This fellow, when Narendra Modi had gone to USA, that Howdy Modi event had happened. And he had come over to India. Namaste Trump event was organized. Correct? Modi had told, no? Here is India's friend, my friend, President Donald Trump. It had become a meme. Do you remember? It became Donald Trump. Correct? It was in response to that stupid fellow, Donald Trump. For Swami Vivekananda, he said, Swami Vivek Mannan, it seems, stupid fellow. Virat Kohli became, Sachin Tendulkar became, all those things. That's why Modi, fulls, swag level. President Donald Trump. So, ties. They said, bro, leave bro. We will open one US seed corporation. We will open an Indian seed corporation. Let's do import-export without any taxes. That agreement cannot come in 90 because, it is, what do you say, not companies. They are central government undertakings. So to cover those things, 90A has come, that's all. Specified Association of India can enter into an agreement with Specified Association of foreign country. That Specified Association only, this I told you, see. There is a specified association in, for example, that Taipei. Here only, where did it go? Here only, sorry. Taipei Economic and Cultural Center in New Delhi, a specified association. And India Taipei Association in Taipei is an association. Like that, in very many other countries, they have. Example, I'm giving that, so. They can adopt such agreement. DTAA provides a particular mode of computation of income. Same should be followed respective of the provisions. They'll give the mode of computation of the income as well. In case of conflict with IT Act and provisions of DTAA would prevail over the IT Act. PVAL Kulandagan Chettiar case. Provisions of section 90 would prevail over 4, 5, 9, etc. Even when a business connection is established, profits of the company could not be taxed. The same is specifically exempted. Wherein income is not taxable as per income tax law, then one need not look into DTA. When income is taxable as per income tax law, one has to verify whether such income is taxable in India as per DTA. If such income is exempt as per DTA, it shall not be taxable. Same, Azadi Bachao Andolan. The general rates applicable under Indian law shall be further increased by surcharge, whereas DTAA, it will not be further increased. It we have seen already. Both are equal, better to follow DTA, because DTA will not add any of those things. That is 90A. This page number 11.4, permanent establishment, important. Keep asking in the exam. Permanent establishment. So permanent establishment, this is as per Article 5.2. Excuse me. Article 5.2 of the DTAA, any convention if you see, they have defined permanent establishment. Generally in all the conventions, DTAA conventions, this dialogue will be there. What is permanent establishment? Means a fixed place of business through which the business of an enterprise is wholly or partly carried on. So permanent establishment is place of management, branch, office, factory, workshop, mine, quarry, any other place of extraction, even a place of management, even a hotel room as I discussed will be this. Guys, for royalty, fee for technical services, for royalty, fee for technical service and all those interest stuff that we discussed. Whether there is P, whether there is no P, if you remember, it is a source rule. We saw for royalty 44DA, if there is permanent establishment, we saw. Even if 44DA is not there, whether you have permanent establishment, no permanent establishment, always taxable under different rates. You have 115, you have that royalty, or that 115 series you have seen, no? Because it is earned in India, deemed to occur as in India. Right? But the question will arise for incomes, business incomes other than these. For business income other than these, we have one which is permanent establishment. And one more under 911, we have that business connection. What is wider, business connection or permanent establishment? Obviously, business connection is wider. Business connection is wider. So, as per DTAA, generally it says, for other income, see royalty, fee for technical services, interest and all, leave it. For other business income, for other business income, if there is permanent establishment, all the profits that is attributable to that permanent establishment will be taxable. For example, 44DA we have seen. However, as per the Income Tax Act, Section 9 says, if you have a business connection, then the profits will be taxable. Profits will be taxable. See, one rule is very simple. If a permanent establishment is already there in the country, automatically business connection will be there, no? Obvious. Obvious. Hence, taxes, you have to pay tax. But the interesting part of the story is, if business connection as per Income Tax Act is there, but you don't have any permanent establishment, then generally there will be no tax. Because ultimately permanent establishment has to be there in India. Confusion was arising. Confusion was arising. That's why with respect to DTA and read with 911, the rule was framed in the section and various cases. As you see here, the DTAs provide that business income of a non-resident or foreign company received from India shall be taxable in India only if the non-resident or foreign company has a permanent establishment in India. The profit attributable to such PE shall be taxable in India. The DTA therefore provides that a non-resident or foreign company does not have a PE in India, income earned in India is not taxable in the hands of non-resident. Is the general rule in all DTA. If you have PE, then you have business connection, then taxable. If you don't have PE, no business connection, not taxable. Even though it may be business connection as per 911, it is not business connection as per DTA. Because we are doing DTA now to compare both. Whichever is more beneficial to SSE, obviously it'll tell was no business connection because no PE. But as I told you, this rule will apply to all kinds of business except royalty, FTS and interest, because for this P is immaterial, separate section for this. Even DTA separate stuff is there for this. So for P is immaterial for that. Other business income. However, 911 talks about business connection which is more wide in nature. Wide in nature. So, position as per 911. This is for income excluding royalty, fee for technical services, then interest. Royalty, fee for technical services, interest. Income arising to non-resident or foreign company from India. If there is DTA, what to do? If there is no DTA, what to do? If there is no DTA only, very easy. There is no DTA between two countries. If there is business connection under 911, then income is taxable in India. If there is no business connection, income is not taxable in India. Confusion of PE will never come. Why will confusion of PE come? Because in DTAA it is written, if PE is not there, no business connection. Come to this. There is PE in India, there is no PE in India. No PE, income is not taxable as per DTA. If there is PE, income is taxable as per DTA. Even if there is a business connection but no PE, 911 shall not apply since DTA provides that income is not applicable. Beneficial thing. Very important chart. No DTA, PE, that dialogue will not come. So in no DTA sin, if business 911 will apply. Business connection, pay income tax. I don't care whether PE is immaterial here. The P concept comes only in DTA. But if there is a DTA, one more question is what? P, is it there or not? No P, no tax. I don't care if business connection is there. No P, no tax. That's all. If there is P, then tax. Important. That is regarding P. We'll come to this. Guys, let us say you have stayed in India for 182 days. You have a business in Singapore also. There also you have stayed for 183 days. You are a resident here also, resident here also. What will happen? What will you pay tax? Where will you pay tax? In which case are you a non-resident? In which case you are a resident? Both the laws say to stay for minimum 182 days. You have stayed both in 182 days. Let's say it's like a leap year, 183 you have stayed. What to do? Singapore says 180 days you should stay for residency status. Here you have stayed for 182 days, 181 days, whatever it is. What to do? That's why there is something called as a tie-breaker rule. Tie-breaker rule. Come to page 15.2, this one. This is the model tax conventions. It's like a checklist. More in depth in your elective paper. Here 2 to 3 marks, sometimes more for paper 7. It is always part of the OECD model, Organization for Economic Cooperation and Development model. It will be there. You see article number 2. This convention shall apply to taxes on income and on capital imposed on behalf of contracting state and political subdivisions and all these things. Sorry, not this. Residence, tiebreaker rule. It is possible that a person in case of individual is resident in 2 contracting states as per domestic law of that law. So this applies in the following sequence. First is I should check state of permanent home. Where is your permanent home? Where was your ancestor? Where is your house where you generally stay? You may be traveling, but where do you stay? Let us say in both the places you have a permanent home. Then second test. Center of vital interest and personal interest. Where are your businesses? Where do you have your house? Where do you have your family? Let's say I have two families. Here also, there also. Some of our ministers have no one area, one. Then I should go the next part. Habitual abode. For business of a pleasure, where do I spend slightly more time? I should sit and analyze. Habitual abode. Habitual, by reason of habit, where do you stay? Both places I stay. I have to give equal importance to both my wives. Both my wives don't know that I have one more girlfriend also. Then next, nationality. Are you an Indian or are you a Singapore citizen? Sir, I have dual citizenship, sir. Nirmala auntie will say like this. Put one Sastanga Namaskaram. Like, bro, first I asked for permanent home. You said 2 homes. Then you said vital interest. Sir, I have interest everywhere. Here also wife, there also wife. Okay. Habitual abode. Where do you spend more time? Both are equal. All is fair in love and wives. Fair and square. That also gone. Nationality. I am pan-national everywhere. Nirmala auntie will say, you do whatever you want. Means, you do 2 countries, I am not going to, I'll go away, I'll run away. Mutual agreement between competent authorities of the contracting state. They'll put 2 ministers, 2 whatever, officers, you do whatever you want. Only if the tie is not resolved in the first criterion, then the second criterion shall be applied and so on. Competent authorities. See, as per the facts of this case, the SSC has permanent home both in India and Malaysia, and therefore one should look at the place of vital economic interest. While he had business activity in India, there was no business activity in Malaysia. There was no business activity in India. Therefore, center of vital interest is Malaysia. He should be treated as resident of Malaysia. In India, non-resident. That's what. PVAL Kulandagan Chettiar. I told you already before. See, this is the tiebreaker rule. Sir, like this and all in exam, they will not ask. Sir, like that and all, you should not think. This is Bangalore lingo. This and all, that and all. What and all will come in the exam, sir? Everything and all will come, sir. I am not joking. This is Bangalore lingo I am teaching you. Here 6 marks, deadly. Every jurisdiction in the domestic law prescribes the mechanism to determine residential status of a person in case the stupid study cafe, it seems. Can't see only. A person is considered to be resident of both contracting states. It becomes necessary to apply the tiebreaker rule. Discuss the manner of application. Full whatever I explain now, you should explain. 6 marks. So guys, they keep asking. You cannot say they don't ask. Come to compiler. 12.12 Q&A vault. Question number 10. Important. Arif is a resident of both India and other foreign countries in the previous year. He owns immovable properties, including residential house in both the countries. He earned income of 50 lakhs from rubber estates in foreign country. In the financial year, he also sold some house property situated in foreign country, resulting in short-term capital gain. Arif has no permanent establishment in India. However, his derived rental income of 6 lakhs from property let out in India. House in Lucknow also where he stays. Article 4 talks about this individual thing, rent of vital interest. You are required. In this case, guys, both he has. But since he has a business, a rubber estate, from which he got capital gain, hence it should be treated as foreign country. Residential house I have both. Thus he has a permanent home in both. However, has no permanent establishment in India. DTAA with foreign individual resident of both the countries, deemed to have resident in which he has permanent home and economic relations. He owns a rubber estate in foreign country. Therefore, personal and economic relations with foreign country are closer. Hence, property is located, P is there also. Same case, PBAL Kulandagan Chettiar. So, in order to claim the relief, what should I ask from him? TRC, tax residency certificate. And then see how they are asking 6 marks. This also recently asked in the exam. I have not given which exam and all everywhere because simply you will see that then you will superbly think. November they asked, bro, May they will not ask. All that, that's why I removed. I consciously removed it. All these are examination questions, RTP, MTP questions. You need not know from when it came. Study everything. Please solve this full book of 600 and whatever 30 pages and let's see how you will not get 70 plus. Open challenge. How you will not get 60, 65 plus. 70 plus little bit extra in it. Okay, 65 plus. How you will not get, I'll also see. Sir, I got 32. Then I'll say next exam you'll get 40. 70 plus over. Not like that. You will get. Okay, don't worry. Study properly, guys. You'll get. Why won't you get? 100% you'll get. Come to module 1, guys. Y13. If you remember, this one part we had not done. And I told you, we will do it when we reach international taxation. God only knows when you remember, but I remember. Wherever we have missed out important things, we will come back. Wherever I have not done those other things, they are not very important, you can go through. That's the simple logic. Wherever it is really important, and I have told you some other time that we'll come revisit it later, I will revisit. Wherever, we have missed certain small things I would have not done, that is homework. That is nothing, you can aramse read it. But guys, we'll cover everything, don't worry. Almost everything will be covered. So, in this case, basically guys, you are a resident of India, okay? And you did business in the United Kingdom and you earned, let's say, 5 crore in the United Kingdom. Tax was some 5 lakh. You didn't pay, you ran away. You are now coming to India. Can the UK fellow, and you have your TRC, everything, UK person, government will prepare a tax demand, 5 crore, no sorry, let's say you had a property of 5 crore, no 1.5 crore is the tax. They will prepare 5 lakhs and all, they will not come. 1.5 crore, they will send one notice to India and they will say, sir, please do the needful. So basically, the demand of 1.5 crore will be sent by the UK government to CBDT. Recovery. Inter-country recovery. I need to see whether that SSE has a property in India. There is a property in India. If yes, the tax recovery officer having jurisdiction over that particular property will make the recovery. Let us say he has no other property in India. So actually there was no recovery before, not possible. In 2019, because of the Black Money Act and so many things, there were all DTAs were amended, where, like, for example, even Vijay Mallya is outside, I can go recover from there. Now what happened? It is allowed. TRO having jurisdiction over the SSE can make recovery through other means. If property is not there, so what? I will now check. I will open the Benami Transaction Act. What if you have given your property to your wife or your friend or whatever? Let me figure out. Investigation is on. This is a very small amendment but important amendment. That is 288 capital A. In module 1, page Y13, we had left it. Where an agreement is entered into by the central government with any foreign government for recovery of income tax. For SSEs resident in foreign country or having property in foreign country or deemed to be in default, TRO can forward certificate to CBDT. And CBDT shall take needful action with the direct tax avoidance agreement. They will talk to them. Reverse. For SSEs resident in India or having property in India which are deemed to be in default, CBDT will receive a certificate from foreign government and then they will do the needful. Can you see tax clearance certificate? Should give this if he is domiciled in India, all that we have seen. How to recover and all we have seen here in this advanced tax portion only we had seen. See, attachment of sale of property, immobile property, arrest of the person, all this detention and all you can do now. I can arrest that person. This 222 will happen here. Earlier there was not possible. Now they have amended. Small amendment. Okay. On that note, enough for the day. Enough for the day. Next class, very, very important class. We will discuss the Vodafone case. The what happened in Vodafone case, why the law was amended, what all was amended, what are the tax implications. Extremely interesting, very important case. After, when this class is over, next class. Okay. See you guys. Take care. Love you all. Bye. Hi, my dear buddies. How are you doing? So guys, today's session, very important. We will be discussing the Vodafone case law, the case of indirect transfer. Okay. So kindly concentrate. Many questions will definitely come, has come before, will be coming. And either way, it is very important for us to understand the entire deal. So this was like a landmark legislation which changed the course of taxation, especially the foreign taxation. So it was extremely important to understand what this entire thing was. So let's go ahead and understand. So guys, very, very simple. There was this company, Hutchison Telecommunication International Limited. So please come to page number 8.1. I'll explain the case law and then we can go ahead. Okay. So there was Hutchison Telecommunication International Limited, HTIL. It was a foreign company registered in Hong Kong. Right. It had a wholly owned subsidiary called CGP Investments Limited. It was a foreign company registered in a tax haven. Now what is a tax haven? Cayman Islands. So we had seen tax havens in a couple of classes before. So we saw in these things the taxation laws are relaxed and taxation laws will not apply here. Cayman Islands, Mauritius. So basically, let's say they had invested around 10,000 crore, assume 100% subsidiary. Now, CGP investments had purchased, right? This one had invested in this one that held around 67% of shares in Hutchison SR Limited, HCL, right? So basically, this was the holding company, wholly owned subsidiary, and the wholly owned subsidiary had one more subsidiary called as Hutchison SR Limited. It was an Indian company. It was a joint venture of Hutchison and SR Group. Now, SR Group held 33%. SR Group had 33%. They were providing telecommunication services. Hutchison SR, wherever you go, the network follows Hutchison SR. Earlier, it was how it was. Guys, very simple. Again, I repeat. Hutchison Telecommunication International Limited, HTL, registered in Hong Kong. Wholly owned subsidiary was CGP Investments. CGP Investments was where it was a foreign company registered in Cayman Islands, Mauritius, and that held 67% in Hutchison SR Limited, HCL, whereas SR Group also had 33%. Fair enough. All this was absolutely okay. CGP Investments did not have anything else except 67% of shares in Hutchison SR. So Hutchison Telecom had invested 10,000 crore. In that 10,000 crore, they again invested the full amount here, 10,000 crore, to get what? 67% of shares in HCL. So if you think about it, the Indian company Hutchison SR Limited was indirectly controlled by Hutchison Telecommunication International Limited, HTIL. Anyway, what was the holding company of the Hutchison SR Limited? It was a foreign company. Now, CGP Investments and Vodafone International Holdings. This is registered in Netherlands, whereas this was registered in Mauritius. So these two fellows met up in Australia, and it was a share transfer arrangement whereby CGP Investments Limited transferred 100% of their shares to whom? What? 100% of shares in CGP from what? HTIL. Basically, Vodafone International Holdings met Hutchison Telecommunication International Limited and said, bro, your subsidiary, whatever shares you have, right? That shares that you have, full or entire thing we will purchase. We will purchase the entire thing. So Hutchison Telecommunication International Limited, and of course the representatives of CGP Investments are them only. They said you have an investment in your balance sheet, CGP Investments. That investment, a full investment, we will purchase. So ultimately, guys, Hutchison Telecommunication International Limited sold their entire investment, CGP Investments, which is registered in Mauritius, to whom? Vodafone International Holdings BV. This is registered in Netherlands. Where did they all meet? They all met in Australia. So ultimately, because Hutch sold their investment CGP to Vodafone, what happened directly? Vodafone took over which company? Indirectly, Hutchison SR Limited. SR still continued to hold 33%, but the entire control of that 67% went to whom? Vodafone International Holdings Limited. Now, this obviously held outside. So if you see here, to acquire controlling interest in Hutchison SR Limited, which is an Indian company, agreement of sale of shares of CGP took place outside India. It did not happen within the country, happened outside India. I told you, somewhere in Australia it happened. So ultimately, guys, in this entire structure, I repeat again, Hutchison Telecommunication Network. So let me just show you in a different way, right? If you see income deemed to occur or arise in India, section number 9. So what does it say? Income accruing or arising through or from any business connection in India. Income through or from any property, asset or source of income. Income through transfer of a capital asset situated in India. Just a sec. Right? Then income chargeable and head salaries earned for services rendered in India. So all this you leave, we have already discussed all these things. You see here, income accruing or rising through or from any business connection in India. Is this a business connection in India? No. CGP is a foreign company. Vodafone is a foreign company. Through or from any property, asset or source of income in India? No. Income through transfer of capital assets situated in India? No. So, Hutch Cayman, Hutch British Virgin Islands, Hutch India. Outside India was what? Vodafone. So basically Hutch BBI was sold. So basically ultimately is the income received by Hutch Cayman on sale of shares taxable in India. Shares of a foreign company were transferred. Transaction was between non-residents outside India. Payment was made outside India. Payment was made outside India. Right? So as a result, what happened? Very simple. Hutch Cayman and Hutch BBI, Hutch India was there. That entire thing was sold. Ultimately, what it became? Hutch BBI and indirectly Hutch India. I have just removed this so that directly I have shown Vodafone and Hutch India in this. Make it easy. Vodafone, Hutch SR. In between, one or two things were there. Don't want to confuse. This much is enough. Okay. This is the entire stuff. So then eventually what it became? Vodafone Netherlands became Vodafone British Virgin Islands and Vodafone India. So if you see here, then this is British Virgin Islands. Ultimately it became what? Vodafone British Virgin Islands, and eventually Hutchison SR was renamed Vodafone India. Right? Now, come back. It was a cool case, nothing happened, no tension. But there was a very, very smart assessing officer. Correct? Srivastava. OP Srivastava, if I'm not wrong. So Mr. OP Srivastava said, bro, okay, you are saying CGP investment is outside India, okay. You are telling Hutchison Telecommunication International Limited is outside India, okay. And you are saying Vodafone also is outside India, okay. But he said, bro, but the underlying assets are in India. Since the underlying assets are in India, this would come under which one? If you see, income through the transfer of a capital asset situated in India. It is income generated through what? A transfer of a capital asset. Capital asset would be underlying asset. Through the transfer, issue went to Bombay High Court. Bombay High Court came out with the amazing decision. What did Bombay High Court say? Bombay High Court said, check it out, the transfer of shares by CGP Investments, by whom obviously HTIL, Hutchison Telecommunication International Limited, to Vodafone, this one, obviously that's entire sale, amounts to a transfer of controlling interest in an Indian company, Hutchison SR Limited. Even though you are transferring CGP, ultimately controlling interest of Hutchison is going there. Point number one. The dominant purpose of sale of shares of CGP was to transfer. What is the purpose of sale? Transfer the controlling interest. The High Court said assessing officer is 100% right. Of course, it went to CIT appeals. He also supported the AO, went to High Court. Bombay High Court said OP Srivastava is 100% correct. We should reward the man for his brilliance. In fact, I think OP Srivastava went on to become the CVDT chairman. He was rewarded. So they said, boss, you are not transferring CGP investments ka shares. You are not even transferring. What are you transferring? Controlling interest of Hutchison SR. You are transferring controlling interest of Hutchison SR. Vodafone has acquired a source of income in India, that is Hutchison SR Limited. By reason of this transaction, it has earned capital gains, which is taxable. Correct? HTIL, Hutchison Telecommunication International Limited. By selling the source of income in India, it has what? Earned capital gains taxable in India as the income earned towards the sale consideration of the underlying shares. Underlying shares. Brilliant. Subject matter of the entire transfer as contracted between the parties is not really shares of a Cayman Island company, but the asset situated in India. That's all. These are the exact wordings. So I have written on pointers. I'm reading that out. I repeat, the subject matter of transfer as contracted between the parties is not actually the shares of a Cayman Island company, but the asset situated in India. Deadly. Vodafone was therefore liable to deduct TDS. Vodafone paid the amount. Bro, where is the TDS? TDS only have not deducted on the payment made to HTL, and therefore what was sent, guys? Show cause notice was sent. Capital gain. Let's say if it was sold for 60,000 crore, assume 60,000 minus 10,000, 50,000 crore capital gain, 20% tax, 10,000 crore. Section 195 TDS you did not do, 20%, for which you need to pay 10,000 crore. And I released a show cause notice under section 201. I had given a 201 order. The OP Srivastava had given that order. Bombay High Court said show cause notice is 100% correct. The show cause notice is undoubtedly 100% correct. Deadly case. Deadly case. This went on to Supreme Court. And it is said that though, judiciary is extremely pure, there are certain black marks in the judiciary. And it was held that this is one such case which was a black mark in the judiciary. It has been alleged that the judiciary was sold on this one. Because guys, I'm talking about a 10,000 crore tax, collection. And such a big company called Vodafone. And it was more than tax planning, etc. It was tax avoidance and tax evasion, whatever you did, is what the allegation was. And Supreme Court unfortunately overturned the High Court's very good decision. High Court, whatever they had done was a very, very good decision that was overthrown by the Supreme Court. Overthrown by the Supreme Court. Completely overthrown. By whom? By the Supreme Court. 1 second. Yeah, there you go. For example, landmark Indian judicial on tax planning, SC in McDowell case. Tax planning is legitimate if it is within the framework of law. Colorable devices cannot be part of tax planning. Colorable devices means what? Something that breaks the entire concept of tax planning. For example, this one. Whatever they did was usage of a colorable device. Ultimately, the objective was to evade tax. Principle of Duke of Westminster, taxpayer can arrange his affairs as to reduce tax liability, is dead. Basically, it said that you should obviously tax avoidance scheme you should ignore is what he said. Supreme Court in Azadi Bachao Andolan case, an act which is otherwise valid in law cannot be treated as invalid merely on the basis of some underlying motive, supposedly resulting in some economic detriment or prejudicial to national interest, if it is valid in law, is what the Supreme Court said. But in this particular case, what you did more, if you see the intention, it was to evade tax. It was to evade tax. Anyway, guys, Supreme Court, very, very bad decision. The revenue should look at the entire transaction as a whole and should not adopt a dissecting approach. They cannot dissect it and say, no, you're wrong here, you're right here. That's what they did. Every strategic foreign direct investment coming into India as an investment destination should be seen in a holistic manner, is what the Supreme Court said. The offshore transaction herein is a bona fide structured investment in India. Income Tax Act does not cover indirect transfers between non-residents outside India. That's what happened, indirect transfer. Under the Indian Companies Act also, the situs of the shares would be where the company is incorporated and where the shares can be transferred. Therefore, the situs of the shares is Hutch BVI, is in British Virgin Islands and not in India. Situs means where the position of the shares are. Therefore, shares of the Indian company was not transferred, they said. One of the worst decisions ever. India currently does not have any anti-abuse provisions to tax planning opportunities. This also came later. GAR, General Anti-Avoidance, regulations. We'll see that later. Because of this stupid Supreme Court decision, many amendments came. One of the amendments was GAR. This observation he made, no, India currently does not have anti-abuse provisions. Pranab Mukherjee, like, bro, we'll make. Taxpayer is entitled to arrange his affairs as to reduce tax incidence. In the absence of sham or colorable device, it is not considered as tax evasion, is what they say. Difficult to say that Hutch India or Vodafone was a fly-by-night operator, basically short-term investor. Hutch operated in the telecom sector in 1994. Hutch has made significant contribution to the kitty of revenue by way of taxes. Hence, amount received on sale of shares is not deemed to accrue or raise in India, and hence India would not have any right to tax such income. Worst decision ever, to be honest. Worst decision ever, because you are not selling some, come on guys, you are not buying CGP shares. You are buying what? Obviously, the shares of Indian company only. It was a very, very, very stupid decision. Right? That's all, guys. After that, Pranab Mukherjee said, bro, enough is enough. Brought about retrospective amendments. Retrospective amendments. Deadly amendments. One, we'll come to this. One, they changed the definition of transfer under 247, First Amendment. Second, they changed the definition of capital asset under 2 clause 14. And third, they covered indirect transfers under section 9. Amazing. Because of this, and guys, they did a retrospective amendment from 1962. Pranab Mukherjee did not keep quiet. Did not keep quiet. First Amendment, if you see, 2 clause 14, let's see. An explanation was added, definition of capital asset. Just show you. Here. This explanation was added. here. Inserted by Finance Act 2012 by Pranab Mukherjee with retrospective effect from 1/4/1962. In a capital asset, property is being transferred. Property is also capital asset. What is property? It is hereby clarified that property includes and shall be deemed to have always included from where? From 1962. Any rights or in relation to an Indian company, including rights of management or control or any rights whatsoever. So guys, here by transferring CGP investments to Vodafone International, you may not be selling Indian shares. Okay. You may not be selling Indian shares, no problem. But you are selling property. What is property? Rights. So by selling CGP investments to Vodafone, you are selling the rights of what? Management control. Beautiful. 2 clause 14. Are you understanding? Including rights of management or control or any other rights whatsoever. So first change was 2 clause 14. 2 clause 14. Next, the definition of transfer. 2 clause 47. This transfer. For the removal of doubts, it is hereby clarified that transfer includes, and you see this also, 2012 with retrospective effect from 1/4/1962. For the removal of doubts, it is hereby clarified that transfer includes and shall be deemed to have always included disposing of or parting with an asset or interest therein. What interest? Interest in the Indian company. Or creating any interest in any asset in any manner whatsoever. How am I creating an interest? By transferring. Directly or indirectly, absolutely or conditionally, voluntarily or involuntarily. Tomorrow if hostile takeover happens, that is also covered. Adani did a hostile takeover of NDTV through other means. That also is covered. Just saying, if it were to be a foreign company, I'm saying. By way of an agreement. Now this deadly line. Whether entered into it in India or outside India. By whom? Here it is in Australia. Or otherwise also, I don't care. Either through an agreement or otherwise. Even if agreement is not there, I will deem it to be a transfer. Notwithstanding that such transfer of rights has been characterized as being affected or dependent on flowing from the transfer of a share or shares of a company registered or incorporated outside India. Deadly. Notwithstanding means what? Even though such transfer of rights, transfer of rights in which company? Indian company, has been characterized as being affected or dependent or flowing from. It's flowing from where? Flowing from the transfer of share or shares of a company registered or incorporated outside India. CGP investments. Are you seeing? Brilliant. Brilliant. And of course in section 9. In section 9. Explanation 4 and 5 are added. See in this dialogue, through or from business connection, through or from any property, through or from any asset. This is the fourth one, no? Through the transfer of a capital asset situated in India. Through or from is not there. Supreme Court said since from is not there, India, from nothing is coming from India. It is through. Am I going through an Indian company? No. It's going through some foreign company. Is it coming from an Indian company? No. That from word is not there. So it means it will not cover, is what they told. Wrong decision. Very bad decision. That's why they inserted what? Explanation 4. The removal of doubts. It is hereby clarified that the expression through shall mean and include, and then deadly. They are telling, bro, it always meant also. From 1962 itself. it shall be deemed to have always meant and included what? By means of, or in consequence of, or by reason of. Means what are they saying? By means of. By means of means what? By means of means capital asset, ultimately underlying asset should be in India. That's what it means. By means of, in consequence of, or by reason of. Then explanation 5. Explanation 5. Share of CGP were sold, no? Share of Indian company were not sold. So explanation 5. The removal of doubts. For the removal of doubts. Here. Hereby clarify that an asset or a capital asset being any share or interest in a company or an entity registered or incorporated outside India shall be deemed to be and shall always deemed to be to have been situated in India if the share or interest, for example, I'll tell you, it is hereby clarified that an asset or capital asset being any share or interest in a company or entity registered or incorporated outside India, CGP investments, shall be deemed to be and shall always be deemed to have been situated in India. CGP itself is situated in India. If the share or interest derives directly or indirectly its value substantially from the assets located in India. Deadly. If the value substantially is from the assets located in India. 66.67% substantial value of Hutchison SR Limited is held by CGP. Now, what is this substantial? We'll see later. But just know that yes, 66% is, you can also say it's substantial. Substantially, it's being derived from whom? Indian company only it's derived from. CGP is just a holder of shares. That's all. Custodian, you can say, nothing else. So by this amendment, shares of Mauritian or Cayman Islands company which has investments only in India shall be deemed to be situated in India as it would derive its value substantially from assets located in India. Substantially word was not actually defined. Is it 20%, 50%, 51%, 75%, 100%? Don't know. We'll see that later. Term amendment, the amendment came from 1/4/1962. Deadly. Deadly. Then problem was, now in this case, what were the problems? What were the problems? I'll just open this. So when this happened in 2012, Pranab Mukherjee created a lot of, noise everywhere. To some extent, the foreigners stopped investing in India because they said, boss, I may have many investments in India and that controlling can be somewhere else. Now, if this sells somewhere, I sell this to somewhere else and you are taxing everything in India, I don't want to come to India. I don't want to come to India. Question number 1. Bro, what do you mean by substantial? Please tell. You are saying substantially held. What do you mean by substantial? We don't know. Problem number 1. So they created something called as Parthasarathi Shom Committee. His name was Parthasarathi Shom, Dr. Parthasarathi Shom. So Shom Committee between 2012 to 2014 analyzed the problems that the foreign investments were facing because of this retrospective amendment. First one was substantial means what? We don't know. By the way, though this came in 1962, retrospectively, Vodafone went off to international court and said anything which you'll have to, what do you say, bring something to tax retrospectively, which is to the detriment of the SSE, not for the benefit of the SSE. You cannot bring like that. International court. Lot of pressure from abroad came. So even though it got amended from 1962, CBDT guideline and also instruction from the government was it had to apply only from 2012, which means older provisions are grandfathered. So to a large extent, Vodafone didn't have to pay so much because these regulations, international pressure came. True story. 2012, I followed it very closely because it was my final exam. May 2012, I wrote. But this Vodafone, I was not studying till the exam because I knew that will not come in the exam. It was, a fresh case. But immediately after my exam, I used to study this very, very carefully. That PPT also I had made during that time only, actually. I had given a couple of talks, in the institute for members. I remember I was a young kid and some good people had given me an opportunity to speak on Companies Act and this one. I had made that PPT. I searched that PPT in some old pen drive today. Pen drive was their old one. When my GMCS I attended, that pen drive found somehow. So I showed that now. It was what I prepared over a decade ago. Crazy. 11, 12 years ago, my dear friends. Yeah. So one of my friends was in the Big Four. That time he had done articleship. I was in a medium-sized firm, so I had understood how to make the PPT that way where it moves and all those animation stuff, right? Good fun. Anyway, so I remember the Shom committee during that time. One change was they said, boss, no, lot of political pressure, other pressure, international court pressure. So Vodafone case is like grandfathered. Going forward, you do it. That was point number 1. Point number 2. What do you mean by substantial? We'll come to this. Substantial means what? God only knows. Second, there are investors in the US. They invest in foreign institutional investors. I told you these are predominantly funds. I've explained this already. All come together and this fund will give units. And they will obviously invest in Indian companies. If a US investor who has some 100 units, he sells these units. The moment he sells these units, my dear friends, obviously the underlying share is in India. Even if I sell one share, gone. First of all, substantial word not defined. This one, FI is investing in India should be substantial. What is substantial? We don't know. Let us assume it's substantial. The moment an investor sells one unit also, Underlying asset is in India, so he also has to pay tax. So they said, please explain what is substantial. So you see, that's why one was this, substantially I have to explain. Then for that second problem that I just showed now, substantial, I'll come to it for this problem. Proviso was inserted in the year 2015. Nothing contained in this explanation shall apply to an asset or capital asset which is held by a non-resident by way of investment, directly or indirectly, in a foreign institutional investor as referred to in 115 AD. Right? So it will not apply to the investor. It will not apply to the investor. It will not apply to the investor. Next, first problem, second problem, third problem. This is after explanation 5 proviso. All these explanations are what? To 911. It will all come under that only. So if you see, whatever explanations I am reading, all this 911, A, B, C, D, E. After explanation to again A, B, C, D. All these explanations. 4 we read now. Again, if you are holding it as a portfolio investment, foreign portfolio investment, nothing. Whatever is relevant for the exam I'm doing, other things will come in paper 6C. Explanation 6 was inserted. All this by the Shom committee recommendations. Explanation 6 spoke about substantially. Substantially means what? Explanation 6. This I told you already, explanation 5. This is explanation 6. And 7. Because of Shom committee recommendations, explanation 6, 7, 5 proviso came, plus one more CBDT circular came. What is the problem there? Hutch was there, CGP Mauritius was there, Hutch SR was there. Since CGB now is deemed to be located in India, we have seen that if any dividend is paid by CGP, it is deemed to accrue or rise in India. Though a foreign company is giving dividend to one more foreign company, dividend is not taxed in that country, but dividend, since it's deemed to occur in India, it's taxable in India. So on this dividend, will it be taxed? Answer is yes. This also people did not like. They said, what is this nonsense? Why the hell should I pay tax? So for this, CBDT said, nothing to worry. It will not apply to dividend. It will only apply to transfer of capital asset. Not dividend and all that, don't worry. Dividend is income. No, any income derived from capital asset. No, income doesn't include dividend income. So guys, as I told you, proviso to explanation 5 was added. Explanation 6 was added. Explanation 7 was added. And the CBDT circular came. Explanation 6 defines the word substantially. Explanation 7 talks about if I sell the shares. Substantially means this one here. CGP investment should hold some shares in Hutchison, substantial shares. What is substantial is 1. Second one is unit holders. I told you this example. US investors, FII it will not apply, we saw. Explanation 5, the proviso. But if it is not FII, if it's some foreign normal company, and if I am selling one share also, will it apply? Yes. But it should be, it's wrong. There should be some percentage. What is that percentage? Given in explanation 7, sorry. Talks about the shareholding. How much shareholding if you transfer, will it be deemed to be, okay, attract capital gains, TDS and other things. Let's see that. See, substantially. Everything I'll explain. Explanation 7, proportional capital gains. Everything. Then some other reporting requirements. That's it. So come to the notes, guys. Coolly we'll study one by one and finish it off. Easy. All these amendments will come in the exam. Important. Yes, guys. So all these amendments you should study and go. It is very, very important. Let's see one by one. Come on. It has been clarified that capital asset shall include any rights in an Indian company, including rights of management and control. We discussed already. Therefore, capital asset shall include the rights of Hutchison Hong Kong, an Indian company, including right of management and control. Hence, Hutchison Hong Kong has transferred to Vodafone a capital asset in India, being rights in Indian company, including right of management and control. Discuss that. Explanation 5. Capital asset being any share in a company incorporated outside India shall be deemed to be situated in India. CGP, deemed to be situated in India if the share derives directly or indirectly its value substantially from the assets located in India. Hence, shares of CGP Investment Mauritius being a share in a company incorporated outside India shall be deemed to be situated in India as the shares of CGP derive its value substantially from the business of Indian company located in India. Therefore, if shares of CGP are transferred outside India to a non-resident, then capital gains on shares of CGP shall be deemed to accrue or arise in India, shall be taxable in India. Explanation 5 would be applicable when shares of CGP are transferred and as the effect of transferring directly or indirectly underlying assets located in India. However, discussed this already, CBDT circular. Declaration of dividend by such a foreign company, that is CGP outside India, does not have the effect of transfer. I am transferring dividend. That doesn't mean I am transferring a capital asset. So CBDT said, don't worry, boss. Dividend and all, if you are getting, you can continue to get. It is only I am talking about transferring the shares. So if CGP declares a dividend of 50 crore in its shares on its shares and the said dividend is received by Hutchison Hong Kong, such dividend shall not be deemed to accrue as in India in the hands of Hutchison Hong Kong. Derive its value substantially. Of the Shom Committee recommendations, 2015 Act has inserted the meaning of deriving its value substantially. The share shall be deemed to derive its value substantially from the assets, if on the specified date. Now this specified date, etc., is only for what? This is explanation 6, by the way. Told you here, explanation 6 substantial. So what is this? Specified date not needed for us. This requires minimum 2 hours discussion. This is not for paper 7, it is for paper 6. So leave it. The shares and shall be deemed to derive its value substantially from the assets of a specified date if the value of such assets exceed 10 crore and, important, represents at least 50% of the value of all the assets owned by the company. Guys, what is substantial? First of all, investment should exceed, value of asset should exceed 10 crore and represents at least how much, guys? 50% of the value of all the assets owned by the company. 50% of the value of assets. In that case, it was 66.67% anyway, the investment value, right? That's why. See this balance sheet of CGP investments, example. Share capital 10,000 crore. Investment in HCL 2,000 crore. Investment in some UAE. This is in India, this is UAE 8,000. Is the shares of CGP value substantially located, etc.? What is 50%? It should be 5,000. Is 5,000 crore invested? No. How much is invested? Only 2,000 crore. Therefore, no capital gain shall arise in India. Shares of CGP are transferred outside India to another non-resident because it's not more than 50%. Is the value of asset more than 10 crore? Yes. 10,000 crore is the value of the 2,000 crore. It is more than 10 crore. That you leave. Second condition, it should represent 50% of the investment assets owned by the company. What is the asset owned by the company? 10,000 crore. What is 50% of 10,000 crore? 5,000 crore. Is it increasing? No. Second one. Share capital 10,000. Investment in HCL 6,000. UAE 4,000. What is the overall investment? 10,000. What should be the substantial located? It should be more than 5,000. Is it more than 5,000? Yes. Capital gain shall arise in India. The shares of CGP are transferred outside India to another non-resident. However, guys, again, explanation 7 to section 9 says it should be proportional capital gain. So guys, if I am transferring some asset, whatever, is 10,000 being transferred? No, only 6,000 is applicable to India. No, it is deemed to occur as in India. This is still not applicable to India. So, if the capital gain is some 100 crore, 100 crore is representative of 6,000, right? So, you should be proportionate. That's next one. You see with example, we'll see. In a case where all assets owned by the company referred in explanation 5 are not located in India, take in this example. HCL is only located in India, other one is UAE. Only the part income of the non-resident transfer from transfer of Indian company is reasonably attributable to assets located in India shall be chargeable to tax. In example 2 above, Hutchison Hong Kong sold the entire 10,000 crore investment, this one, 10,000 crore investment in CGP investments. All the shares are transferred at 70,000 crore outside India. Capital gain will be 70 minus 10, 60,000. This 60,000 should be attributable in what way? 60,000 into 6,000 by 10,000. Why? Even though the entire thing is transferred, 40% will definitely not accrue in India. Only 60% will accrue in India. So obviously the capital gain also should be proportionate. Capital gains will be 60,000. So 60,000 into 6,000 by 10,000. So 36,000 CR. Now I was talking about the income individually, unit holders and all. If they sell, what, even if one share if they sell, do they have to pay? That also they defined. That also they defined. This one is important. They had asked in 2019. Similar question here. I have given an example. 19, I think 21 also. Income shall not be deemed to accrue or arise in India to a non-resident from transfer outside India. Any share of a company incorporated in India. One share and all, if I sell, if I sit and calculate, useless. If the transferor individually or along with its associated enterprises, first of all, does not hold the right of control and management, point number one. In this particular case, my dear friends, definitely Hutchison Telecommunication had control over CGP. CGP had control over Hutchison SR Limited. But if this is wholly owned subsidiary, what if there are millions of shareholders and I hold some 3 shares in CGP and those shares I am selling? Tell me, should I pay income tax? No. What is that percentage which is ignored? That is this point. First of all, do you hold any right of control and management? No. What will I hold with 1 share? And nor does voting power or share capital or interest exceeding 5% of the total voting power or total share capital at any time 12 months preceding the date of transfer. You should not hold any voting rights exceeding 5% of the total voting power or total share capital. You should not hold any voting power or share capital or interest exceeding 5% of the total voting power or total share capital at any time 12 months preceding the date of transfer. This that asked in the exam that told that fellow held 10%. He's selling the 10%. Is it valid? Yes. Shares of CGP are held by Hutchison Hong Kong to the extent of 95% and Mr. Kingston to the extent of 4% and Miss Elizabeth to the extent of 1%. If Mr. Kingston and Miss Elizabeth transfer shares of CGP to another non-resident, no capital gain shall arise because first of all, they do not have any right in management and their voting power does not exceed 5%. This they ask for 3 marks, guys. Chiller. Specified date means valuation date. This part you ignore, it's fine. I told you foreign portfolio investor will not covered. Reporting obligation of Indian entity. Please mark this as important. What is the reporting obligation of Indian entity? 285. What should Hutchison SR Limited, Indian company, do? Indian entity shall be obligated to furnish information related to offshore transactions having the effect of directly or indirectly modifying the ownership structure or control of the Indian company. Where shares of a foreign entity that derive its value substantially from assets located in India, CGP, or transfer such shares, the Indian concern shall, within 90 days from the end of the financial year in which transfer of shares of Indian and foreign entity took place, shall furnish the return in 49D. If you don't do, that's the deadliest part. Penalty, 2% of the transaction, guys. 2% of transaction. In my example, if it is 60,000 crore, 2% of 60,000 crore is how much? 1,200 crore penalty, deadly. And 5 lakh in some any other case. So this is the important part. All important amendments covered. Very, very important. Clear? Hope you understood. Easy. But they keep asking. One more exemption was there, just for your knowledge. Write it here. So same, Hutchison Group is there, CGP is there, eventually Hutchison SR Limited is there. Now rather than Vodafone buying this Hutchison, if Hutchison gets amalgamated or merged with some other entity, and all the provisions of amalgamation are properly followed, it is not like a buyout like Vodafone bought. Amalgamation I'm talking about. Would that be a transfer? Generally, Indian shares, it is exempt. And two companies are, but here foreign shares are there. So it may be taxable. That's why to prevent that from happening, 47(6) AB has told that anything that happens, which is covered in explanation 5 to section 9, will not be regarded as a transfer. Will not be regarded as a transfer. Right? This anyway in that separate amalgamation chapter, I have given it as a point. We'll again revisit that later. Just for your knowledge, I told you. 10.1, my dear friends, important chapter of transfer pricing. 10.1, important chapter of transfer pricing. Of the 30 marks in international taxation, roughly 10 marks will come from TP, minimum. So it is the most important chapter of international taxation, transfer pricing. Basics we'll do today, remaining we can see later. Most important is basics. Alright guys, come on. Transfer pricing. Are you ready? Sir, we don't have a choice, sir. So how are you feeling, guys? How is DT? Easy, difficult? Easy dead or dead easy? Easy, no? We have discussed coolly, slowly, everything in depth. So you should be in a position, good position to understand everything. Unilever, United Kingdom, has, let's say, 85% shares of Hindustan Unilever India. So they sell a formula for any FMCG, shampoo, soap, whatever it is. They will sell. Hindustan Unilever Limited has to pay. They will sell it at 1,000 crore. But if two unrelated parties were there, they would have only sold it for 550 crore. So what has happened is, this Indian company, Hindustan Unilever, has to pay them 1,000 crore instead of 550 crore, which means for India, two things, 450 crore, expense is more. If expense is more, profit will be less. Profit is less, tax will be less. So tax on 450 crore is less. Plus you are all law students, right? In economic law, there is something called FEMA, as you know, Foreign Exchange Management Act. It is always better for money to stay in India. If it goes away, what to do? So, unfortunately, FEMA outflow also is there. To plug these two things, Arun Jaitley, especially for this FEMA, he said 450 crore is going outside India, it should come back also. He, in his final budget 2018, changed certain things. We will see this later. But tax on 450 crore, this I am losing out income tax. I need to bring back my income tax. So my dear friends, that is why transfer pricing has come. That is the reason why transfer pricing is there. Very, very simple. That is exactly why we have transfer pricing. So section number 92. Business operates in a dynamic environment. So if you see, transaction between two or more enterprises belonging to the same multinational group can be manipulated so as to cause erosion of tax revenues. To curb such tax evasion or tax erosion, rather, a detailed statutory framework which leads to computation of reasonable, fair, and equitable profits. Equitable means on the basis of equity, means on the basis of what is just than what is wrong or what is unfair. This is what is just, fair. And taxes, profits and taxes in India has been introduced under Chapter 10, Section 92 to 94B. Covers relating to arm's length price, meaning of associate enterprise, maintenance of information and documents by persons entering into international transactions, etc. So, section 92, obviously it all has to be an arm's length price. Show you section 92. Any income arising from an international transaction shall be computed having regard to the arm's length price. Any income arising from an international transaction. So, P, who is in India, enters into an export transaction with J in UK. Excuse me. Excuse me, guys. So P in India enters into an export transaction with J in UK. Two random fellows. Selling price of the transaction is 10 crore, but P, an arm's length price, however, is 40 crore. Would TP regulations apply? Any income, okay, arising from international transaction, yes. Is it international taxation? Yes. Transaction, yes. Shall be computed having regard to arm's length price? Yes. Should the tax be deducted on 40 or 10? 40. 1000% wrong. Guys, if I am selling to this fellow and I don't even know that fellow, why the hell will I sell it at 10 crore? I will sell at 40 only, no? So 92 seems to be, just says international transaction having regard to arm's length price. Nothing extra, it's not telling masala. The masala is added in 92A. Masala is added in 92A. For the purposes of this section and 92, 92B, 92C, 92D, it all has to be what? An associated enterprise. Where is it? You see, let's read 92B, you'll understand. 92B gives the answer, guys. 92B exactly tells what do you mean by international transaction. If you see, 92 speaks about international transaction. 92 speaks about international transaction. right? 92 speaks about international transaction. International transaction is defined in 92B. International transaction means a transaction between two or more associated enterprises. Two or more what? Associated enterprises. Two or more associated enterprises. What do you mean by associated enterprises? That is given in 92A. I hope you are understanding. 92 simply says international transaction. International transaction in 92B means two or more associated enterprises. And associated enterprises means 92A. 92A. See all this with examples. Come back to 92. Any income arising from an international transaction, you will see, shall be computed having regard to the arm's length price. To the arm's length price. Right? So, Indian associated enterprise is making a sale transaction. 10 crore arm's length price. 20 crore. To UK associated enterprise. Now here what has happened? What have I lost? 10 crore, 20 crore, 10 crore I have lost. What I was supposed to earn 10 crore extra, I am just showing it at 10. Similarly, if Indian associated enterprise is purchasing arm's length price is 30 crore, but I am purchasing at 80 crore from USA associated enterprise. Then what happens? 50 crore is what? My expense, unfortunately. Extra expense. Third, Indian associated enterprise has taken a loan from USA associated enterprise. Interest that they are giving, ideally it is 3 crore arm's length price, I am giving 8 crore. All these people started to do when the AO started sending notices. Coolly, the Indian fellow said, okay, sir. Okay, I am selling this, sir. No problem. This I will treat it as income, sir. Okay. But this too, sir. This is expense, sir. And sir, this is interest, sir. You please show me, sir, in the Bare Act. It says income arising from. It doesn't say expense arising from. It doesn't say interest arising from. Income it says. It doesn't say expense incurred. It doesn't say interest payable. Doesn't say that. Any income arising from an international transaction shall be computed having regard to the arm's length price. It doesn't say anything else. So you see, for the removal of doubts, it is hereby clarified. See, this was added later. That the allowance for any expense or interest arising from an international transaction shall also be determined having regard to the arm's length price. Got it, guys? This also will have effect to the ALP, arm's length price. So these two also are covered under transfer pricing. So we have Unilever UK, you have Unilever Africa, Unilever Uganda, Unilever Singapore, Unilever India, they invested in some 1000 crore R&D, research and development. Main Unilever took 200 crore, but they allocated 100 crore here, 200 crore here, 5 crore here only. ₹494 crore here. India income is around 300 only, they allotted 495. Whereas in Africa, very less tax rate, though the income is 500 crore from there, they just allocated 100 R&D. Can they do like this? Will ALP come here? Will ALP be based on the volume of transactions in each country? Allocation also should happen according to that. This golmaal people started doing. And when you ask them, they said, bro, it is neither income nor expense nor interest. It is an apportionment of expenses, apportionment of head office. This is not allowance for any expense, it's apportionment. The subsection 2 came. Subsection 2. And apart from international transaction, domestic transfer pricing also came in the year 2012. Sweeping changes by Pranab Mukherjee in the year 2012, almost 170, 180 changes came. Thankfully, my attempt was Finance Act 2011. Those who did after me died. 2012 Finance Act was a deadly Finance Act. Thank God I passed. Where in an international transaction, specified domestic transaction, two or more associated enterprises enter into a mutual agreement or arrangement for the allocation or apportionment of. This see, allowance is there. Here it is allocation. Allowance and allocation are different. Expenses, obviously, when you spend, it is allowed as per the income tax, that's allowance. Apportionment is different. Of any contribution to any cost or expense incurred or to be incurred in connection with a benefit, service, or facility. Cost or expense allocated or apportioned to, as may be contributed by any such enterprise, shall be determined having regard to arm's length price of such benefit, service, facility, as the case may be. The second part will come there. Even now, domestic transaction also will come as per arm's length price, which we'll see later. Tell me one thing. India is exporting to USA. Export rate was 200 crore. Arm's length price was 150 crore. Will you reduce the income for India? Will you reduce the income and pay less tax? No. Sir, when you are increasing, when you are doing golmaal, you will increase the tax. But sir, when they are very honest, why don't you take lesser one? Pranam Mukherjee say, hey, poda. Subsection 3. Provisions of this section shall not apply in case where the computation of income under subsection 1 or 2A, whatever it is, including allowance, expense, etc., determination, allocation, everything has the effect of reducing the income chargeable to tax or increasing the loss, as the case may be, computed on the basis of entries made in the books of accounts in respect of the previous year was entered into. If it results in reduction of taxation, reduction of income, transfer pricing will not apply. Transfer pricing will definitely not apply. Certainly not apply. Same thing given here, read arm's length price, 2 or more allocation, R&D, all this. Effect of reducing will not apply. When proviso says computation of income, determination of expense, determination of allocation of cost shall not apply. It will not apply for computing the income, for determining expense, allocating, determination of allocation. After allocating, it will apply. Determine how to allot, no, it will not apply. And guys, so for basic determination computation, it will apply. But if it reduces, same. What? Has the effect of reducing the income, increasing the loss, then it will not apply. Otherwise, we have seen on top, no? For if you want to determine the arm's length price, compute everything, it will apply. Same thing. This is important. 2 marks like that they keep asking. Associated enterprise means what? One by one. So guys, now page 10.1, please come to associated enterprise definition. Very, very important, because based on this only they keep asking in the exam. When we see the questions also, you will see. If you see the Q&A vault, you will see many such questions. They can ask you in this thing also, what is that, MCQ also, all one by one. What do you mean by associated enterprises? We have already seen that 92 talks about international transaction, and in that 92B says two or international transaction will happen between 2 or more associated enterprises. And what are associated enterprises? Only then only the arm's length price will come into the picture, because if there are two unrelated persons, I will not sell anything less. Why the hell will I sell it for less? Only when there is associated enterprise, then there will be a chance of this transfer pricing. Unless the market is down and I'm doing a distress sale, that's a different issue. But otherwise, nobody in their right mind would sell it for less. Anyway, so what is this? One enterprise holds directly or indirectly shares carrying not less than 26% of the voting power. why this 26% of voting power is given in Companies Act in section 1142. If a special resolution has to be passed, it should be how much? More than or equal to 75%. Now, suppose if there are two entities which have started one more entity. One entity has, or basically in one company, there are many shareholders. Many shareholders are there. If one shareholder has 26%, then these fellows will have 74%. Can a special resolution be ever passed by these people? No. Which means for this company holds the key if everyone has to pass a special resolution. This company has control over, or this shareholder has control over this enterprise. Because most of the important ones, you will have to pass a special resolution. Like if you have to give a loan, or if you have to invest in some company, in all the cases, it should be special resolution under section 186 of Companies Act. Predominantly, it's like that. So generally board will decide, but if it exceeds a certain threshold, obviously it will be done by the shareholders at what percentage? 75%. So ultimately, if all other people have 74, at least from this 26%, 1% vote I should give. I will tell, no, I will not give you whatever you want. That is deemed to be control. That's what I am trying to tell. See, not less than 26% of the voting power, minimum 26%. So if A Limited has 30% equity shares in B Limited, then it's an associated enterprise. If A Limited USA has 25% equity share capital but 5% preference share capital, it is not an associated enterprise. Associated enterprise tick. Associated enterprise cross. Why? Guys, it speaks about 26% of voting power. Voting power means what? Should have voting rights. Does preference share have voting rights? No. Does preference share have any voting rights? No. So by that logic, no voting rights. ESC means equity share capital. PSC preference. A is associated enterprise. MCQ question. On 1/4/2023, a US company, an Indian company had 24% voting power. On 30/6/2023, US company entered into a contract with an Indian company where the selling price was 100 crore, but arm's length price was 300 crore. They purchased certain goods, which means they just gave them 100 instead of 300 crore. On 31st March 2024, US company in the Indian company acquired 2% more shares, making it 26%. But the transaction had already happened. What do you think? TP will apply, TP will not apply. TP, when will you see? At the time of transaction or when? You will say at the time of transaction, since it's 24%, TP will not apply. Institute will say, you being a chartered accountant, not applicable. See? Two enterprises shall be deemed to be associated enterprises if at any point of time during the previous year, any point of time during the previous year, even if reverse happens, once upon a time it was 26%, at the end of the year it is 2% also, in the middle somewhere the transaction has happened, gone. Very, very clearly we should understand this. Got it? Let's see the indirect control, because it says directly or indirectly. What is indirectly? A Limited has 75% equity shares in B Limited, India, USA, India. Associated enterprise, yes, 25%. B Limited has C Limited, Japan, 50%. Associated enterprises, yes, because one or more enterprise as in the other. What about this? A and C, 75% of 50%, 37.5%, yes, associated enterprise. Directly or indirectly. Clear? Very simple. Next. Any person holds directly or indirectly shares carrying not less than 26% of the voting power of each enterprise. So if you see each enterprise, 30 A Limited, 30% equity shares of B Limited, India. A Limited also has 26% equity shares of C Limited. Any person holds directly or shares carrying of each such enterprise. Is it an associated enterprise? Yes. Is it an associated enterprise? Yes. By virtue of common control, A and B associated enterprise, A and C associated enterprise, B and C also associated enterprise. Common control. Since it has a common control. Using of the word each such enterprise. Case number 2, Mr. A holds 26% equity share in B Limited, 30% in Japan. So B and C also associated enterprises. Any person, if he is holding directly or indirectly shares carrying not less than 20 of each such enterprise, and each such enterprise, two enterprises will be deemed to be associated enterprise. That's dialogue starts like that only, no? Two enterprises shall be deemed to be associated enterprise if any person has control in both, which means these two enterprises will be associated enterprises, common control. A loan not less than 51% of the book value of the total assets, includes stock in trade, advanced by one enterprise to other enterprise. A loan of not less than 51% of the book value of the total assets. A Limited, B Limited has 5% equity share capital. Doesn't matter. Here shareholding will not come. B Limited has given loan of 6 lakhs to A Limited. Right? So guys, this one change, this arrow mark must be reversed. A Limited USA is giving B Limited 6 lakhs loan. Book value of the assets of B Limited is 10 lakhs, which means book value. What is 50%? 5 lakhs. Not less than 51%, it says. Means if the USA company has given more than or greater than or equal to 51% of the book value of assets, which means the 51% of the book value of assets is funded by the loan by A Limited. Just make this change here. Arrow should be reversed. Sorry. Right? I repeat, the logic is very simple. The book value of assets of the Indian company should be funded by the other company. How much? 51% minimum. So here out of 10 lakhs, 6 lakhs is being funded by whom? USA. So 60% is being funded by USA. That's what it is. Yes. that there is deemed to be controlled. One enterprise guarantees not less than 10% of the total borrowings of the other enterprise. What is the total borrowing of B Limited India? 100. But A Limited USA, which has no equity share holding, doesn't matter. But borrowing, they are guaranteeing 25 lakhs. 25% they are guaranteeing. Since total borrowing guarantee 25 lakhs is greater than 10%, so it is associated enterprise. It is an associated enterprise. A Limited USA, no equity share capital, borrowing guaranteed 25 lakh. Next. More than half of the board of directors or one or more executive directors of one enterprise is appointed by the other enterprise. Board of directors appointing is one part of the story, or even one or more executive directors. Executive directors are the directors who are working almost full time in the company. They are the people who are going to decide. So basically, if there are some 10 dummy directors in that, 10 directors out of which 5, 6 are dummy, even if you appoint 6 dummy directors, it's okay. I mean, obviously that is also associated enterprise, but forget about that. Even if you appoint just one executive director, which means of the 10 people, if you just appoint the one who really matters, who really actually will work for you, then it's an associated enterprise. So if you see, A Limited USA, B Limited India, total directors of B Limited are 10. If you have appointed 8 directors, then associated enterprise. On the other hand, A Limited USA, B Limited India, you may have 10 directors also, I don't care. You just appoint one executive director, done. One executive director, you are done. On the other hand, more than half of the board of directors of or one or more executive directors of each of the two enterprises appointed by the same person. A Limited appoints one executive director in B Limited, associated enterprise by virtue of point number 5. A Limited appoint 8 directors in C Limited, which has 10 directors. With point number 5, you are already an associated enterprise. This provision says B and C are also associated enterprises. B and C are also associated enterprise by virtue of common control. So B and C also by virtue of common control, what are they? Associated enterprise. The business of one enterprise is wholly dependent on the use of know-how, patent, technical know-how of the other enterprise. Is the owner which has exclusive right. So Maruti Suzuki, that Suzuki will give the know-how, and Maruti is totally dependent on Suzuki for their know-how. So is Maruti and Suzuki associated enterprises? 100% yes. So if you see A Limited, India, B Limited, Korea, for example, Kia. So this B Limited will give the design, specifications, everything to A Limited, undoubtedly. It is wholly dependent, the entire know-how, etc. is wholly dependent on the know-how, and it's an associated enterprise. And B Limited is a manufacturer of home appliances, whatever the case may be, the design, specifications, everything is provided by them. So is it an associated enterprise? 100% yes. 100% yes. So all this it was taken from UK transfer pricing regulations. UK one. Next, 90% or more of the raw material and consumables required for the manufacture or processing of goods or articles carried out by one enterprise is supplied by the other enterprise. And prices and other conditions relating to supply are what? Influenced by the other enterprise. Are influenced by such other enterprise. If you see, so here, apart from directors, they can also use the word governing board. They'll also use the word governing board. So there is a guidance note on transfer pricing. So there they have defined governing board as what? Institute has released that governing board. It means body or council that has the ultimate authority to manage the affairs. So basically, even if I appoint one executive member in the governing board, that's it. Correct? Because it says more than half the board of directors or members of the governing board or one or more executive directors. So, I mean, that since it will confuse you, I have not written, but just keep it in mind here. See, more than half of the board of directors or members of the governing board or one or more executive directors, which means more than half of the board of directors or more than half of the members of the governing board is what they say. But the what do you say? ICI guidance note has told even if you appoint one governing member also, it's fine. Doesn't make sense. That's why I did not give. It will simply confuse you. That much in depth and all in paper 7 they'll not give. So just remember more than our board of directors or one or more executive directors. Whatever we have given here, just study that and go. Since it was there, I just explain it extra. That's all. Leave it. Leave that. It's fine. Here. So what is it? Case 1. A Limited USA procures yarn, that is raw material for fabric, from B Limited, 50 crore at that rate. Total requirement of yarn is what? 55%. Out of the 55% procurement, USA gives 50%. Is it more than 90%? Yes. Is it an associated enterprise? 100%? Yes. On the other hand, A Limited USA, correct, directs to supply yarn to C Limited, Germany. Directs to do that. Now this one, case 2. Case 2 was not there before. Case 2 are not there before. This was generally called as the, so UK ka this transfer pricing regulations ended here. This was our Indian edition. This was popularly called as the Dubai route. Under the Dubai route, instead of A Limited selling it to B Limited, A Limited used to sell it to Dubai Shell Company. Dubai Shell Company used to sell it to B Limited. So that 50 crore is there, no? I would sell it at anything valued at 5 crore, I would sell it to Dubai at 6 crore, and Dubai would sell it to India at 50 crore. All the money that Dubai would receive, correct? Or let me just change the example here. This is India I have given. Let me change the example. How the Dubai route used to happen, I'll just explain. In Dubai route, what used to happen was India exported to Dubai. And in Dubai, the Indian enterprise's wife only would be sitting there. So rather than giving it to any other country, anything worth 10 crore would be just sold at 12 crore. So in India, how much tax I'll pay? 2 crore over. Dubai will sell it to German company at 40 crore. India should have sold it at 40 crore here and paid tax on 30 crore. But instead, I paid it to, I routed it to Dubai. And Dubai here, 28 crore. This is tax free because in Dubai, tax generally is not there. Now 5% they have brought, but what is 5% compared to 20%, 30%, 40% in India, right? So this was the popularly called as the Dubai route, using one more company in between. So if you see, A Limited directs to supply yarn to C Limited, C Limited supplies to India, all these golmaal if you do also, yes, price and other conditions related to supply, C Limited, B Limited are influenced by A Limited. Hence, all three are associated enterprises. The goods or articles manufactured or processed by one enterprise are sold to another enterprise and prices are influenced by such enterprise, already discussed. A Limited sells cost to B Limited, price and other conditions are influenced. Otherwise, A Limited sells cost to B Limited, B Limited sells cost to C Limited, all are associated enterprise. Where one enterprise is controlled by an individual, the other enterprise also controlled by such individual as relative or jointly together. All these they added later. So Mr. A proprietors in A and company proprietary concern. Mr. A and Mrs. A have 52% share in Bingo and Sons USA, which is a partnership. So since I control one enterprise, me and my relative control one more enterprise, these two, A and company and Bingo and Sons, will become associated enterprise. See, where one enterprise is controlled by an individual and the other enterprise also controlled by such individual or is relative or jointly together, then this enterprise and this enterprise will be associated enterprises. Where one enterprise is controlled by a Hindu underwriter family, other enterprise is controlled by a member of such Hindu underwriter family or relative jointly. Relative as per 2 clause 41. Hindu underwriter family controls A and company, whereas member of Hindu underwriter family and relative of such member holds 52% share in B Limited. A and company and B Limited are associated enterprises. Where one enterprise is a firm, AOP, BOI, and the other enterprise hold not less than 10% in such firm. So A Limited USA holds 11% share in B and company, which is a firm, AOP or BOI, associated enterprise. And there exists any other mutual relationship as and when the CBDT prescribes, then that also will be part of what? Associated enterprises. This is the deal, guys. Now if you see, you will understand what is international transaction. International transaction means between two associated enterprises. At least one of them should be non-resident. It should be non-resident, or resident, non-resident, non-resident, resident. Resident not covered, because if one fellow does through the other, then what happens? Both of them will be like one person's loss will be other person's gain. India will gain eventually, it doesn't matter. But still people were doing golmaal. That's why domestic transfer pricing also came, which we'll see later. For this international transaction, only this. Both non-residents routed through other things. Resident, non-resident, non-resident, resident. Both non-residents will come when you have a source in India. Deemed to occur in India, CGP, all that we saw, no? That one. If they are related. If both are non-residents and transferable, only if the income of one of the non-residents is assessable under Indian income tax. We just discussed that. So matrix, resident, non-resident, resident and non-resident both should be there. If you see, if it is by transaction by resident, transaction with resident, it is obviously not considered as international transaction. Transaction by resident with not resident, it is obviously concerned. Non-resident to resident, it is yes. Non-resident to non-resident, yes, subject to the note above. If the income is assessable under the Indian Income Tax Act, as simple as that. If the income is assessable under the Indian Income Tax Act. As simple as that. International transactions between associated enterprises will include what? Purchase, everything we have covered, guys. This you can just go through. Basically, every single thing you can imagine is covered here. Purchase, sale, transfer, lease, use of tangible, intangible, provision of services also, capital financing, lending, borrowing, guarantee. Any transaction that has a bearing on profits, income, loss, asset, anything. Transaction of business restructuring, reorganization, everything, mutual agreement, arrangement between two more associated, allocation. We just thought about that. No, we just discussed that, allocation. Whatever you can think of is there in this. What they were doing, two associated were there. No, one dummy they used to create. This was unrelated person. On the face of it, unrelated person. So they used to do here and from here to this. That also they covered. Transaction between an enterprise and an unrelated person shall be deemed to be a transaction between associated enterprises if two conditions should be satisfied. This is an important scenario. Please remember this important. If what? There is a prior agreement between such unrelated person and associated enterprise, or the terms of the transaction are determined between such unrelated person and associated enterprise. Unrelated person can be resident, non-resident, doesn't matter. So one what? There should be a prior agreement, or terms are determined by such unrelated person and the associated enterprise. So A Limited USA, B Limited 40% holding is there. Associated directly. Instead of that, what I will do? A Limited, through either a prior agreement or terms of the transaction they'll determine now, will send the goods to C Limited, unrelated party, outside India. And then transaction between C Limited and B Limited shall be deemed to be between two associated enterprises. Between two associated enterprises. Two associated enterprises. Very, very simple. Law clarifies this very, very carefully. So if you see in one of the questions, see this. Six marks that asked. State with reasons whether Netlon LLC incorporated in Singapore and BRICS Limited domestic company are or can be deemed to be associated enterprises for the transfer pricing regulations. Netlon LLC has advanced a loan of 53 crores to BRICS. The total book value of BRICS is 100 crores. See, loan is advanced by one enterprise to another enterprise, not less than 51% of book value. So what is the answer here? Yes. Market value 150, I don't care. I should see book value. Repayment seen, I don't care. It should just be advanced, no repayment involved. I don't care about repayment. Netlon LLC, they do not say outstanding loan and all that. They've just told advancing a loan. So keep note of that. Netlon LLC has the power to appoint two directors of the BRICS whose total number of directors is 4. Guys, it should be majority. Majority means 3 out of 4 in this case. Power to appoint is not the criteria at all. They should have appointed, mind you. See the wordings. More than half is appointed, not power to appoint. So, in the first case, definitely yes, associated enterprise. Second case, not. Because it's just 2 out of 4. It's not majority. And moreover, it is the power. Total value of raw materials of BRICS is 900 crores. Out of this, Nelson supplies 820 crores. So this comes to around 91%. So more than 90 is what they are told, no? So yes, they definitely. So like that, dead easy questions will come. So kindly go through this today. Stop the class here. Kindly go through. In the next class, we'll move on with various types of other transfer pricing. Easy chapter, guys. 2-3 classes we'll take and finish it off. Very easy it is. And pakka 10 marks will come. See, in that question paper, 6 marks came. So please solve the Q&A vault. It will be of utmost help. Okay. See you guys. Take care. Bye-bye. See you. That also. So just remember that. It's going to be very easy. Okay. See you.
All right, my dear buddies, how are you doing? So let's continue with our discussion on transfer pricing. So if you see in the previous session, we're discussing many things about transfer pricing. So in this session, we need to continue. So let us see, come back to where we were discussing all these provisions. We're discussing 92C, computation of arm's length price.
and we were seeing how it should be between two related parties. Even if it is unrelated parties also, we saw that it can be done provided it is routed through various. We understood the Dubai rule and all those things, the Dubai route. Yeah. In this particular area, 92C, there are various methods also that we need to figure out. So let me just take you through section 92C as well. If you see the Bayer Act, let's go there. Computation of arm's length price. So there are various methods in the computation of arm's length price. So this is what we are going to discuss today. At least 3 methods we'll discuss today. Comparable uncontrolled price method, we'll see that. So if you see subsection 4, first of all, where an arm's length price is determined by the assessing officer under subsection 3, the assessing officer may compute the total income of the assessee having regard to the arm's length price. Why have they used the word may? Because if the arm's length price happens to be lesser, then will he proceed further towards, charging the, assessee? No. If the arm's length price is lesser, why will he care? Only if the arm's length price is more, then other issues will come into the fore. So in this question, if the arm's length price is very less, you will not even think about it. That's why they've used the word may. Okay, so do not get confused saying why may has been used. Very simple. And next, what will happen if, let us take an example. There is an Indian company, right, which has exemption under 10AA. And there is a company in USA, Associated Enterprises. So basically the selling price, this company sells certain things at 100 crore, but the arm's length price actually is 130 crore. Now, I have taken, since it's 100 crore, etc., and let us say PGBP here, PGBP final income is around 20 crore. Now, against this, I have taken 10AA deduction 20 CR. So basically, Indian company has not paid anything. Now, because of this arm's length price issue, how much will he, what is the extra amount? 30 crore. This 30 crore will be added here, obviously. So he'll make it 20 plus 30 crore. The question now is, can I take 10AA deduction under this addition also, addition of 30 crore? Can I take a 10AA deduction under the addition of 30 crore? Point number 1. Similarly, can I opt for chapter 6A deductions under this 30 crore? Can I opt for chapter 6A deductions under 30 crore? These are the 2 things that I need to figure out. So for this, just for your knowledge here, that is what is given here. Sorry, this you leave. There. Provided that, I am reading 92C4 proviso, provided that no deduction under section 10A, 10AA, 10B, chapter 6A shall be allowed in respect of the amount of income by which total income of the assessee is enhanced 30 crore after computation of income under this section. After the computation of income under this section. Right? And beauty is, if you make this 130 crore, right? If you make this 130 crore, that is okay. But in a scenario where, you have taken this, all these things, and you have taken additional. So this 30 crore anyway, it is not going to be allowed. It's not going to be allowed. This is when you are selling stuff. On the other hand, if you have purchased at a higher rate, instead of purchasing at 100, you have purchased at 140 and you have paid whatever amount it is, 140, etc. So your expenses is ideally you have paid 140 instead of 100. So here you are taking all those things. This is against Indian company or you will do a foreign company. Obviously, the entire transaction will be with respect to an Indian company. If there is any benefit arising for the other company as such, correct? So if here the selling price here also is 100, ALP is 130 crore, correct? And if there is lower taxation in USA, just assume, here also for that matter, whatever it is, can USA go for a higher income so that they'll take higher income as such? I mean, what I'm saying is, if let's say, if you take the taxation of both the things, Indian company taxation is let's say 30% and in USA it is less for them. So to balance the scale, since both are associated, can the USA company say, I will take the extra tax, don't worry. Why? Because even if their income is increased by 30 crore, tax portion is less only anyway. All these golmaal people used to do, guys. If Indian company does not get benefit, I will take out that income. No problem. So to curb all those things from happening, you see that other provisions also came. Where total income of the associate enterprise is computed under the subsection on determination of arm's length price paid to another associate enterprise from which tax has been deducted or deductible. The income of the other associated enterprise shall not be recomputed. So basically, if I have given and I have already paid tax, I cannot say other company, that is USA company, let me recompute the income altogether. No, not possible. ALP, the transfer pricing will be applicable on one company, and if any tax has to be paid, that company only has to pay the tax and close the deal. Recomputation, all these nonsense cannot be done. That is what this section is telling. Very, very simple. 92C. Yeah. Moving on. We had seen the other areas also. Cool. So what we'll do is, if you see 92C, guys, these are the various methods that we need to understand. 92C1. The same methods I have given it here. See page number 10.5. This we have already discussed. Transaction even between unrelated persons are deemed to be international transactions. Even if it be unrelated person, if I'm using the other company to ensure that there is tax benefit. And transaction between B Limited, C Limited, it can be between in India also, outside India also, I don't care. So it will definitely be applicable. This we had already seen. So moving on here, as I told you guys, computation of arm's length price, section 92C. These are the various methods that we have. Comparable uncontrolled price method, popularly called as the cup method. Resale price method, cost plus method, profit split method, transactional net margin method. In this session, let us just do 3. To get a fair understanding, we will do 3. Comparable uncontrolled price method, resale price method, cost, and if time permits, we'll do the other 2. So, one by one. Comparable uncontrolled price method is called as the cup method as well. Let's see, guys. So all these provisions are given in this one. Rule 10B. Rule 10B. All these provisions are given in rule number 10B. So let us try to understand. Let's say an Indian company, so I'm discussing the cup method. Indian company is giving to a related party, USA. It is exporting 1 lakh goods at 100 rupees. Fair enough. The same goods, similar goods, they are exporting to an unrelated person. Unrelated person in, let's say, Kenya. Here I am taking what? Rupees 120. I am taking it at rupees 120. So cup method, what guys? Comparable method. So if you see, comparable uncontrolled price method. When you mean uncontrolled, where will you control the price? Only if it's a related party. So when I say uncontrolled, what does it mean? Uncontrolled means transaction between unrelated party. Transaction between unrelated party. So this method is very simple. Second, this method is very simple. Just put the charger in. Suddenly everything started flying. Nonsense. 1 second. There you go. So guys, related party in the USA, unrelated party in Kenya, Indian is exporting same amount, same. Here it is 100 rupees, here it is 120 rupees. Comparable uncontrolled price method. What is the controlled price? 100 is the controlled price. What is the uncontrolled price? 120 is the uncontrolled price. So cup method says simple. Take the uncontrolled price. So what would be the arm's length price? Rupees 120. This is as simple as that. So the other would be rupees 120. Now moving on in this 120, what else is there? Let me check. In this 120, it's not just that. There are many adjustments also that you need to look for. So what are those adjustments? Let us check. So for instance, guys, this one, you know, in when whatever I was giving to the USA, this was free on board, whereas this is CIF method. And because it was CIF, you know, I have paid 8 rupees extra. I have paid 8 rupees extra to this Kenyan fellow. So that selling price of 120 includes what? 8 rupees extra. So in order to make it comparable, what should I do? I should subtract it or I should add it. So obviously I should subtract it. So it will be what? 120 minus 8. To make it comparable, I should subtract the discount. We will do a sum also, don't worry. So there will be a discount. 8 rupees discount, so it will be what? 112. 112. Then what will be there? There would be a, let us say, the goods shipped to Kenya. The cost, the entire selling price included warranty also. Warranty was charged at 3.5 rupees. Whereas for USA, the related fellow, no warranty. So since the sale price includes that warranty component also in the cost, obviously I have to subtract the warranty. Definitely subtract the warranty. Right? Then because here there were 1 lakh goods, this fellow had given a discount of, let's say, 2.5 rupees per piece, or overall 2.5 rupees per piece. It is per piece. Basically it should be comparable. Whereas here, was there a discount? No discount. So I need to bring it equal. How will I bring it equal? This doesn't have a discount. This has a discount, 100. So I obviously have to subtract it again. Minus 2.5. Like that. So you see the method process again. Determine the price charged in comparable uncontrolled transaction. In my example, the price charge was 120. Such price is adjusted for functional differences, as we discussed, functional differences between international transaction and comparable uncontrolled transaction. Finally, whatever you get, adjusted price becomes arm's length price. The adjusted price become arm's length price. So after all the adjustments, that will become arm's length price. Very, very simple. Let me just adjust the camera a little bit, then I'll come back and record. Alright guys, so this is done, comparable uncontrolled. So what do you do? Functional differences, and adjusted price becomes the arm's length price. So whatever you adjust, that final price will become the ALP, or the arm's length price is what they say. So if you see here, price charged or pays in comparable uncontrolled transaction, this one, add or less adjustments made for related party specific transaction, arm's length price will be like this. So if you take an example, right, Unilever USA, right, it holds 30% shares in Hindustan Unilever, Indian company. So Hindustan Unilever manufactures CD writers, compact disc writers, CD writers, and during the year Hindustan Liver supplied, so Hindustan Liver supplied how much? 10,000 CD writers at a price of 2,000 rupees. 10,000 units were supplied at 2,000 rupees CD writer. Same time, they also supplied 100 CD writers, just 100, to Tata's at 3,000 rupees. Correct? So other detail given is Unilever, the sale to Unilever is on FOB, whereas the sale to Tata is on CIF. And whatever freight etc. that you paid extra, which was paid by Unilever, right? So the freight etc. paid by Unilever, because it was FOB, was 550 rupees. Was 550 rupees. So obviously I have to adjust for that. This is adjustment number one. These are those functional differences. Second one, Tata, that is backed by free warranty. Backed by free warranty, 6 months. Unilever, no warranty. And the cost of such warranty is roughly around 250 rupees. Third one, if you see Unilever has placed a large order of 10,000. So for Unilever, they have given a discount of roughly 20 rupees per unit. 20 rupees per unit. This is the scene. Very, very simple. So now what happens? Let's see how to do the cup method. Sales price. So I have to obviously take the sales price, which I sold it to whom? Which I sold to these fellows, Tata. So first is what, guys? Sales price per unit. The CD writer, Tata's, 3,000 rupees. Next, less differences to be adjusted. First, on account of freight. So here, if you see, Unilever had paid 550 extra, which means Tatas have not paid. Since Unilever had paid, this has to be subtracted to bring it to proper ALP. So 550 rupees I have to subtract. Point number 2, as you can see here, Unilever had paid extra warranty, whereas Tata already had free warranty. Tata had free warranty, Unilever had paid extra. So to bring it to the same level, I have to reduce warranty, 250 rupees. Then on account of bulk order discount. Bulk order discount here, 20 rupees. Who had taken the 20 rupees discount? Unilever. Tata, there was no discount. So I need to actually give them discount to make it proper. So discount I have to give them 20 rupees. So it comes up to 550, 650, 750, 820 rupees. So 3000 minus 820, arm's length price. How much, guys? 2180. So what would it be? Actually, it is 10,000 into 2000 is the price charge, 2 CR. On the other hand, ALP for 10,000 will be 2.18 crore. So this extra amount, 18 lakhs, that will be the income of Hindustan Unilever. This will be increased. This will be increased because I am adding this particular point. So now that other company also, Unilever cannot say, since my tax rate is little less, etc., I will take it at this amount. Please recompute everything. No, it will not work out like that. This is the cup method. Very, very simple cup method. Second method. Did you understand, guys? Very simple. We'll do a couple of examination questions after these three methods, then it will become very easy. One more point that we will be seeing later is, you may ask a valid question. Sir, you may say, sir, you are saying Unilever is there. Sir, but Unilever may be selling to so many people. Unilever is selling to Hindustan Unilever also. Or rather, sorry, Hindustan Unilever is selling to Unilever also. Hindustan Unilever is selling to, in this you are saying in USA. Sir, they may be selling in UK. They may be selling in Canada. They may be selling so many places. What should I check? So this part we will see later. And even if you see here 92C section that we saw, it says most appropriate method has to be followed. There are certain rules and regulations to actually come out with the most appropriate method. There are certain things to come out with the most appropriate method. Now that portion will be applicable not to you but to that paper 6C. Paper 6C has the concept of most appropriate method. So when we see paper 6C, you will understand what would be the most appropriate method to cover this. So here, this is not the most appropriate method. This is just normally they have given. But we need to also figure out what would be the most appropriate method. Having regard to the nature of transactions, class of transactions, functions, all that blah, blah, blah. So comparable uncontrolled price method, resale price method, cost plus method. Yes. So most appropriate method computation also is there. But let's not see that now. Next, resale price method. Resale price method. So basically, guys, what is this is very simple. If I have purchased certain things for 100 rupees, freight I'm adding, let's say 10 rupees, customs duty I'm adding 40 rupees, totally it's 150, 20% gross profit I'm adding 30 rupees, overall making it 180 rupees. In resale price method, what I should do? Basically, I should try and compute the cost. I have to arrive at this 100 rupees. I'm purchasing it at 100, arrive at this 100 because they would have given you 180. You should subtract the GP, you should subtract these two, they would have given. So they will give you this in the exam plus these three. After subtracting, you will come out with selling price. They will come at cost of 100. You will come at cost of 100. Very simple. Seagate India imports hard disk. Seagate is a very famous, hard disk company. Seagate India imports hard disk from Seagate USA. Fair enough. So since I'm importing, I am paying 1000 rupees. Then freight I am paying 200 rupees, totally 1200. And I am telling that the gross profit is 20%. 20% markup. So I am selling it at 1440. 1440. In resale price method, I will take this 1440 and start subtracting all these things. Guys, freight I cannot change, that's okay. But where I would have played around, I would have played around with this. It will definitely not be 20%. So what we need to figure out, is similar goods in the similar industry, what would be the profit percentage? Here I am showing less profit. It could be more, it could be 30%, 40%, 45%. I can only play around here. Because if you see in the market, everybody would be selling at 1440, 2000, 1500. It's like 10-20 rupees difference. Somebody would be selling pen drive, you see, pen drive when you go buy, or now everything has come Google Drive, but hard disk if you want to buy, you will see the difference is very, very minimal. It's not like 500, 600 rupees difference. It will be bare minimal, like 20-30 rupees difference. So the selling price will be the same, 1440. That is not even the point. The point is not the selling price. The point will be, what will I do if it is, what do you say? How will I figure out this 20%? That is the criteria. And why? What if it is not 20%? That is what we need to see in this particular method. So we'll do a sum. You'll understand. Check this out. Determine the price at which the goods are sold to unrelated enterprises. So I need to figure out you're selling that to how. In this example, Seagate is selling to all other people at 1440. That I will compute 1440 in my example. Such resale price is reduced by normal gross profit margin accruing to the enterprise from purchase and resale of similar goods in a comparable controlled transaction. Right? Guys, comparable, uncontrolled you make, sorry, uncontrolled. Obviously. Comparable, uncontrolled transaction. Which means where the sale is made to an unrelated person. So, whatever price you are selling at in a separate uncontrolled scenario, you should go with that. Right? In case comparable controlled transaction, again here, uncontrolled transaction. Sorry, in case comparable uncontrolled transaction. That's what. It should be uncontrolled, guys. Controlled means what? Where I can do golmaal. Uncontrolled means no golmaal possible. So in case comparable uncontrolled transaction is not available, gross profit of an unrelated person from the purchase and resale of similar goods can be taken. Yes, if uncontrolled transaction is not there, then go in the market and see at what rate they are giving. That rate only you should take. Gross profit margin. So everyone in the same industry will be same because selling price will be the same. Cost here and there will be varying, very, very little variation. So basically you should take the percentage. Even for example, in the CA market, classes market, if you take fast track classes, everybody's rates will be almost similar. And books also now, because of the competition that has increased, books also everybody will give on similar lines. So you will know the gross profit margin of the industry just like that, because everything will be done on similar lines anyway. Right? That's what it says. In case comparable uncontrolled transaction, gross profit on unrelated person from purchase and sale of similar goods can be taken. Next, reduce the expenses by the enterprise connected with the purchase. I told you here, no, this one, this 200, and in this previous example here, which I showed you, this 40 rupees, 10 rupees. The price so arrived at step 3 is adjusted for functional differences, and that adjusted price becomes arm's length price. Same thing here, comparable. Expenses in connection, then functional differences, then finally this thing. So for instance, Tetra Pak Australia company with its associated enterprise Alpha Enterprises in India sold 1000 units at 2,900 rupees. 1000 units at 2,000. This is the towel dispenser. Towel dispenser. 2,900 import. And these are anyway sold to Hyatt Regency at 3,000 per unit. This Alpha in the past or during the same time had also bought similar products from Ultimate Industries. This is a uncontrollable transaction, uncontrolled. And they had sold it to Taj. And they had a profit of 12% on sales. Tetra Pak Australia offers a quantity discount of 10 rupees, whereas Ultimate Industries does not offer any discount. Tetra Pak 10%, 10 rupees discount it gives. This one, no discount. No discount. So this Alpha incurred two expenses are freight and customs. Freight, customs. 10 rupees per unit, 25 rupees per unit. What would be the arm's length price? Very simple. What is the resale price that I am selling at? Resale price 3,000 minus gross profit. Gross profit I cannot take here. I am showing less only, no, obviously. 100 over 2,900. Peanuts I am showing. I should obviously take what? I should take what? The gross profit. What should I? Normal profit margin of any other comparable uncontrolled sales that I should take. 12%. 12% on sales, 360 rupees. Right? This is the crux of the matter. Then expenses relating to purchases. Expenses relating to purchases, how much? Customs and freight, 35 rupees. 35 rupees. Then you see, discount. Tetra Pak had taken a discount of, Tetra Pak had given discount of 10 rupees. Whereas Ultimate is not giving. So, this 3,000 rupees includes that discount. Correct? So, it's at higher rate. So, I should subtract it. Quantity discount allowed. So, what would be the arm's length price? 2595. So, I actually had purchased it for 2,900 in 2,000 units. But actually it is 2595 in 2,000 units. Units are the same only. So 305 is more. So into 1000, 3,05,000 is the increase in the income. 3,05,000 will be the increase in the income. As simple as that. As simple as that. Next, cost plus method. This is very easy, guys. Determine the direct and indirect cost of production incurred by an enterprise for sale of goods or services, direct or indirect cost. Then determine the normal gross profit markup to such cost. That is the profit on cost I should determine, which will arise to an unrelated enterprise or a comparable uncontrollable transaction. Normal gross profit margin again to be adjusted for functional differences. And the cost determined in step number 1 to be increased by adjusted profit markup. And finally, sum so arrived. Direct cost, indirect cost. That will become the cost of production. Then add the industry margin along with functional differences. Cost plus margin will give me the arm's length price only, no sales. Simple. Example. Alto Limited, Germany holds 35% shares in Beta Limited, India. Beta Limited, India develops software and also does on-site and off-site consultancy services for various customers. Now, Beta Limited during the year billed Alto Limited for 100 man hours at the rate of 2000 per man hour. The total cost of direct and indirect cost amounted to 1,75,000. But the same Beta Limited billed one more company C at the rate of 3,000 rupees per man hour for same similar work with a margin of 50%. Right? So Beta Limited derives the technology support from Alto Limited. There is no such support from C. I'm just providing services. So here the value of technology, though I am selling it at this 3,000 rupees, technology support, Alto is giving tech support. And that tech support is amounting to 20% of gross profit, which C is not giving. So I am providing these services plus extra they are giving what? Tech support also they are giving. Extra tech support. Which Beta is not giving. Beta is not giving. And since Alto gives lot of business, they are also giving quantity discount. Quantity discount also 10% of gross profit. Here, one additional point. Beta Limited has to assume all the risks and cost of marketing, and that is 10%. When they are giving to C, there is no support from C, they only have to bear the risk. Adjustment number 1, adjustment number 2, adjustment number 3. Fourth adjustment. Beta offered 1 month credit to Alto. Cost of such credit is 3% of gross profit. Cost of that credit was 3% of gross profit. So they provided credit also. Beta provided credit to Alto, whereas this one was pure cash. Now you see, again this is what? Cost plus method. What should I do? Gross profit markup of C Limited is what? 50%. Then I have to adjust differences. First, less differences with respect to tech support. Tech support, who is giving? Alto Limited is giving tech support, right? 20%. Here they are not giving support, that's why 50% I'm minting money. Here, if they had given that support, this profit percentage would have drastically reduced because I have to pay for that tech support, right? So I have to subtract. So it is 20% of 50%. How much? 10%. I have to reduce. Then one done. Next, quantity discount of 10%. I have given what? Beta limit has given what? Beta has offered to Alto. How much discount? 10%. That discount I'm not getting here. I'm not giving here. So that has to be reduced. %10 of 50%. 5%. Then risk factor here. Risk. Third one. Beta Limited has to assume all the risk, which is estimated as 10%. So that also has to be reduced. Because if beta is assuming the risk, here I am not assuming the risk there. So that extra 10% will come to 5% again. Overall what guys? 30%. Next, 1 month credit. Beta Limited offered 1 month credit to Alto, but there is no credit offered to this. So since credit is issued and directly I am getting, that 1 month credit, cost of credit has to be added, obviously. Add the cost of credit. 3% of 50%, 1.5%. So actually arm's length price profit markup 31.5%. What is the direct plus indirect cost in the given? 1,75,000. What is the arm's length income? 31.5%. So this cost plus markup of 31.5%. So 1,75,000 plus 31.5% of 1,75,000. That will only be the arm's length price, arm's length income. 2,30,125. How much is the income? 2 lakh. How is it 2 lakh? 100 units into 2,000. 100 man hours into 2,000. 2 lakh. What is the overall? 30,125. 30,125. These are the three methods. Let us solve some questions, guys, because method is this much only. As much as you solve questions, it will be in better position to understand. The more questions we solve, it will be better. These are all examination questions, by the way. Come to the compiler. Page 11.2, question number 4.
This was asked in a couple of times, November and all that they've asked, November 2017 if I'm not wrong. Anyway, year is not important guys, but asked in the exam for sure. Hyundai Motors Limited, Indian company, declared income of 300 crores, computed in accordance with Chapter 4D. But before making any adjustments in respect of the following transactions for the year ended 31st March 2023, 10,000 cars sold to Rida Limited, which 30% shares held in Hyundai Motors Limited, at a price which is less by $2,000 for each car than the price charged from Shintco Limited. Royalty of 1.2 crores was paid to Kyoto Limited for the use of technical know-how in the manufacturing of the car. However, Kyoto Limited provided the same know-how to another Indian company for 90 lakh. Loan of euro 1000 crore carrying interest at 10% per annum advanced by Dorf Limited, German company, was outstanding on 31st March 2022. The total book value of the assets of Hyundai Motors Limited amount to another Indian company which is given at 9%. Here I have taken 10%, but I have given the 9% to somebody else. Total interest paid for the year was euro 100 crores. Explain in brief the provisions of the act affecting all these transactions and compute the income of the company chargeable to tax for assessment year 23-24, keeping in mind the value of $1 and €1 as 50 and 55 respectively throughout the year. Simple question, one by one. You see, first one, method of ALP. In case of first one is cup, second one is cup, third one is cup, because they have given other comparable methods as well. So first one, here, see the answer. Since Rida Limited holds 30% shares in Hyundai Motors Limited, both the companies are associated enterprise obviously. Transaction of sale of car is an international transaction. In the instant case, 200 per car is underpriced in the international transaction. Hence, underpricing valuation how much? 10,000 cars into $200 into 50 rupees. 10 crore has been undervalued. Here, 10 crore. What is the income computed? They have given already. Income computed of Hyundai is 300 crores. For 300 crores, kindly add 10 crores because you have undervalued it. Second one. It is assumed that the company is wholly dependent on the use of technical know-how as per 92A2. Transaction of payment of royalty to Kyoto for the use of technical know-how is an international transaction. Yes, Hyundai has paid excess royalty compared to an uncontrolled transaction. 30 lakhs is the differential. 30 lakhs into 50 rupees into 50. So 15 crore. 30 lakh dollar into 50. 15 crore. Third. Loan received by Hyundai Motor Dorf was 1000 crore, equivalent to 55,000 crore. Since the loan advanced by Dorf is more than 51% of the total book value of the assets, we have seen it is more than 51% of the total book value of the assets, then it will become a international transaction in the sense that that international transaction will be between two related parties or associated enterprises. So in this case, it was associated enterprises. Dorf Limited charged interest at 10% to Hyundai but charged interest at 9%. So 1% they are undercharged. Hence the differential in interest is 1%. Amount liable is how much? 1% into 55,000 crore. That is 550 crore they have paid less. That will be added here. Ultimately 875 crore. Like this they ask. One or two more questions we'll solve. Come on. $11.11 guys, very important
This is by far one of the toughest questions asked in the history of international taxation. Important. One second. Let's solve this first, then come back to that nano. See question number 10, page number 11.6. This was May 2018, guys. Question. May 18 new syllabus. When the new syllabus first came, this was under the new scheme. This was the question asked. Amar P Limited, Bangalore, is engaged in IT enabled services. It's a subsidiary of ABC in US. It also provides similar services to a company, SAK Limited, in Singapore. Its billing and other information is as given as under: billings per month to ABC 85,000 USD, billings per month to SAK 70,000 USD. IBC has provided a loan of USD 1 lakh to Amar P towards purchase of hardware for executing its project. Rate of interest charged for the said loan is 3% per annum. Direct and indirect cost 100 and 200. Amar P works 9 hours per day, 15 days to execute projects for ABC and 8 hours per day for 15 for this SAK. Services provided by both is similar throughout the year. Warranty was provided to SAK for a period of 2 years. Cost of warranty is calculated at 1% of direct cost incurred. Cost of warranty is neither included in the direct or indirect cost. Assume conversion rate is 64. Compute arm's length price as per the cost plus method, amount to be added. Cost plus method they have only given. So if they have not given, we have to figure out which method. But that they will only mostly give, guys, no problem. So what is it? Direct cost, cost plus method. Direct cost 100 into 8 into 15, indirect cost 200 into 8 into 15. Total direct and indirect cost 36,000 US dollars. Billings per month, how much? 70,000 they had given. Gross profit 34,000. Difference between the two. Gross profit margin to cost, how much is it? 34,000 into 100 by 36,000. Because this is on sales, I have to make it on cost. 94.44% it will come. Adjustment for functional differences. Correct? There is nothing there. So what? Total direct and indirect cost 36,000. But yeah, what is the functional difference here? Cost of warranty should be added extra 120. Total cost will be 36,120. So billings per month here it is 70,000. Margin 70,000 minus 636,120 is 33,880. Here if I am computing it 93.80. Here in one it is 94.44. Other place it is 93.80. So what do I do here? Direct cost, indirect cost, total direct and indirect cost, cost plus method. Then add what? Interest on loan of USD 1 lakh borrowed for purchase of hardware. You have see here 3% by 12. Same thing. And if you see how much, what is the margin that I should use? 93.80. So ultimately this will come. Direct case. Easy. But guys, important sum is 11.11. Check it out. Nano.
Nano Incorporated, German company, holds 45% of equity in High-Tech Limited, Indian company. High-Tech is engaged in development of software and maintenance of the same for customers across the globe. Its clientele includes Nano Incorporated. During the financial year 2023, High-Tech has spent 2,400 man-hours for developing and maintaining software for Nano Inc., with each hour being billed at 1,300 rupees. Cost incurred by High-Tech for executing work for Nano amounts to 20 lakh rupees. High-Tech also has undertaken developing software for Modi Industries, for which High-Tech Limited had billed 2,700 per man hour. So, in the previous problem that I saw also, they had compared both the things and figured out which has the lower margin. The persons working for Modi Industries and Nano Incorporated are part of the same team and were matching credentials and caliber. High-Tech Limited made a gross profit of 60% on Modi Industries work. Guys, on Modi Industries work, this 60% is the catch here. 60% is on sales or is it on cost? We have to do it on cost, but is this on sales or on cost? This is on sales, most important, which means you have to convert it on cost. High-Tech, that's the important part. Other things are easy. High-Tech Limited's transaction with Nano are comparable to the transaction with Modi Industries. Nano gives technical know-how support to High-Tech, which can be valued at 8%. Since work for Nano involved huge number of man-hours, quantity discount was given, then credit was given, same. The only catch here is 60%. So if you see, normal gross profit markup is 60%. Adjustments for technical differences. Technical support from Nano, 8% of 60%, 4.80. Quantity discount, 14% of 60%, 8.40, 13.20. So I should subtract it to get 46.80. Then cost of credit to High-Tech, 2% of bill value, 2%. Arm's length gross markup 48.8. This is the markup on sales. I should find out the markup on cost. Right? So if you see 100 minus 48.80, that will be the markup on cost. Cost of services provided 20 lakh, arm's length bill value so much, then markup I should compute like this. So it will come up to 39 lakh 6,250 minus actual billing 31 lakh 20,000. Amount is 7 lakh 86,250. 7 lakh 86,250. So actually, how they have to calculate it? Cost incurred is how much, guys? 20 lakh. Adjusted gross profit margin, that is markup cost. See, I'll write here. Sale price is 100. Normal gross profit on sales is 48.8. Which means the subtraction, direct and indirect cost is 51.2. So what is the normal gross profit on direct and indirect cost? So obviously it should be, if you use this 48.8 into 100 divided by 51.2. So the gross profit on cost would be 95.3125%. Mathematics. Applying this percentage on 20 lakhs, I am going to get the markup 19 lakh 6,250. That only is this one, 39 lakh 6,250. Instead, you can do this also. This is on cost, right? 100 minus 48.80. That will be on, the cost. Cost is 100, this for you remove, and it will be the same percentage anyway. Overall amount will come 20 lakh divided by 100 minus 48.8, because this percentage is on the sales, not on the cost. I have to convert to cost, which means if 100 is the sales, 48.8 is the sales margin, remaining is the cost. This 20 lakhs is represented by that 51.1. So what is the final figure? 39.06. Simple. That's it, guys. Already little heavy duty stuff for you. So this much is enough. Study properly. Okay. On that note, we'll end today's class. The remaining methods and all we'll do later. Okay. Take care. See you. Hi, my dear friends. How are you doing? That was Jayakumar here. So let's continue with our session. So we had done the various methods. I had shown you the questions as well. We had done 3 methods. 2 kuti methods are there. It says anyway easy it is. So we'll finish it off and then we'll move on towards other areas. That's it, guys. International taxation is quite simple. Just have to get the hang of it. And then it will become very, very easy. So we have the profit split method, right, and the transactional net margin method. So let's see the transactional net margin method. And of course, there is one more method which says as may be prescribed and computation of the most appropriate method. Also, let's see. Transactional net margin method, also called as TNMM method. What is it? So if, for example, Hindustan Unilever sells shampoo to the parent group Unilever, whatever net profit that they make, let's assume that the direct cost plus indirect cost is around 1000 crore. Selling price is, let's say 2000 crore. So what is the net profit? 1000 crore. 1000 crore. So if you see 1000 crore by 2000 crore, and I will say 50%. But if you see this base selling price, this base obviously is not the correct base because I have taken selling price 2000 crore. I would have sold at, whatever amount it is. It may be less, it may be more, whatever. So if that be the case, they say this base should not be tainted. Should not be tainted means it should not be affected by these controlled enterprises. So what I should do, I should take a similar net profit. Here it is 50% net profit. I may have sold it at less. So I should take a similar in the similar industry, let's say Procter and Gamble or anybody else, how much they have sold it for with the usual parameters I need to check. And when I check that, whatever I get, let us say they have made a profit of 70%, Procter and Gamble. Should I apply that 70% on this? Yes. So my net profit will not be this, it will be 70% of whatever I sell. That is the transactional net margin method. So very simple. So the margin I should see, this margin is how much? 50%. Let us say it is 53%. So extra margin 53%, 3% I have to add. Let's say 4% I have to add. Why 3% I did not take? As you know, I should not take 3% because there is a inbuilt threshold of 3% already given as per the law. So up to 3% plus or minus they will ignore. We will see that in the next one. Right. So we're checking this. Let's continue with this, guys. 92C, all that we see. Anyway, come back. So you see. Sorry. So what is transactional net margin method? Check out. Determine the net profit margin realized by the enterprise from the international transaction on any relevant base. Net profit margin realized by the enterprise from a comparable uncontrolled transaction is computed having regard to the same base. Base should be proper. Net profit margin referred to in step number 2 is adjusted for differences. So as I told you, I am making what? 10% and I'm making 50% in this and Procter & Gamble is making 55%. So it's higher by 5%. So the adjusted net margin would be extra 5%. That's what I should take.
So I should take it 55% of 2000 crore instead of 50%. That's all. As simple as that. Then of course I need to adjust the differences, that normal differences that we adjust, plus or minus, and then finally it is the final percentage is upright. So if 55% includes, that is on CIF, this is on FOB, that plus or minus whatever you do, let's say finally it comes up to 54%. Then that 54% I will apply and close the deal. Very, very simple. So net profit is determined by applying adjusted net profit margin as determined in step number 3. Check it out. A Limited India exports shampoos to B Limited USA, an associated enterprise, and earns a net profit of 10%. The sales are 12,000 crore and net profit is 1,200 crore. India is also exporting shampoos to other countries and earning a net profit of 25% on sales. C Limited India's net profit is higher by 3% here, since its sales are to Middle Eastern countries, only where there is a 3% higher margin on sales. So adjusted net profit would be what? 25% minus 3%, 22% on the basis of TNMM. And applied the sales made 22% into 12,000, 2640. How much did you make? You are just making 1,200 crore. Correct? With just 10% on sales. But actually you are making 25% elsewhere. But since that extra 3% margin was only for the ones in Middle Eastern countries, that was the adjustment that I have to make. 25% minus 3%, 22%. Ideally, I should apply the 22% on 12,000 crore, which is coming up to 2,640. How much am I showing? I am showing 1,200. So what is the extra amount that I have to pay tax on? International taxation 1,440 crore shall be made the income of A Limited on account of transfer pricing, on account of TP. Simple, simple. Now, check this most appropriate method. The most appropriate method shall be applied for determination of arm's length price. However, the variation between the arm's length price so determined and price at which the international transaction has actually been undertaken does not exceed 3%. 1% in case of wholesale trading. So guys, there is a 3% window. There's a 3%, you can go plus or minus, nothing will happen, of the actual transaction price. Such difference shall be ignored and the actual transaction price shall be treated as arm's length price. When the difference exceeds the threshold, exceeds 3%, such difference shall be added to the income of the SSC. So you see, if the actual transaction price is 180 lakhs and arm's length price computed on the basis of the most appropriate method was 185 lakhs, the difference between the two prices does not exceed 3%. 1% is around 1.8. So 1.8 into 3 is 5.4, which means till 185.4, no problem. But now it is just 185. Is it a problem? No problem. Such difference shall be ignored. The arm's length purchase price for Prabhu Limited determined by the most appropriate method for financial year 22-23 are 2,000. ALP in the following situation shall be determined like this. So what is the mean that is most appropriate method? 2,000, 2,000, 2,000. What is the international transaction price? 2,300, 1,900, 2,030. See this case number 2. My transaction price is 1,900, but 2,000 is the ALP, arithmetic mean. Difference is 100. Here difference is 300. Here difference is 30. So I should take 3% of the transaction price. That's coming up to 69, 57, 60.90. If point number 3, the difference is greater than point number 4 or less than point number 4, I need to see. 300 is greater than 69. 100 is greater than 0.4. 30 in this case, 30 is less than 60.90. So what would be the arm's length price? 2,000, this will be 2,000, this will be 2,030. Here addition to the extent of 300, here ALP has the effect of reducing the profit, section 92 shall not apply, obviously.
If anything reduces the profit, I would not take it into account. I will not apply that at all. Here in this case, 2030, is it less than that 3%? Yes. Where 0.3 is less than 0.4, then no adjustment is required. So if there is a decrease, you will increase it, provided it is more than 3%. Second, if it's the same, it's the ALP value, etc. is the same, then 92 shall not apply, because in this case, ALP has the effect of reducing the profit, so it will not apply. Last but not least, the third case, it is well within the 3% threshold. If it is well within the 3% threshold, no adjustment is required. No adjustment is required. Now, the one more problem. When more than one price is determined by the most appropriate method, arm's length price shall be computed as per Rule 10 CA. In the exam, sometimes they may ask you guys, this is predominantly for paper 6. It is coming for paper 6C actually. But if they ask, institute or mental fellows, sometimes if they ask, we should be ready with the answer. This is when more than one price is determined by the most appropriate method. For example, if I just have if I have got all the methods and if I have got some 5 prices, I told you, no, that time one company is there. I am selling similar goods across everywhere. In that only one is a related party, all are unrelated parties. So I need to check all the rates, no, obviously. Which rate will I follow? All the rates. So if you see, if I get like that 5 prices, then I will take arithmetic mean. But if more than 5 prices are there, see 1, 2, 3, 4, I am selling in Canada, in USA, in UK, in Somalia, in Kenya, then what to do? There is a procedure. That procedure is given in 10 CA. Right? So I told you 1% in case of wholesale trading. What is wholesale trading? Just for your knowledge, you can just go through this. Wholesale trading means an international transaction or specified domestic transaction of trading in goods where purchase cost of finished goods is 80% or more of the total cost pertaining to trading activities. Purchase cost of finished goods is 80% or more of the total cost. Average monthly closing inventory is 10% or less of sales in respect of trading activity. So in this case, the purchase cost of finished goods, whatever I am purchasing, the final finished goods is 80% of the cost. So basically, this is for those things where I'll just purchase from somewhere and sell it rather than manufacturing. So this will go there. This is irrelevant. Leave it. Leave it. They'll not ask, just for your knowledge. But here, guys, you see that Rule 10 CA. 1 second. This we have already seen. We'll finish it off, then we'll go there. When the AO on the basis of material or information in his possession is of the opinion that price has not been determined as per 92C or documents are not maintained by the SSE in accordance with 90D or data used for computing arm's length price is not reliable or it's incorrect or SSE has failed to furnish the information within the specified time, then the AO himself can determine the arm's length price, providing an opportunity of being heard to the SSE. When price is not determined, 92C you have not followed, documents etc. you have not filed. Basically, all the documentation has to be filed by the SSE. If it's not filed, then boss, you have not filed this portion. Why? You have given the figure but not filed the documentation. Data used for computing is not reliable. So whatever data you have given, it's not matching with whatever data I have. Tax department has some crazy data with them. So they will say that data, this data not matching. Why, bro? Please tell me. And then SSE has failed to furnish the information within the specified time. So there is a time limit where you have to file it under 92D. If you have not filed, then I can do that. So then what happens? What is the effect of all these things? Where the arm's length price is determined by the AO, no deduction under 10A or Chapter 6A shall be allowed. We have already seen. Once you determine, If on chapter 6A, we have seen this in the previous session, the 50 is the chapter 6A, 50 crore is the income, 50 crore is the reduction. Now I will increase it by 10 crore. On this, we look at chapter 6A decision on 10AA? No. If income of one enterprise is increased by the AO, the income of the other enterprise also shall not be recomputed. This also we have seen. So you check. A Limited and B Limited entered into an international transaction. B Limited provides technical services to A Limited for which it charges 25 crore. AO determined the ALP of this transaction at 22 crore in the books of A Limited. However, in the books of B Limited, income shall continue to be recognized at 25 crore only. Just because you reduce here, that there also it will not be reduced. A Limited in USA holds 28% equity share in B Limited. A Limited provides know-how to B Limited for which it pays a royalty of rupees 100 lakhs to A Limited. As per DTAA, tax rate on royalty is 10%. B Limited reduces TDS of 10 lakhs and remits 90 lakhs to A Limited. B Limited files its return of income of 300 lakhs after claiming expenditure 100 lakhs on royalty. A Limited also files its return of income, royalty 100 lakhs, tax 10 lakhs, TDS 10 lakhs, payable nil. The AO, on the basis of information available with him, determines the arm's length price of royalty to be 40 lakhs. You have shown 100 lakhs. We'll just show 40 lakhs there. Tax implications. A and B are associated enterprises. We know. Since A is a non-resident, is providing know-how, there is an international transaction. Second point. Third point, AO will assess the income of B Limited at 360 lakhs after disallowing royalty of 60 lakhs. Right? 60 lakhs is gone here. It has to be 100, you have shown 40, so 60 lakhs. We'll add it to this 300 lakhs. It will become what? 360 lakhs. Outcome will be deduction under 10A or chapter 6A will not, which is otherwise allowable to be limited, shall not increase on account of addition of 60 lakhs. A Limited cannot claim its income should be 40 lakhs instead of 100 lakhs and cannot claim refund of TDS of 6 lakhs. So these are the tax implications. Same, if one company increases, other company will not increase, will not be allowed to increase. So suggestive methods, as we have seen, we have all seen all these things. These are the suggested methods. Comparable uncontrolled price method is used for loans, royalties, services, etc. Resale price method is applied where there is significant value addition to the product, where I will add more value to that. Software services, I will add more value to it, or any goods where I will actually add more value to it. I'll just take the raw materials and manufacture the goods. Then I will take resale price method. Like I will just import jewelry, or I will just have the raw diamond and actually work on it. Value, add value, a lot of value to the goods and then sell it. Profit split method, it is for, what do you say, integrated services, which we'll see. Transaction net marginal method, as we have seen, transfer of semi-finished goods and finished goods, distribution of products, etc., where only the base should be the same, or base should not be tainted, so to speak. Any other method is for other things. Now this guy is important. Important in the sense it asked once or something in the exam, but it is there, part of the rules, we need to do it. What does it say? When in respect of international transaction or specified domestic transaction, it is applicable for domestic transaction also. The application of the most appropriate method results in determination of more than one price. There is determination of more than one price. Then the arm's length price shall be computed as follows. The arm's length price will be as follows. First one, important, just to know the steps. You will create a data set in the ascending order. A data set in the ascending order, where the data set constructed consists of 6 or more entries. Arm's length range beginning from the 35th percentile and ending on the 65th percentile shall be determined. I'll give you an example, you'll understand. If the actual transaction price falls within the range, such actual price shall be deemed to be the arm's length price. If the actual transaction does not fall within the range, then the median of the data set shall be the arm's length price. Let's coolly see. If it is less than 6 entries, then it will be the arithmetical mean. If it is more than 6 entries, all these things I should do. If there's a fractional number, next higher number I should do. If it is a whole number, average I should do. Sir, nothing I'm understanding. You will not understand anything unless we solve a problem. CR. Check it out. We'll see. Coolly we'll see. No problem. You will see the following prices have been determined as arm's length prices using comparable uncontrolled transactions method. So this has to be, all these things are given, guys. So first you have to do a data set, organize everything in the ascending order. Step number 1. So here data set shall be constructed placing prices in the ascending order. So if you see here, 118, 19, 20, 22, 20, all this ascending order you should do. If it is 6 or less than 6, you can do arithmetical mean and close. But here I should check the 35th percentile and the 65th percentile. So the 35th percentile is what? 10 entries into 35 by 100. How many entries are there? You see, 10 entries. What is the 35th percentile of that? Percentile of the number of entries. So what is 35th percentile of number of entries? 3.5. 3.5 should be rounded off to 4. What is 65th percentile? 65, 7 it will be. The range should be between the 4th number and the 7th number. That's the idea. ALP should be between the 4th number and the 7th number. This is the range. If your thing comes here, then otherwise gone. 4th one, actual transaction price. You see, I mean, in the question they would have given actual transaction price, let's say, was 123. Is the actual transaction price coming in between 122 to 125? Answer is yes. So in case the actual transaction price falls within 122 to 125, such actual transaction price, that is in this case 123, shall be deemed to be the ALP. Very simple. If actual transaction price was, let's say, 120, in this case, actual transaction price does not fall within the range, and the ALP shall be calculated considering the median of the data set. Median of the data set. Median is always midpoint. There are 10 entries, 10 by 2. Median is midpoint. 11 entries means 11 by 2. 25 entries, 25 by 2. 10 by 2 is 5. Since it's a whole number, arithmetic mean of 5 and 6 I should take. That will be the median. So if you see, median is midpoint. Midpoint and the next point divided by 2 you should do to get the final. So if you see, what is the median here? 5th. 5. So 5 and 6 I should take the midpoint. 123 plus 124 divided by 2, which is 122. In case ALP shall be 122. Why is ALP 122? Because the actual transaction price was 120. The actual transaction price comes within that range, then no problem. Very simple. Very easy. Then this is in paper 60, they'll give you weights also. You'll add weights, weighted average. So you'll assign weights to the quantum of cost. All this more in depth you will learn in 60. For our paper, for 30 marks, not needed. But since it's there, I'm giving, that's all. That's all, guys. Very, very simple. This is the most appropriate. Again, I will repeat. There are 10 entries. First, take the, arrange everything in ascending order. For arranging in ascending order, calculate the 35th percentile, 65th percentile. It is 3.5. 4th item, 7th item. Between 4 and 5, the range should be between 122 and 125. If the actual price is within the range, that's the range. If the actual price is not within the range, then it's a problem. Then what should you do? Compute the median. How do I compute the median? Total number of entries divided by 2, 5 in this example. So fifth item and sixth item, average you take, that will be the median. So in this case, 123 plus 124 divided by 2 is 122, sorry. 123 plus 124 divided to 122. That will be the median. In this case, ALP shall be 122. Very, very simple. I think this is wrong, no? 123 plus 124 will be 123.5, guys. Sorry. This will be 124. Change this to 124. My bad. Sorry. Typo error. I was wondering, how is it 123 plus 124 by 2? How is it 122? 124. 124. 123 plus 124 by 2 is 124. Yeah. So again, guys, I repeat, very simple. Ascending order. Second, 35th percentile, 65th percentile. In that range, it should be there. Compare the actual transaction with that range. If it is within the range, leave it. If it is not within the range, calculate the mean. Mean will be number of entries into 50%. Mean, whatever figure you get, that figure plus the next figure, take the average and round it off to the next number. That number will be the ALP. Very, very simple. So this is what it is. Second. So, there was one case law in 2021, just for your knowledge. It was called Engineering Analysis Center of Excellence Private Limited case law. So, in that, what the issue was, I will read out the issue, just listen to it. It's not there in the material, that's why I'm just telling you extra. I just found it in one of the things and found it interesting, that's why. Would the amounts paid by resident Indian end users or distributors to non-resident computer software manufacturers, would it be amounting to payment of royalty for the use of copyright in the computer software? So a resident Indian end user, so I would have bought one package. Let's say I have an app subscription. That app subscription main office is in USA. So let's say it's an editing app. I am paying 5,000 rupees per annum, assume. So when isn't it a software? Yes. For subscription model, isn't it like royalty for software? Yes. So the question here was, would it be liable to determine this in tax reduction at source at under one section 195? So if you see that the royalty means everything, that it means transfer of any rights, etc. So in respect of any copyright, etc., it is also the right to use the software. I am transferring the right to use the software. So if it is directly purchased by the end user, the Supreme Court said that it would amount to the use of copyright. In this case, he had directly used it, right? However, even though you had directly purchased and would amount to royalty, this is not royalty for the purposes of TDS. So it is not royalty for the purpose of use of software. So they held that this particular case, even though it may be royalty under section 9, but that particular DTAA, DTAA says royalty will be not for end user. This was just a question between DTAA and Section 9. Section 9 definitely royalty includes use of software. But in that particular DTAA, it said it is not use of software. Use of software like end user, that is not royalty. So what definition to follow was the case law. That's all. Case law was whether I should follow DTA definition or whether I should follow income tax definition. Till now we have discussed about rates. Rates, if it is DTA or this thing, whichever is beneficial, you should follow. What about definition? Definition also, should I use whichever is more convenient, should I follow? So that's what the answer is, yes. Even the definition, they should follow whatever is more convenient to the SSC. In this particular case, what is more convenient to the SSC? This one, if I don't have to pay tax, it's more convenient, no? So it will come under that particular provision. It will come under that particular provision. So it is not needed. It is not needed. That is one case law. I just found it interesting, so I just want to tell you. So you can just make a note that if royalty gives a benefit to the SSC, if DTA gives benefit to the SSC, then you have to follow DTA, including the interpretation and not just the rates, including the interpretation issues and not just the rates. Come to this, guys, page 10.20, specified domestic transaction. So I'll give you examples. Example number 1. If there is anything between ATIA, a unit under ATIA, IA, IB, 10AA and all those things you have seen, they will enter into a transaction with a non-ATIA unit. Guys, international taxation was one. This is domestic transaction. Why was it introduced? ATIA unit, where it can claim exemption, enters into a contract with a non-ATIA unit, probably of the same business, whereby, let us say, selling price of 200 lakh, selling price of 200 lakh, and what? There is a FMV of 90 lakh. Selling price will be 200 lakh and FMV of 90 lakh. That be the case. FMV of 90 lakh, I am selling it at 200 lakh. If I am selling it at 200 lakh, think about it, for a non-ATIA entity, instead of spending 90 lakh, they are spending 110 lakh more. More money spent, more expenses means profit will be less. First of all, they are gone. Here, instead of getting 90, they are getting 110 lakh more. 110 lakh more, profit will be more. But since it is ATIA, for the entire money, it will be deduction. ATIA is your income based deduction. They will get full ATIA profit, they will take deduction. So the department was getting into a problem, or rather there was obviously, for them it was a loss, both the angles. Here also, both the cases. That is one. Second part is, instead of ATIA and non-ATIA unit and some outsider. This is non-ATIA unit within the same SSC. Some outsider. I would have found somebody who has a lot of my black money, I will want to give off to somebody, so I will do that. So I will find somebody who has a lot of black money. So another party, I also have black money, we will now exchange. So same, instead of ATIA and non-ATIA, ATIA with an outsider. Same transaction, selling price 200, FMV 90. Using this only, you tell me, guys, what will be the what will be the arm's length price, FMV?
I should take the FMV. But this was not part of international transaction. This is domestic transaction. So will that be taken into account? Yes, specified domestic transaction will be taken into account. One more example. Right here. There are specified rate of taxation under 115 BAB where new companies can only pay 15% tax. Profit was, let's say, 100 CR. I will inflate the profit to 250 crore and I will, pay 15%. I will use black money of somebody else and bring it into business and make it 250 crore and make it 15% on that instead of 30%. TP will be applied here also. And on the first 100 crore, 15%. Remaining 150 crore, my dear friends, I'm going to charge normal percentage of 30. These transactions are covered under this one. Which one? Domestic, specified domestic transaction. Specified domestic transaction. Let us see. Check. Specified domestic transaction means the following transactions provided the aggregate of such transaction entered into by the SSE in the previous year exceeds a sum of 20 crore. So this, whatever example I gave you, in this international transaction, there is a threshold of 3%. And here, what is the threshold? 20 crore. If it exceeds 20 crore, then no. Less than 20 crore, no problem. More than 20 crore, problem. See, ATA, ATIA, ATIA, ATIA 8, full ATIA series 15115 BAB. All examples I have given you. Same thing. The same stuff is given. Where any goods or services held for the purpose of eligible business are transferred to any other business of the SSE. Where any goods are held for purpose other business are transferred to eligible business. Consideration for such transfer recorded in the accounts does not correspond into market value. Same thing, 200 crore. For the purpose of deduction, it has been made at the market value on that date. It shall be computed at FMV. Simple, 90 crore you take. Where AO, it appears that AO owing to close connection between SSE of eligible and any other person. First example was ATIA, non-ATIA. This one is ATIA and some other person who has close connection. More than ordinary profits, take the amount of profit is reasonably determined. Same thing. An eligible business means what? ATI, ATIAB, IAC, IB, IC, IE, 10AA and all these things. So that is what we are trying to tell. Simple. So domestic transfer pricing, there's nothing there, guys. Very, very easy. So it will be domestic transfer pricing as well. So while doing all the methods that we were checking, all these secondary adjustments and all we'll see later. One more method was there. Profit split method. So here you check this, page 10.10. Transactions which involves provision of integrated services by more than one enterprise or transfer of unique intangibles means what, guys? I'll explain. So to do that one small method, which is easy here, profit split method. So there is a USA company. It has asked for buying chipsets which is used for remote and the entire hardware. Along with that, the extra software. For example, Amazon Fire Stick. Amazon Fire Stick will have a chip here, which is the brain or the nucleus of the entire device. And of course, it will have the entire hardware mechanism. And apart from that, other software which is linked to Amazon, get on to the Fire TV, Amazon Fire Stick, Fire TV, click on it, it should come. So it will have all mechanisms. The chip is manufactured by one company, let's say ZMC Singapore. The hardware is manufactured by, Amco India. The other software, the connecting devices, etc., that is manufactured by somebody else. USA company asks all these fellows to sell the entire thing. Amazon asks everybody to sell that thing to them. Now it is multiple things that are combined, what to do, which method to use. Best method to use is what? Take the entire thing, because you'll be selling the remote. The chip is useless without the hardware. Hardware is useless without the software. And the interconnecting wires, etc., software, which is again needed for running the TV remote on Amazon Fire Stick, that is also different. Right? So we have the profit split method. How much value would the chip take if the product is sold? I have to compute. How much value will the hardware be? I should take. In these remotes, etc., I recently lost one remote. I bought one remote, 1,800 rupees. Cost will be maximum 200. I'm not joking. So if you see, this method may be applicable in international transaction involving transfer of unique intangibles or multiple international transactions, which are so interrelated that they cannot be evaluated separately. This example. Determine the combined net profit of all associated enterprises. Determine relative contribution made by each of these associated enterprises on the basis of functions performed, assets employed, risk assumed. If one company is assuming the risk, if the remote gets damaged, the chip company says, no problem, I will replace it fully, I will pay for the other two also. Then they should get a higher rate. Split the net profit in step 1 and the ratio determined in step 2. Profit apportioned is considered to determine the arm's length price in relation to the international transaction. Very, very simple. So the total net profit, then you should do the apportionment. Apportion the net profit directly attributed to each of the entities. And then some residual will be left. That also your apportion, the proportion of the relative contribution to each entity. You see here, A Limited USA holds 28% in B Limited India. Further, C Limited Germany holds 32% in B Limited India. B Limited develops software and is into software consultancy. C Limited Germany received an order from D Limited Germany for developing a software product, and A Limited USA, B Limited and C Limited for all the three. Germany each have contributed to the development of the project. Germany finally delivers the product to D Limited and receives consideration of $40,000. C Limited Germany pays a sum of $10,000 and $14,000 to A USA and B Limited India. profit of 10,000 was earned on the entire transaction, B Limited India incurred a total cost of 8,000. The relative contribution is 50%, 20%, 30%. So, entire thing is given here. Price charged by C Limited 40,000. B's share of revenue, A's limited share of revenue, C's share of revenue. Combined total profits 10,000. That also they have given combined total profits 10,000. Relative contribution 20%, 50%, 30%. 2,000, 5,000, 3,000. Total cost for B is 8,000. Total income for India, how much? Revenue share $14,000. B 14,000 plus what? Overall 14,000 minus 8,000. What is 8,000? Second. Sorry guys, I thought there was some mistake in this question. That's why I actually paused the video to check, because what is it? This is correct only. Sorry. So it is 14,000 revenue share plus 6,000. That is why it becomes 20,000. Very, very simple. So I was just seeing like minus and like, why is there a problem? So it's fine. So when I'm making this, when we give it to the designer, no, so we will be very scared. What if that fellow will make plus into minus, minus into plus? So constantly seeing these things. And as you know, few errors are there. I've made you rectify in class only. I mean, I was just wondering whether this was a thing, but my bad. That's why I just paused the video to see whether everything is okay and whether there's any mistake. Right. Moving on, friends. Who are running nose. So it's annoying. Every time I'm trying to talk, there is this white irritation coming out. So I need to, so I'm pausing and, going to the loo and trying to take steam and all those things. Anyway, take care of your health, guys. Most important. Next, what do we do? I'm just trying to go in a proper structure, not in that structure, but understandable structure. Let's see. So, guys, even though so many things were happening, people used to fight. So before that, so what do you do if you fight? But before that, to fight, what documents do you rely on? You rely on something called whatever you have only furnished. So please come to 10.23. Maintenance of what? And furnishing of information and documents by certain persons. So all these things you need to furnish. 92D. Again, all the rules, etc. It's purely procedure as such. So everything. Yeah, this one especially. 10.18. You see, every person who has entered into international transaction or specified domestic transaction shall keep and maintain information and documents prescribed. So this would be called as local files. Basically, guys, if it is less than or equal to 1 crore, there is no need of any documentation. Only if it is more than 1 crore, then we need to take the documentation. Small value less than or equal to 1 crore is considered as small value. Small value not needed, more than 1 crore needed. So every person has entered into an international transaction or specified domestic transaction shall keep and maintain information and documents prescribed. So this predominantly is called as the local file. In legal parlance, it's called local file. So this local file, no, it has to be submitted irrespective of international tax returns, irrespective of whether it's there or not. The second part here, we'll see the constituent entity of an international group shall keep and maintain, inform all the records, etc. So this constituent entity, more in depth, you will learn in 6C. Now it's not needed. So as I told you, a constituent entity, there are some 15-20 pages of rules. This is called as a local file. This is for every person who has entered into an international transaction. But if you are a constituent entity, you have to maintain, see, this is important. There shall be applicable, this shall be, even if there is no international transaction, they have to mandatorily keep filing this. Always. So every person who has entered into international transaction or specified domestic transaction shall keep and maintain information and documents prescribed. Point number 1. That is called local file. This one, constituent entity, this is called as master file. The one who are running with the master file, they always have to, what do you say, file the returns irrespective of whether international taxation is happening or not happening. Master file is a must. So, and also one more thing called country by country report. Country by country report. So as I told you, transaction exceeds 1 crore, document should be kept for 8 years. Gist of the story, more than 1 crore, maintain for 8 years. 3 files, master file, local file. Master file, anyway you have to maintain, local file. Third one, country by country report. It is called CBC report. Country by country report, CBC report. CBC report. So generally in some countries, if things don't go as planned, like in India and USA, there are some transactions which they cannot figure out with any method. So who will do this? Obviously, the prime ministers will not sit and discuss transfer pricing. It will be done by competent officers. Generally, the Director General of Income Tax, these people will be termed as the competent officers. These competent officers, both from India and USA, they will sit and discuss and they will arrive at the arm's price. So now let us go into the concept of where you will refer to the transfer pricing officer, 92 CA. Where reference is made to TPO, transfer pricing officer, page 10.11. Transfer pricing officer. So there used to be litigation because transfer pricing officer used to report something, international transaction, then it will go to TPO, that's transfer pricing officer. AO did not like TPO's order. He used to sit and change all those things. So that's why, to ensure smooth functioning, 92 CA is inserted. Let's see. The AO, with the prior approval of CIT, Commission of Income Tax, may refer the calculation of ALP to TPO. If he wants to do that, he can do so. The TPO shall determine the ALP in respect of other international transactions which are noticed by him subsequently in the course of the proceedings. The beauty is, I ask him 1, 2, 3, 4. Can he add the 5th one also? Yes. Something which has already been reported, but he feels that it has to be, where is it reported? Local file, master file, all these things. But can he add that, saying that, boss, you have missed this out? You may have reported it, but you have not calculated properly. Can he add this? Yes. He can. So can he add the 5th one? Yes, he can. And who has the power will AO have the power or TPO? AO has to listen to the TPO. No second thought about it. AO has to listen to TPO. The TPO has the power to determine the ALP of an international transaction noticed by him even when the AO has not referred the said transaction and even though it was not reported to the SSE. See, order of the TPO shall be binding on the AO. Here, international transaction. TPO is about to determine ALP of an international transaction noticed by him even when the AO has not referred the said transaction. In the MCQ, once they had asked, TPO can determine ALP of a domestic transaction that he has noticed but AO has not referred. Hear it properly. TPO has the power to determine ALP of a specified domestic transaction which he has noticed but not referred to him by AO. Answer is not possible. He can only do the international transaction, not the specified domestic transaction. Specified domestic transaction, like I told you, that ATIA and all those things. So there are 4 items. Can I add the 5th item? Yes. You have referred me only 3. Can I add the 4th one? Yes. Provided it's a international transaction, not a domestic transaction. Domestic transaction not possible. The order determining the ALP by TPO shall be made before 60 days prior to the last date for completion of assessment under section 153. Under 153. And you can rectify any mistake apparent from record. Proceedings are stayed by a court and the time period available to TPO to make the order is less than 60 days. It will be extended to 60 days. But before that, when should you make, guys? 60 days prior to the last date for the date of completion of assessment. So, up to assessment year 2021, time limit to make assessment under section 143.3 was 12 months from end of relevant financial year. And it is from assessment year 21-22, it has become 9 months. Where it is referred to TPO. Where it is referred to TPO, what will happen? It is increased by 1 year. It's increased by 1 year. So combined reading of this and this, what is the scene? So this 12 months will become 24 months. 9 months will become 21 months. So for example, for assessment year 2021, 143.3 is on 31st March 22. Relevant assessment year will be 31st March 21 plus 12 months. And the TP time limit to, what do you say, do the TP will be 31st March 23. And then combining this part, guys, that's the example I want to give you. The order should be passed 60 days from the completion of time limit. 60 days. The assessment has to be completed and order has to be passed. So anyway, 1 year will increase time limit plus 60 days you will get. So April, May. April 30 days, May 30 days. By 30th May should finish. That is how you should read that. Should not get confused.
TPO can rectify any mistake apparent from record. For determining ALP, TPO may exercise the power to summon under 131, power to call for information survey. He has the power of the civil court. TPO means who, guys? JCIT, DCIT, ACIT. Joint Commissioner, Deputy Commissioner, Assistant Commissioner authorized by the board to perform the functions of the AO. CG may make a scheme to make it faceless also. So as you can see, these are all theory aspects, and wherever there is value addition, I'm adding them. Just keep noting them down and going and writing that in the exam. That is more than sufficient. You will definitely do well. Now, because of litigation, many litigations still happened and the courts were getting a lot of pressure. So what did CBDT do? CBDT said, boss, there is a lot of confusion because you are also doing something, they are also doing something. In fact, when this is a UK law, transfer pricing, where India, when they adopted it, they had no clue how to do it. So the officers were sent to England for training for 1 year and they came back, but still nobody knew. That's why in India, TP is generally done by only big fours. They have the idea, and institute organizes various seminars, etc. Only the partners of these EY, KPMG, PwC and all come, who are experts in this TP area. Even when institute organizes this international course, international diploma, international tax diploma, that also is done only by EY, PwC people. The trainers will be those people. So since there was an issue there, they decided to make something called as safe harbor rules. None of these rules will come for you in the exam. It is in paper 6C, and there also you can see the book and answer because it's a lot of things to remember. But you should know determination of the income can happen under safe harbor rules. CBDT made these rules and said, look bro, you don't want any transfer pricing officer to touch your books. Kindly follow the safe harbor rules. Like for example, I'll only tell you, if this is the rate, you offer 18% to income. You offer 25% to income. I will give it's like a ready reckoner where I have given, if this is the income that you are getting, offer 5%. This is the income you are getting, offer 20%. I am giving you that already. When I am giving you that, blindly follow. Why are you seeing here and there? Just follow that and close it. If you follow the safe harbor rules, obviously it's a little tax extra you have to pay. If you follow the safe harbor rules, it is safe. Harbor means ship where it chills at the bay. You don't have to go into the sea. You can chill there by the bay. That's called safe harbor rules. Determination of income under section 911, income of non-resident in relation to operations carried out in India through PE of ALP under 92C, 92CA shall be subject to safe harbor rules. That's all you need to know. There is something called safe harbor rules. Right? Let us see next. We'll come to advanced pricing agreements. That will be done in the next class. Yeah. Then here 10.1a, you need to give a report. Every person who has entered into an international transaction or specified domestic transaction during the previous year shall obtain a report from a CA. Furnish the same 1 month prior to the due date, that is 31st October, in form 3CEV. Otherwise, guys, penalty is crazy. In this case, penalty is 1 lakh. Here, this one, failure to furnish 1 lakh. Apart from that, deadly 2% of the value of transaction. 1 lakh penalty anyway will come, plus 2% also will be charged. So it is something which is very, very deadly. These are all the various points, guys.
we'll stop here. So in the next class, we'll start off with advanced pricing agreement under 92cc. I'm keeping this short and sweet, 1 hour, 1.5 hours, so that you will also feel that, okay, I'm finishing major portions. These are all little theoretical aspects. Practical aspects, we are doing sums. You study this much and go, more than sufficient. This along with, please solve the Q&A. Please solve the Q&A. I have also made you solve many problems. Apart from that, extra are also there. Please solve. You follow my material, this material, and follow the institute, this thing, Q&A material. Nothing else is needed. I can assure you that. Okay. See you guys.